Hello students, today we are going to start with our last head of income, that is income from PGBP. What does this PGBP stands for? PGBP stands for profit and gain of business or profession. So this chapter, income from PGBP, is given under chapter number 4 of unit number 3 of ICS study material in module number 2 on page number 4.169. I hope this is quite clear. If you don't have the physical copy of the ICS study material, don't worry, you can download this PDF from the ICS website. If you don't know how to download it from the ICS website, the link for this PDF is given in the description below. From there you can download it. Okay, the notes that you are seeing right now on your screen are also available for download. The notes are given in the Telegram group. The link for the Telegram group is given in the description below. Before understanding the main provision of the chapter income from PGBP, let's understand this chapter somewhat in layman terms. Okay, so come into the blank page. Over here our assessee is there, Mr. X. Okay, Mr. X is having a business of garments. Okay, and Mr. X has calculated the net profit of the business with the help of accounting standard, and such net profit is equal to rupees 5 lakh. So the question over here is, will this 5 lakh will be straight taken into computation of total income? So the answer for this question is no. Okay, so basically what does income tax says? This rupees 5 lakh that has been derived, that is the net profit derived for this garment business, is as per the accounting standard. Okay, it is not as per the income tax act. So the income tax has given the directions, okay, with the help of which we can ascertain that which all incomes we have to firstly take under the head PGPP and which all expenses we can reduce from this income in order to find out the net profit that will be taken into the computation of the total income. I hope this is quite clear to you all. I hope you all have understood this overview, how this chapter will work into. I hope this is quite clear. And furthermore, I'll give you one more glimpse. Okay, understand that this assessee Mr. X has made his trading P&L account. Okay, over here he has mentioned the sales, say rupees 10 lakhs. Okay, over here he has mentioned purchases of say rupees 4 lakhs. Okay, and there are no opening stock, but there is a closing stock of say rupees 2 lakhs. Okay, and this assessee Mr. X has paid a salary. Okay, has paid interest on loan. Okay, and has also charged a depreciation. I hope this is quite clear. So this is the most common things that we can see in the trading P&L account. Okay, so the assessee Mr. X has paid a salary of say around 1 lakh. Okay, he has paid an interest on the loan of say rupees 20,000, and he has charged depreciation in the P&L account say of rupees 80,000. I hope this is quite clear. And finally the net profit is around, let's see how much, 12 lakhs minus 4 lakhs minus 1 lakh minus 1 lakh. So the net profit comes to around 6 lakhs over here. Okay, but the income tax says that this all expenses that you have reduced from here, okay, and you have find out this net profit, we won't consider this in the computation of total income of the assessee. We will calculate this expenses as per the direction given under the head PGPP. I hope this is quite clear. So for example, understand that there is a direction given for this interest on loan. So income tax says that we won't consider this 20,000 expense entirely. We will only consider up to rupees say 18,000. Okay, and this depreciation is as per the accounting standard and it is not as per the income tax act. I hope this is quite clear. As per income tax act, the depreciation comes to around 1 lakh 20. Okay, so now we will again calculate the net profit. How we will calculate the net profit? Understand it over here. Net profit we will write as it is as per books of accounts. Okay, that is in simple words accounting standards method. Okay, we will write over here 6 lakhs. Okay, so income tax is disallowing this particular 20,000. So what we will do over here is we will add disallowances of expenses as per income tax act. I hope this is quite clear. So how much is the disallowances? Let's see over here. Okay, so first, interest on loan. Okay, entire 20,000 is been disallowed. I hope this is quite clear. And second is depreciation. Depreciation is entirely disallowed of 80,000. Okay, so we will add this total, okay, which comes to around 1 lakh in our profit. That is the net profit, which will come to around 7 lakh. So basically we are increasing the net profit. You can see this, if it is disallowed, that means this will not be reduced from the sales, and finally our net profit will increase. I hope this is quite clear. Many of the time students do not understand these things. Okay, I am teaching something really advanced right now in the beginning. Okay, but this advanced thing will help you throughout the lecture. I hope this is quite clear to you all. Don't worry, I'll revise this entire explanation whatever I am giving it to you over here right now. Okay, so here what I have done is I have taken the net profit as per the books, that is as per the accounting standard of rupees 6 lakhs, and then I have added the disallowances of expenses as per the income tax act. So income tax has disallowed this two expenses, that is 20,000 and this 80,000. I hope this is quite clear to you all. So that is what we have taken, and we have added this expenses back to the net profit. And finally now it is equal to 7 lakhs. Now we will reduce allowances of expenses as per income tax act. I hope this is quite clear to you all. And here income tax allows interest on loan up to 18,000. So that means we will take this entire 18,000 over here. Okay, and income tax allows depreciation of rupees 1,20,000. I hope this is quite clear. So we will write over here depreciation as per income tax act comes to around 1,20,000. Okay, so in the outer column we will take this, which will be equal to 1,38,000. I hope this is quite clear. You all might be thinking that how come income tax act is allowing more depreciation as compared to the accounting standard. So accounting standard says that we need to calculate depreciation as per the company's accounting policies. Okay, but here the depreciation that has been calculated on the asset is calculated as per the rates given by income tax act. I hope this is quite clear. So there is a possibility that the income tax act's rate of depreciation may be higher than the accounting standard. I hope this is quite clear to you all. So that's why even if the calculation of the depreciation is of 80,000 as per the accounting standard, we will take the depreciation calculation as per the income tax act only. Okay, irrespective the depreciation over here as per the accounting standard was lower as compared to the income tax depreciation. Okay, that is not the concern. We have to calculate the depreciation as per the income tax act only. I hope this is quite clear. That's why over here I have taken 1,20,000. Okay, so now we will calculate our net total income. I hope this is quite clear to you all. So let's calculate 7 lakhs minus 1,38,000, which is equal to 5,62,000. I hope this is quite clear. So if you can see over here, earlier our net profit was 6 lakhs. So the concern of income tax department was correct that this calculation of the net profit is not as per the income tax act, but it is as per the accounting standard. So now over here what we have done is we have calculated the net profit as per income tax act. I hope this is quite clear to you all. And this is the profit, that is the net profit as per the income tax act. I hope this is quite clear to you all. Okay, so I hope you all have found it little difficult to digest it right now at the start only, but the entire chapter revolves around these things only. That is, the question will provide us the net profit, and this net profit will be as per the accounting standards. We have to calculate the net profit as per the income tax act. So all the sections that we are going to study under the head, that is PGPP, it will help us to calculate the net profit, this net profit. okay, as per the Income Tax Act. I hope this is quite clear to you all. Okay, don't worry what was this disallowances of expense, allowances of expense, this all we are going to study in the notes. Okay, so now let's come back to the notes. Okay, so over here the first section given under the notes is section 28, which tells us about income under the head PGPP. That means which all income will be considered under the head PGPP. I hope this is quite clear. So earlier we have studied income from capital gain. So we know what does income from capital gain means. So if an assessee is earning an income from capital gain, such income will not be taken under the head of PGPP. I hope this is quite clear. And the income that an assessee has earned from the business, okay, he will not take such income under the head of income from capital gain. I hope this is quite clear. That's why the income tax has specifically given a direction. That means this all are the incomes that we have to consider in the head PGPP. I hope this is quite clear to you all. So let's study income under the head PGPP. Okay, firstly come to point number 9. So basically when we are calculating the gross profit, okay, how we calculate the gross profit? We calculate the gross profit in this simple manner: sales reduced by purchases, okay, reduced by opening stock, okay, and further we add closing stock, and further we reduce factory expenses, and finally we find out our gross profit. I hope this is quite clear. So income tax says that whatever the sales we are doing, that is the business is doing, that will definitely be considered under this section, that is section 28. But other than that, there are certain incomes that has to be considered specifically under PGPP. So that is what is given in this 8 points. I hope this is quite clear to you all. Okay, so now let's understand the first point. First point says that the illegality of a business or profession or vocation does not exempt its profit from tax. What does this mean? So understand it in simple manner. If Mr. X is running an illegal business, okay, but from this illegal business, this Mr. X is earning a profit. So if Mr. X is earning a profit, irrespective the business is legal or illegal, it does not matter. The profit will be straight taken into the computation of income, okay, under the head PGPP. I hope this is quite clear to you all. So let's read this point 1 again. The illegality of a business or profession or vocation does not exempt its profit from tax. It will be considered as income, and the same will be taxable in the income tax under the head of PGPP. I hope this is quite clear to you all. Okay, so now let's understand point number 2. Point number 2 says that compensation for termination of any agency, management contract or any other contract is also considered as PGPP income. So what is this? Let's understand it over here in the blank page. Okay, so understand this in this manner. Mr. X, okay, has taken a franchisee of McDonald's, okay, and Mr. X has set up his premises as per the requirements of McDonald's, okay, but McDonald's cancelled the contract with Mr. X, but Mr. X and McD, that is McDonald's, had a contract which said that if McD is cancelling a contract with Mr. X, okay, then McD will pay Mr. X a compensation of rupees 10 lakhs. I hope this is quite clear. So basically what the scenario was over here, Mr. X had taken a franchisee from McD. Why he has taken the franchisee from this McD, that is McDonald's? He has taken the franchisee from McDonald's in order to run the business and earn income. I hope this is quite clear to you all. But McD cancelled the contract with Mr. X, and MACD and Mr. X had a contract which said that if MACD is terminating or cancelling the contract with Mr. X, then MACD will pay Mr. X a compensation of rupees 10 lakhs. Okay, so basically this rupees 10 lakhs has been received by Mr. X during the course of the business. I hope this is quite clear to you all. That's why if any compensation for termination of any agency, management contract or any other contract is considered as PGPP income. I hope this is quite clear to you all. So let's understand the third income, export incentive or import license sold or duty drawback. So many of the time the assessee, for example Mr. X, has taken an export incentive from the government. If the government is giving the export incentive to Mr. X in order to encourage exports, okay, in India, then whatever the export incentive has received by Mr. X will be considered as an income under the head PGPP. I hope this is quite clear to you all. What does this mean? Import license. Many of the times, in order to import anything in India from outside India, the assessee has to purchase an import license, and this import license is given for a particular time frame. Okay, so for example, understand this in this manner. This import license is given for say 10 years. Okay, but after 5 years Mr. X wants to quit from this business due to high compliances, okay, of government. So he sells off this import license. So if this import license which he has taken from the government in order to import in India, and if he is selling this license and whatever consideration has been received by the assessee for such sale of import license, it will be considered as income under the head PGPP. I hope this is quite clear to you all. Okay, so basically do not consider this import of license as capital asset. Okay, this import license is not a capital asset. Okay, this is simply a cost. Okay, and if the assessee is again selling this import license in future, okay, due to quitting the business, okay, or any other reason, then whatever consideration has been received or money has been received for this import license sold will be considered as income under the head PGPP. I hope this is quite clear. What does duty drawback means? Many of the time the government gives duty drawback. Okay, what does this duty drawback means? Duty drawback simply means that the assessee will pay taxes, okay, and if assessee complies certain conditions of government, then the government will pay the assessee the duty, that means the taxes that the assessee has paid to the government. Okay, so this is known as duty drawback. So if the government or if any authority is paying the duty drawback to the assessee, then whatever is the duty drawbacks amount, it will be considered as income under the head PGPP. I hope this is quite clear to you all. Okay, so now let's understand point number 4. Point number 4 says that non-competence fees. What does non-competence fees means? Let's understand it over here in a blank page. Okay, so understand that Mr. X is doing a business in a particular area. Okay, and Mr. Y is a business chain holder and he wants to do the business in the same area. Okay, in the same area, this same area. Okay, but Mr. X is already doing business in that area. That's why if Mr. Y will start a business in this same area, then Mr. Y will incur loss. So what does Mr. Y does? Mr. Y asks Mr. X that you sell off your business in this particular area, or else you do not sell off this business. I will give you, this Mr. Y will give Mr. X a consideration of say rupees 50 lakhs. Okay, for 5 years, okay, and Mr. X will not carry the business in this particular area for 5 years. I hope this is quite clear. So Mr. Y is paying to Mr. X a non-competence fees, okay, a non-competence fees. So if a non-competence fees has been received by an assessee who is running a business in a particular area, it will be considered as a business receipt. I hope this is quite clear. So this non-competence fees received by a particular assessee who is running a business, then such non-competence fees will be considered as income under the head PGPP. I hope this is quite clear to you all. Then let's move on to next point. Point number 5. Any sum received under Keyman insurance policy. What does this mean? Let's understand it over here. So understand that Mr. X is having a very established business, okay, and Mr. X himself is not running the business, okay. The business is run by these 4 peoples, okay, A, B, C and D. So these people are the key managerial person who are running the business of Mr. X. So if Mr. X take the policy for this key managerial person, okay, and God forbid if anything happened to this key managerial person, then Mr. X will receive an insurance compensation from the insurance company. I hope this is quite clear. So if Mr. X has taken a key managerial insurance policy for this key managerial person and something happens to any of the key managerial person, then Mr. X will receive the insurance compensation. So what this insurance compensation will be? This insurance compensation will be considered as income under the head PGPP. I hope this is quite clear to you all. Okay, so that is what is given over here. Any sum received under Keyman insurance policy, it will be taken under the head PGPP. I hope this is quite clear to you all. So now let's move on to point number 6. Point number 6 says that sales proceed of assets of business specified under section 35 AD. So what is this section 35 AD? We will understand it first of all, then we will understand this point. Okay, before understanding this point, to make you all understand this particular point number 6, it is something very difficult. Okay, you need to understand what does this specified businesses mean. I hope you know by now specified business. We have already studied under set off and carry forward about this specified business, but we have not studied specified business in detail under section 35 AD. Okay, over there I told you that we will study this specified business under section 35 AD under the head income from PGPP chapter. Okay, so we will study it over here. So now let's move on to next income, point number 7, which says that sum received in cash or kind on account of transfer of the right to the manufacture, product or right to carry out business or profession. So after reading this much, you must have automatically understood that this is basically sale of self-generated asset. Okay, basically over here the assessee is selling the right to manufacture, product or right to carry out a business or profession. That means he is selling off his goodwill as well as the business. I hope this is quite clear. So you already know that goodwill is a capital asset, and here simply you can see that the assessee is transferring. So if there is a capital asset plus there is a transfer, okay, then automatically capital gain will get triggered. I hope this is quite clear under section 45 subsection 1. I hope this is quite clear to you all. I hope you remember income from capital gain chapter. Okay, so now let's move on to point number 8. Point number 8 says that FMV of the inventory on its conversion into capital asset. What does this mean? Understand it over here in the blank page. Okay, so Mr. X is doing business of property. Okay, so basically the inventories of Mr. X will be flats or houses. Okay, so if this inventory, okay, is converted into capital asset of the assessee, then how things will be? The things will be in this manner. The inventory which is converted into capital asset, this CA stands for capital asset, then the fair market value of the inventory will be considered as sales, okay, and this will be deemed sales, okay, and this deemed sales will be taken under the head income from PGPP chapter, and further we will calculate total income of the assessee. I hope this is quite clear to you all. Okay, so let's revise the section number 28, okay, that is income under the head PGPP. First point says that the illegality of a business or profession or vocation does not exempt its profit from tax. It will be considered as income and the same will be taxable in income tax. Let's revise point number 2. Point number 2 says that compensation for termination of any agency or management contract or any other contract is also considered as PGPP income. Point number 3 says that export incentive or import license sold or duty drawback, whatever this amount has been received by the assessee, will be considered as income under the head PGPP. Non-competence fees received by the assessee, okay, for not performing a particular thing, then such non-competence fees will be considered as income under the head PGPP. Any sum received under keyman insurance policy, okay, for the insurance of this keyman, then whatever this insurance amount has been received by the assessee, it will be considered as income under the head PGPP. Okay, let's move on to next point. Point number 6 says that sales proceeds of assets of business specified under section 35 AD, then it will also be considered as income under the head PGPP. Okay, let's revise point number 7. Point number 7 says that sum received in cash or kind on account of transfer of the right to the manufacturer. Okay, so now let's revise point number 7. Point number 7 says that sum received in cash or kind on account of transfer of the right to manufacture a product or right to carry out a business or profession, then this will not be considered as income under the head PGPP, but it will be chargeable under the head income from capital gain, because there is a capital asset plus there is a transfer, and therefore capital gain is triggered under section 45 subsection 1. I hope this is quite clear to you all. Okay. So point number 8 says that fair market value of the inventory on its conversion into capital asset, then whatever is the fair market value of the inventory, it will be considered as income under the head PGPP. I hope this is quite clear. Point number 9 says that the normal sales plus commission or professional fees received by the assessee, it will also be considered as income under the head PGPP. I hope this is quite clear to you all. So the next point over here talks about speculative transaction. We have already studied what the speculative transaction means under the chapter set off and carry forward. Okay, so we will simply read it. Okay, so point number 1 over here says that it means purchase and sale of securities or commodities or stock without taking the actual delivery. Okay, so by now you know what does this means. Point number 2 says that if a part of a business of a company consists of such speculative transaction, then such company shall be deemed to be carrying on a speculative business to the extent of such speculative transaction. I hope this is also quite clear and quite self-explanatory, because we have already studied this speculative transaction in detail in set off and carry forward chapter. If you don't remember, then please go and watch set off and carry forward lecture. I hope this is quite clear to you all. Okay. The last point says that if the main purpose of the business of a company is a speculative transaction, then they would not be deemed to be carrying on the speculative business. I hope this is quite clear. If you remember, in set off and carry forward chapter, I have made a chart of speculative transaction. Over there, these 2 points we have studied. I hope this is quite clear to us. So basically, this is the overview of the chapter, that is income from PGPP chapter. I hope this is quite clear. We will see this at the end after studying all the sections. I hope this is quite clear. Okay students, so now let's understand the expenses. So the very first section is section 30. What does section 30 says? If the assessee is incurring an expense of rent, or he is incurring an expense of rates and taxes and insurance of the building, then such expenses will be allowed as business expenses. That means these expenses can be reduced from the income of business. In other words, this expense will be allowed for calculating the net profit as per income tax Act. I hope this is quite clear to you all. Okay, so let's read this section 30. Section 30 says that rent, rates, taxes and insurance, so this all are the cost paid for the building by the assessee, okay, and such cost has been paid for the business related work, then such expenses will be allowed as deduction. What does this means, will be allowed as deduction? This simply means that this will be allowed to be reduced from the income of the business. I hope this is quite clear to you all. So for better understanding, let's again come back to our blank page. Over here I explained you this example that this particular net profit was calculated as per the accounting standard. So for example, understand over here there was this rent and rates for the building of rupees 10,000. Okay, so this entire 10,000 will be allowed as expense from this sales. That is, in order to calculate this net profit, whatever this 10,000, that is the rent and rates and taxes paid for the building, this will be allowed for calculation of the net profit. That means this 10,000 we will not add back into the net profit. That means we will not disallow that expense as per the Income Tax Act. I hope this is quite clear. But if this rent, rates, taxes and insurance of a building are related to his personal use, that means the assessor's personal use, then it will be added back to the profit. I hope by now you know what does add back to profit means. Okay, so all these things that I have explained to you all over here in this blank page, I have explained it to you all so that you can understand what does deduction allows mean and what does add back to profit means. I hope this is quite clear. I hope I have created a well set base for you all. Okay, so now let's understand this again. Section 30. Section 30 says that rent, rate, taxes and insurance paid for the building and such building is used for the business, then whatever expenses has been done for this building, okay, this will be allowed as deduction from the income. Okay, from the income and for the purpose of calculating the net profit as per the Income Tax Act. I hope this is quite clear. But if this rent, rates, taxes and insurance have been paid for the building and such building is used for otherwise than business, in simple word has been used for the personal use, then such expenses will be added back to the profit. I hope this is quite clear to you all. Okay, so basically remember that in exam the examiner will provide you this detail, that is the profit and loss as per the accounting standard. We have to consider this net profit over here and then we have to calculate the net profit as per the Income Tax Act. So basically this method is known as indirect method of calculating net profit as per Income Tax Act. I hope this is quite clear to you. And what is the direct method of calculating the net profit as per the Income Tax Act? The direct method is the question will simply provide us with the sales and all the expenses that will be allowed as per the Income Tax Act. Then we need to simply make this table only, and this table will be as per the Income Tax Act and not as per the accounting standard. I hope this is quite clear, because all the expenses will be as per the Income Tax Act only given to you in the question. That would be a very simple question, but most of the time in exam the examiner asks indirect method only. I hope this is quite clear to us. That means you have to consider this value over here and you need to add all the expenses that are not allowed as per the Income Tax Act, and further you have to reduce the same expenses which are allowed by the Income Tax Act, but there are certain limits. Okay, so over here you have seen that limits also, how income tax give the limits. Okay, and finally we will find out the net total income as per the Income Tax Act. Okay, so now again I'll not come back to over here and again explain you this all things. Okay, I hope you all have understood this much, what does deduction allow means and what does add back to profit means. Okay, so now let's move on to the next section, that is section 31. Section 31 says that repairs and insurance of a plant and machinery for the business purpose, then whatever expenses has been incurred for this repairs and insurance of this plant and machinery, and this plant and machinery is used for the business purpose, then such expenses will be allowed as deduction from the income for computation of net profit. Okay, under the head PGPP. I hope this is quite clear to you all. But if the repairs and insurance of this plant and machinery is done and this plant and machinery is used otherwise for business, that means this plant and machinery is used for personal use. In simple words, understand that plant and machinery can be AC and this AC is of the assessee's residence. Okay, then the repairs and the insurance cost of this AC incurred by the assessee and such expense has been taken in the business, then such expense will be not allowed as expense and such expense will not be reduced from the income for calculating the net profit. In other words, it will be added back if, as per accounting standard, the net profit has been calculated and in that net profit such repairs and insurance which has been incurred for the personal plant and machinery has been reduced from the net profit, then such cost of repairs and insurance of plant and machinery will be added back to the profit. I hope this is quite clear. Sounds little complicated, but don't worry, I'll just show it over here once. Okay, understand this. This is the net profit, say rupees 5 lakh as per accounting standard, and in this 10,000 repairs and maintenance cost of personal AC has been reduced. Okay, so what will be the strategy as per the income tax act's net profit? We will firstly consider this 5 lakhs, okay, and we will add personal expenses of 10,000, okay, and finally we will find out 5,10,000 will be the net profit as per the income tax act. I hope this is quite clear to you all. So this section, that is section 30 and section 31, you don't need to remember these sections, okay, you just need to remember the name of the expenses, that is rent, rates, taxes and insurance of a building. Okay, if these expenses have been incurred on the building and such building is a building used for the business purpose, then whatever the expense has been incurred, it will be reduced from the income. I hope this is quite clear. And finally, it will be considered in calculating the net profit as per Income Tax Act. I hope this is quite clear to you all. Similarly, in section 31, if repairs and insurance cost has been incurred for the plant and machinery and this plant and machinery is used for the business purpose, then whatever the cost has been incurred will be reduced from the income, okay, and will finally calculate the net profit, okay, of the assessee. I hope this is quite clear to you all, okay. But if all these expenses are incurred for otherwise than for business purpose, then such expenses will be added back to the profit if it has been already reduced while calculating the net profit as per accounting standards. I hope this is quite clear. Okay students, so now we will understand our next section, that is section 32, depreciation. So there are two ways of calculating depreciation, one as per accounting standard and one as per the Income Tax Act. So what does Income Tax Act says under section 32? Under section 32, Income Tax Act says that depreciation as per accounting standard will be disallowed. That means whatever the depreciation has been calculated as per the accounting standard will be added back, okay, will be added back to the net profit that has been calculated by the assessee as per the accounting standard, and depreciation will be calculated as per the Income Tax Act and it will be reduced from the income in order to calculate the net profit as per Income Tax Act. I hope this is quite clear to you. So let's come into a blank page and understand this over here. There is our assessee Mr. X who has calculated net profit which is equal to rupees 5 lakh, okay, and in order to calculate this rupees 5 lakh, depreciation as per AS was rupees 1 lakh, okay, it was reduced. So basically what we have to do is we have to take this net profit as per books, okay, which is equal to 5 lakhs. We need to add back the depreciation because this depreciation amount calculated as per the accounting standard is not allowed by the Income Tax Act. I hope this is quite clear. So that's why we are adding this back and we are increasing our net profit. So our net profit will be equal to 6 lakhs and further it will be reduced by the depreciation as per Income Tax Act. I hope this is quite clear to you. So basically under section 32 we will understand how to calculate the depreciation as per the Income Tax Act. I hope this is quite clear because this figure of accounting standard will be already given to you in the question. We need not need to calculate this 1 lakh rupees. It will be simply given to us. We need to calculate at times the depreciation value as per the Income Tax Act, but many of the times the question may provide you with the depreciation figure as per the Income Tax Act. I hope this is quite clear to you. So come to our notes, okay. So let's read it again. Section 32, depreciation. Depreciation as per accounting standard will be disallowed and added back to the net profit, and depreciation as per the Income Tax Act will be calculated and reduced from the income in order to calculate the net profit as per Income Tax Act. I hope this is quite clear. So there are certain conditions in order to calculate the depreciation that we need to see, but we will not see the condition right now. We will see the rates of depreciation for calculating the depreciation on the depreciable asset. I hope this is quite clear. So the rates of depreciation are given on the next page. So let's understand the rates of depreciation. Okay. So first asset, which is a depreciable asset, is a building. Okay. So if there is a building and such building is normal building and it is used for business use only, then the rate of depreciation is 10%. But if the building is a residential building, then the rate of depreciation is 5%. And if the building is a temporary structure, what does temporary structure means? If you have seen many of the times when a buildings are being constructed, there are small houses have been created for the laborers. Okay, so whatever these small houses has been created, so these small houses are known as temporary structure, and on that depreciation of 40% is allowed. I hope this is quite clear. And if the building is used for water supply or treatment of the water, then the building will get a depreciation of 40%. I hope this is quite clear to you all. So let's revise this again. If there is a building and if the building is a normal building for business use, then the rate of depreciation is 10%. But if the building is a residential building, then the rate of depreciation is 5%. If the building is a temporary structure, then the rate of depreciation is 40%. But if the building is used for water supply or for water treatment project, then the rate of depreciation is 40%. I hope this is quite clear to you all. So the second depreciable asset is furniture and fixture. If an asset is a furniture and fixture, then the rate of depreciation is 10%. You all might be wondering what does fixtures means. Fixtures can be simply understood as switchboards or electric bulbs. Okay, these are known as fixtures. I hope this is quite clear. So if the asset is a depreciable asset and such depreciable asset is a furniture and fixture, then the rate of depreciation is 10%. I hope this is quite clear. Then the third asset is motor vehicle. If a motor vehicle is there and if the motor vehicle is acquired for hiring business and such motor vehicle is acquired on or after 23rd August 2019 up to 1st April 2020, then the rate of depreciation is 45%. Otherwise, that means if the motor vehicle is acquired for the hiring business before 23rd August 2019, then the rate of depreciation is 30%. I hope this is quite clear to you all. Then, if a motor vehicle is there and the motor vehicle is acquired for non-hiring business on or after 23rd August 2019 to 1st April 2020, then the rate of depreciation is 30%. Otherwise, that means if the motor vehicle which is acquired for non-hiring business and it has been acquired before 23rd August 2019, then the rate of depreciation is 15%. I hope this is quite clear to you. Then the next depreciable asset is general plant and machinery and office equipment. Okay, then the rate of depreciation is 15%. I hope this is quite clear. Then the next asset is computer. Computer includes computer softwares and computer peripherals like printers, inverters, etc. I hope this is quite clear. Then all of this will be combinedly depreciated at the rate of 40%. I hope this is quite clear to you all. The next depreciable asset is a pollution control equipment. If an assessee is having a pollution control equipment, then the depreciation on such pollution control equipment is 40%. I hope this is quite clear. The next depreciable asset is an aeroplane. If an assessee is having an aeroplane, then the rate of depreciation is 40%. I hope this is quite clear. If the assessee has acquired books and periodicals, so basically these are also kind of asset, but these are depreciable asset. I hope this is quite clear. You all might be wondering how come a book can be a depreciable asset, but you all might not be aware that there are certain books who cost around lakhs of rupees. So this forms an asset. This forms a depreciable asset. Okay. So on these books and periodicals, the depreciation rate is 40% under the Income Tax Act. I hope this is quite clear to you all. The next depreciable asset is a windmill. If an assessee is having a windmill as a asset, then the depreciation on such windmill is 40%. I hope this is quite clear. If an assessee is having a depreciable asset and such depreciable asset is a life-saving medical machinery and equipment, then the rate of depreciation is 40%. I hope this is quite clear. If the assessee is having a ship and such ship is a depreciable asset, then the rate of depreciation is 20%. I hope this is quite clear. If the assessee is having an intangible asset, for example, computer software, but I told you computer software will be depreciated at the rate of 40%. I hope this is quite clear. Other than this computer software, okay, if there is any other intangible asset, then such intangible asset will be depreciated at the rate of 40%. I hope this is quite clear to you all. So basically, you all need to remember the rates of taxes. In this PGPP chapter, this is most important part. Depreciation is the most important part. You have to remember all the rates of taxes, and you need to understand one concept, that is block of asset. What does this block of asset means? So in order to understand what does this block of asset means, we need to go to a blank page. Okay. So let's come to a blank page. Over here, let's understand that there is this assessee Mr. X. Okay, Mr. X is a chartered accountant. We'll write simply CA over here. He's a CA. He has 10 articles. Okay, so articles need to work on a laptop. So this CA has 10 laptops also. So basically these laptops are computers only. Okay, and these computers are a depreciable asset. I hope this is quite clear to you all. So there's all 10 laptops will form a block of asset. I hope this is quite clear to you all. In income tax, the income tax says that this all 10 laptops will be considered in the block of asset, and this block of asset will be known as laptop block. Okay, and at the rate of depreciation, the rate of depreciation for computer was 40%. So this block of 10 laptops will be known as laptop block at the rate 40%. So understand this in this manner. If Mr. X, chartered accountant, buys two more laptops, okay, then these two more laptops will be again added in this block of the asset, that is laptops block at the rate 40%. I hope this is quite clear to you all. So in order to understand this example, we need to understand few things from the notes. So let's come to the notes first of all, and let's understand this part. Okay, then we will again continue in that blank page. Okay, so let's again revise it. Section 32 depreciation says that if a depreciation is been calculated as per the accounting standard, then it will be disallowed and it will be added back to the net profit. Okay, and the depreciation as per the Income Tax Act will be calculated and reduced from the income in order to calculate the net profit as per Income Tax Act. I hope this is quite clear to you all. So now let's understand the condition for charging depreciation as per the Income Tax Act. Okay, the assessee should be the owner of the depreciable asset. Okay, and such asset should be used in the business only, and it should be put to use. So what does this word put to use means? So in order to understand what does put to use means, we'll again come to a blank page. Understand this over here. Mr. X has purchased an AC, okay, on 1st May 2019 for rupees 50,000. I hope this is quite clear. This AC is a depreciable asset. Do you agree or not? So you need to agree that this asset is a depreciable asset. I hope this is quite clear. But the asset, that is an AC, was fitted on 6th May 2019. That is, in other words, put to use on 6th May 2019. I hope this is quite clear. So the put to use, we have to consider of the date when the actually asset was used by the assessee, and rather not the date on which the asset was purchased. But if the question is silent and the question says that Mr. X has purchased a particular asset and there is no detail about put to use, so we have to assume that the date on which the asset is purchased is only the date on which the asset is put to use. I hope this is quite clear. So what is this put to use and why is this so much important? We will understand it in 1 or 2 minutes. Okay, but I hope you all have understood the difference between the date of purchase and date of put to use. Okay, so now let's come back to the notes again. Okay, so over here, the condition says that the assessee should be the owner of the depreciable asset and such asset should be used in the business only. Okay, and it should be put to use. Why it should be put to use, that we will understand it over here. Okay, if the asset is put to use for less than 180 days, then the rate of depreciation will be 50%. Okay, what does this mean? Then the rate of depreciation at the rate 50%. So simply understand it over here. If a motor vehicle is put to use for less than 180 days, then the rate of depreciation will be 45% into 50%. I hope this is quite clear. That means 22.5%. I hope this is quite clear. So that is what this means. then rate of depreciation at the rate 50%. So let's revise this first point again. If the asset is put to use for less than 180 days, then the rate of depreciation into 50%. So I'll simply write it over here into 50% so that it will be simple to understand rather than at the rate. I hope this is quite clear to you all. So how to calculate whether the asset has been put to use for less than 180 days? So that's why a date has been quoted over here, that if an asset is put to use on 5th October or after 5th October, then such asset will be put to use for less than 180 days. So you don't need to calculate on your calci that how many days the asset was put to use. If you remember this two date, that is 5th October and 3rd October, then automatically you will realize that whether the asset was put to use for more than 180 days or for less than 180 days. I hope this is quite clear. So if the asset is put to use on 5th October or after 5th October, then the asset is put to use for less than 180 days, then the rate of depreciation into 50% will be the rate of depreciation of that asset. For example, this computer was put to use for less than 180 days, then the rate of depreciation will be 40% into 50%. I hope this is quite clear, which will be equal to 20% rate of depreciation. But if this computer was put to use for more than 180 days, then the rate of depreciation will be 40% into 100%, which will be equal to 40% depreciation only. I hope this is quite clear to you all. So that's why put to use is an important concept while calculating depreciation as per the Income Tax Act. I hope this is quite clear to you all. So we have understood this part. Let's understand this part. If the asset is put to use on 3rd October or before 3rd October, then it will be considered as the asset has been put to use for more than 180 days, then the rate of depreciation into 100% will be the rate of depreciation. I hope this is quite clear to you all. It sounds little complicated, but this is the only simplest way. Okay, so now let's revise this part. If the asset is put to use on 5th October or after 5th October, then such asset has been put to use for less than 180 days and the rate of depreciation will be calculated in this manner, the rate of depreciation of that particular asset into 50%. Okay, if the asset is put to use on or before 3rd October, okay, then it will be considered as asset is put to use for more than 180 days and the rate of depreciation of that asset will be calculated in this manner, rate of depreciation of that depreciable asset into 100%. I hope this is quite clear to you. So let's revise up to here. Section 32, y'all don't get irritated because this is a very important thing. I am revising it now and then because I want to sink this concept in your brain. I don't want you all to revise it again. Okay, once you are studying it from my video lecture, that is the last time you are studying it. Okay, so let's revise it. Section 32, depreciation. Depreciation as per accounting standard will be disallowed and it will be added back to the net profit, and depreciation as per the Income Tax Act will be calculated and be reduced from the income in order to calculate the net profit as per the Income Tax Act. I hope this is quite clear. Condition for calculating or for charging depreciation is assessee should be the owner of the depreciable asset which has been purchased, and such asset should be used in the business only and it should be put to use. Okay, such asset should be put to use. If the asset is put to use on or after 5th October, then the asset is put to use for less than 180 days and the rate of depreciation will be calculated in this manner, rate of depreciation into 50%. But if the asset is put to use on or before 3rd October, then the asset has been put to use for more than 180 days, then the rate of depreciation of that particular depreciable asset will be calculated in this manner, rate of depreciation into 100%. I hope this is quite clear to you all. Okay students, so now let's understand the format of calculation of depreciation. The depreciation as per the Income Tax Act will be calculated with the help of this format. Okay, so let's understand this format. There is particulars, there is block of asset 1, block of asset 2, there can be multiple block of asset. Because there is a possibility that the assessee may have a laptop, okay, may have a mobile phone, okay, may have a car. So this all depreciable asset will form a different blocks. I hope this is quite clear to you all. So let's understand the particulars. Opening WDV, if any, then we need to add the purchases made during the previous year 1920 relating to the depreciable asset, and if such depreciable asset has been put to use for less than 180 days, then we need to mention that particular asset which has been purchased and put to use for less than 180 days over here, and we need to mention the asset which has been put to use for more than 180 days which has been purchased in the previous year 1920 over here. Okay, and then further it will be reduced by the asset sold during the year, that is the previous year 2019-20, and whatever the amount will come over here will be the balance in the block before depreciation, and we will calculate the depreciation. For example, understand that there is an opening WDV, and the opening WDV of the block of the asset is say 10 lakhs. I hope this is quite clear to you all. So since this is on 1st April 2019, that means this opening WDV has been utilized, that means put to use for more than 180 days. So on this particular amount, the depreciation will be calculated at the rate 100%. I hope this is quite clear to you. But over here, when the asset which has been purchased during the previous year and put to use for less than 180 days, then the depreciation will be calculated and it will be further reduced by 50%. I hope this is quite clear to you all. Okay. So over here the asset which has been purchased, only for that we need to identify more than 180 days or less than 180 days, because the WDV is definitely more than 180 days. I hope this is quite clear to you all. So let's understand it with the help of an example. Okay, so come into our study material on illustration 1 on page number 4.195. Okay, so over here let's read it. What does this question is saying? Mr. X, a proprietor engaged in a manufacturing business, furnished the following particulars. Opening WDV of plant and machinery as on 1st April 2019 is 30 lakhs. That means it is more than 180 days. Okay. So on this, the rate of depreciation will be multiplied with 100%. I hope this is quite clear to you all. And the new machinery, that is the new plant and machinery purchased and put to use on 8th of June 2019. That is, it has been purchased before 3rd October 2019. That means this asset has been put to use for more than 180 days. I hope this is quite clear to you all. And one more new plant and machinery has been acquired and put to use on 15th December 2019. That is after 5th October 2019. That means this particular asset has been put to use for less than 180 days. I hope this is quite clear. And the next asset that has been acquired is a computer. So computer is a new block now. Earlier block was plant and machinery. Now the next block is computer. So the computer is acquired and installed in the office premises on 2nd January 2020. That means it has been put to use after 5th October 2019. I hope this is quite clear. That means this particular computer has been put to use for less than 180 days. Okay, and the value of the computer is 3 lakhs. So what the question is asking us to calculate? The question is asking us to compute the amount of depreciation and additional depreciation as per the Income Tax Act 1961 for the assessment year 2020-21, assuming that all the assets were purchased by way of account payee check. So what does this part means? We will understand after studying section 43B, okay, and rule 6DD. What is all this? You will understand after studying that particular section. So for time being, just be patient enough. Okay. So over here we have only learned by now how to calculate or how to compute the depreciation. We have not yet understood what does additional depreciation means. So for time being, we will ignore this part. We will calculate only up to here. Okay. Okay students, so now let's solve this question in our notes in the format. Okay, so over here first of all we will change this names. Block asset 1 we will change that and we will write it over here plant and machinery block, and over here we will write computer block. I hope this is quite clear, and with the help of this format we will learn how to calculate depreciation. We will mention over here opening WDV of plant and machinery block, which is 30 lakhs. Okay, the opening WDV for computer block is 0, so we'll put a dash, and then we will add the purchases detail of the plant and machinery block. So this first plant and machinery was purchased on 8th June 2019 and this was put to use for more than 180 days. I hope this is quite clear. So we will write this 20 lakhs over here more than 180 days. Okay, so we'll simply put over here 20 lakhs. I hope this is quite clear to you all. And this asset was put to use on 15 December 2019, that means for less than 180 days. So we'll put this 8 lakhs of value over here, okay, where less than 180 days are written. Okay, so we'll put that over here, 8 lakhs. I hope this is quite clear to you all. There is one more asset, that is computer, which has been acquired and installed in the office premises on 2nd January 2020. Okay, and such asset cost rupees is 3 lakh, and this asset is put to use for less than 180 days. So where 180 days, less than 180 days is written over there, we will mention this 3 lakhs. Okay, under computers block column. I hope this is quite clear. And we'll put a dash over here, and there are no details about the asset sold during the previous year, so we'll put a dash, and finally we will find out the balance in the block before depreciation. The balance in the block before the depreciation is 58 lakhs in case of plant and machineries block, and in case of computers block the balance is 3 lakhs. I hope this is quite clear. So now the important task starts, that is calculating depreciation. Okay, here there is written depreciation at the rate normal rate into 100% and depreciation at the rate normal rate into 50%. So by now you know what is this 50% and what is this 100%. Okay, the asset which has been put to use for less than 180 days, the depreciation will be calculated and it will be further multiplied with 50%. Then whatever amount will come, that will become the depreciation for that particular asset as per the Income Tax Act. I hope this is quite clear to you. But if the asset is put to use for more than 180 days, then whatever depreciation has been calculated, it will be multiplied with 100%, and that entire value will be allowed as depreciation as per the Income Tax Act. I hope this is quite clear to you. So let's calculate the depreciation. Okay, so firstly this 30 lakhs and this 20 lakhs will be combined together, and we will write it over here. Okay, 50 lakhs of this asset were put to use for more than 180 days. Okay, therefore the rate of depreciation of plant and machinery is 15%, as we have already studied in the rates of depreciation over here, that the general plant and machinery's depreciation is 15%. So we will multiply it with 15%, and further we will multiply this into 100%. I hope this is quite clear to you all. Okay, into 100%. Okay, which is equal to 50 lakhs into 15%, which is equal to 7 lakh 50,000. I hope this is quite clear. So the depreciation for this opening WDV and this new asset which was put to use for more than 180 days together is 7 lakh 50,000. I hope this is quite clear to you all. And the depreciation for this asset which was put to use for less than 180 days will be calculated in this manner: 8 lakhs into 15% into 50%, which is equal to 8 lakhs into 15% is equal to divided by 2. Okay, that is 50% only. So the depreciation comes to around 60,000. I hope this is quite clear to you all. So the depreciation for this asset which was put to use for less than 180 days is equal to 60,000. I hope this is quite clear. Since our question has also asked us to calculate additional depreciation, but we have not studied what does additional depreciation means, that's why we are ignoring it for time being. But we will not calculate the balance WDV at the end of the current year, because we will once understand this additional depreciation concept also, and then we will feed the details over here, and then finally we will calculate it over here. I hope this is quite clear to us. The primary crux of the explanation over here was to calculate this depreciation amount. So basically this depreciation will be taken into the computation of the net profit as per Income Tax Act. I hope this is quite clear. Whatever depreciation has been charged as per the accounting standard will be added back, and then this depreciation will be reduced from that. I hope this is quite clear to you all. So now let's calculate the depreciation for this computers block. I hope this is quite clear to you all. So let's calculate it over here. 3 lakhs into the rate of depreciation of the computer is 40%, as we have studied in the rates of depreciation chart, that is over here. Computer, including computer software and computer peripherals like printers and inverters, the rate of depreciation is 40%. Okay, so over here the rate of depreciation is 40%, and since this asset was put to use for less than 180 days, this entire depreciation will be further reduced by 50%. I hope this is quite clear to all. And finally, we will calculate the depreciation amount. 3 lakhs into 40% into 50% divided by 100 is equal to 60,000. I hope this is quite clear to you all. Okay, so over here we will put 60,000. So this is the depreciation for the computer which has been put to use for less than 180 days. I hope this is quite clear to you all. I hope you all have understood how to calculate depreciation as per the Income Tax Act. So you have to specifically remember the rates of depreciation, okay, in order to calculate the depreciation as per Income Tax Act. Okay, I hope this is quite clear to you all, and you need to remember this part. You need to understand that the asset should put to use, and such asset should be put to use for more than 180 days in order to take 100% depreciation. But if the asset is put to use for less than 180 days, then the depreciation will be only 50%. I hope this is quite clear to you all. Okay, so I hope you all have understood this much part. Okay, so let's move ahead and let's understand first of all this additional depreciation. Okay, and then we will understand this block of asset chart. Okay, additional depreciation is given under section 32 subsection 1 subsection 2a. Okay, let's read this particulars entirely and then we will understand what does it means. Okay, if the following condition is satisfied, then assessee is eligible for additional depreciation applicable only in the first year of acquisition. The conditions are: assessee should be involved in the manufacturing business, including printing and publication, or generation and distribution of power or transmission of power. Okay, and such additional depreciation will be allowed only for new plant and machinery. Following plant and machinery is not eligible for additional depreciation. That is, UDOSRG is the acronym to remember which all asset is not eligible for additional depreciation. UDOSRG's U stands for used asset, depreciated asset 100%, office equipment, plant and machinery, ships, scientific research, plant and machinery, aircraft, road transport vehicle, residential premises, plant and machinery, guest house, plant and machinery. Note: if manufacturing unit set up in the backward notified areas of Telangana, West Bengal, Bihar, Andhra Pradesh during 1st April 2015 to 31st March 2020, then the rate of depreciation is 35%. That is, the additional rate of depreciation is 35% and the normal rate of additional depreciation is 20%. Okay, if asset put to use for less than 180 days, then the rate of depreciation will be divided by 2. That means this rates will be divided by 2. I hope that is quite clear. That is, in simple words, into 50% only. I hope this is quite clear. And remaining half depreciation to be claimed in the next year if power generation or distributor opts for SLM method of depreciation. It cannot opt for additional depreciation. So by simple reading of this, you might have not understood what this additional depreciation means, but don't worry, let's come to a blank page. Over here we will understand it. Okay, so understand this in this manner. Mr. X has a manufacturing business in West Bengal. Okay, and Mr. X has purchased a machinery of rupees 10 lakhs on 1st of May 2019, and there is no detail about put to use, so we will assume that this is only the date of put to use. I hope this is quite clear to you. And again, he has purchased a machinery of rupees 20 lakhs on 6th of October 2019, and this is only the date of put to use. I hope this is quite clear, and we need to calculate the depreciation now. Okay, so over here we will understand two things, that is our normal depreciation, that is depreciation under section 32, and additional depreciation given under section 32 subsection 1 subsection 2a. I hope this is quite clear to you all. So let's understand it over here. Opening WDV. So there is any detail about opening WDV? There is no detail. Okay. Then we will add purchases. Okay. So there are asset purchase. There are two asset purchase. One asset is purchased on 1st May 2019. That means the asset was put to use for more than 180 days. Okay. So we will write over here more than 180 days. Okay. And the value of the asset is rupees 10 lakhs. I hope this is quite clear to you all. And one more asset has been purchased on 6th of October 2019. So which is less than 180 days. So we will write over here less than 180 days. Okay. So the amount of the asset is 20 lakhs. I hope this is quite clear. And there are no details about sale of asset. I hope this is quite clear. So we will put a dash, and finally our WDV before depreciation will be equal to 30 lakhs, and now we will calculate the depreciation. Since you know that the plant and machinery is eligible to take a depreciation under the Income Tax Act under section 32, so we can take it. Okay, and the rate of depreciation for machinery is 15%. Okay, but if the asset is put to use for more than 180 days, then the rate of depreciation is 15% for plant and machinery. But if the asset is been put to use for less than 180 days, then the rate of depreciation for this plant and machinery is 15% into 50%, which is equal to 7.5%. I hope this is quite clear to you all. But the important concept that we want to study right now is additional depreciation. So let's come back to the notes. What does the note say is that if the following condition is satisfied, then the assessee is eligible for claiming additional depreciation, and such additional depreciation is applicable only in the first year of acquisition. So basically, in our example over here, the assessee has purchased the asset in the previous year 2019-20. Additional depreciation will be allowed in the previous year 2019-20 only. I hope this is quite clear to you all. So that is what is given over here. Okay. And the conditions are as follow. The first condition says that assessee should involve in manufacturing business. Over here in the example, Mr. X is having a manufacturing business. So this first condition is satisfied. And this manufacturing business includes printing and distribution business, or generation and distribution of power, or transmission of power is also considered as manufacturing only. I hope this is quite clear. And the depreciation is allowed only for new plant and machinery. Over here in this example, this machinery are new machinery only. So basically these two conditions have been satisfied. Okay. And following plant and machinery is not eligible for additional depreciation. That means these are the plant and machinery on which the additional depreciation will not be allowed. I hope this is quite clear. And what all are such plant and machinery? Let's understand that. Udosurgy stands for used asset, depreciable asset up to 100%, office equipment or plant and machinery, ships, scientific research, plant and machinery, aircraft, road transport vehicle, residential premises plant and machinery, and guest house plant and machinery. If this all are the plant and machinery, then on such plant and machinery no additional depreciation will be allowed. Okay. And if the manufacturing unit is set up in the backward notified areas of Telangana, West Bengal, Bihar, Andhra Pradesh during 1st April 2015 to 31st March 2020, then the rate of additional depreciation is 35%. Otherwise, that means other than this four states, the rate of depreciation, that is the additional depreciation, will be 20%. I hope this is quite clear. So come into our blank page over here where I am explaining this example. So our additional depreciation rate will be 35%. Why? Because the manufacturing unit, that is the manufacturing business, is in West Bengal. Assuming that this manufacturing business was set up between 1st April 2015 to 31st March 2020. I hope this is quite clear. So this 35% of additional depreciation will be allowed to this assessee, that is Mr. X. I hope this is quite clear. So now let's see how to calculate the amount of depreciation. So we will reduce over here depreciation. Okay. And we will write first depreciation as per section 32. Okay. And first asset put to use for less than 180 days. So the depreciation on this will be as follows. So the asset which was put to use for less than 180 days is of amount 20 lakhs. So on this 20 lakhs into 15%, and this entire 50% will be the depreciation amount. So let's calculate it over here. 20 lakhs into 15% into 50%, 50 divided by 100, which is equal to 1,50,000 is the amount of our depreciation on this asset which was put to use for less than 180 days. I hope this is quite clear to you all. Okay, and the depreciation on the asset which was put to use for more than 180 days, it will be calculated in this manner: 10 lakhs into 15%, okay, which is equal to 1,50,000 into 100%, okay, which is equal to 1,50,000 only. I hope this is quite clear. And this was our normal depreciation as per section 32, but there is an additional depreciation, that is an additional benefit given to the assessee if that assessee is engaged in a manufacturing business, okay. And if he is engaging his manufacturing business in the notified backward areas of West Bengal, Telangana, okay, or Bihar or Andhra Pradesh, then the additional depreciation rate is 35%, irrespective of this rates of depreciation given by the Income Tax Act. Okay, additional depreciation rate is given in this section only, that is section 32 subsection 1 subsection 2a, that is 35% or 20%. Okay, if the manufacturing unit is in this 4 state, then the additional depreciation rate is 35% irrespective of the asset. Irrespective of the asset means plant and machinery only. Okay, and if the asset is in the state other than this 4 state, then the rate of additional depreciation is 20% on the plant and machinery only. I hope this is quite clear to you all. So let's come back to our this example. Okay, and now let's calculate additional depreciation. Okay, additional depreciation at the rate as per section 32 subsection 1 subsection 2a. Okay, so let's calculate it. Asset put to use for less than 180 days. Okay, so which was the asset? This was the asset, that is 20 lakhs asset was put to use for less than 180 days. So on this 20 lakh, 35% depreciation will be calculated, and it will be further reduced by 50%. Okay, so which is equal to 3,50,000. So the additional depreciation is equal to 3,50,000. I hope this is quite clear to you all. And the additional depreciation on the asset which was put to use for more than 180 days will be equal to 10 lakhs into straight 35% into 100%, so which will be equal to 3,50,000 only. I hope this is quite clear. I hope you all have understood how additional depreciation concept work. Okay, so over here we have already solved one illustration and we have solved up till here only. So now let's come back to our study material. And what does our study material says? Our study material says that we have to calculate depreciation as well as additional depreciation. I hope this is quite clear to you all. So now let's come back to our notes and let's calculate the additional depreciation. I'll erase all this so that we can calculate the additional depreciation. Okay, before calculating the additional depreciation, we will revise the section. So let's revise this section, that is section 32 subsection 1 subsection 2a, additional depreciation. If the following condition is satisfied, then the assessee is eligible for additional depreciation applicable only in the first year of acquisition. I hope this is quite clear. And the assessee should be involved in the manufacturing business, and such manufacturing business includes the business of printing or printing and publication or generation and distribution of power or transmission of power. I hope this is quite clear. And such asset is new plant and machinery only. I hope this is quite clear. So in our illustration number 1 over here, there are two plant and machinery, and this plant and machinery are new plant and machinery. So basically this computer is not a plant and machinery. So on this no additional depreciation will be calculated. I hope this is quite clear. Only additional depreciation will be calculated on this new purchase plant and machinery because Mr. X is engaged in a manufacturing business. I hope this is quite clear. So let's come to our notes. Okay, so only this two which were purchased in the previous year 2019-20, on this only additional depreciation will be calculated. Okay, so let's calculate. And one more thing I forgot to check in the question was whether this assessee, that is Mr. X, is engaging his manufacturing business in the backward notified areas or what. So the answer is no. Since the question has not specified that the assessee was engaged in the manufacturing business in the backward area, so we will consider it as it is not engaged in the backward area. So the additional depreciation rate will be 20% only. I hope this is quite clear to you all. So let's calculate it over here. On this asset which was put to use for less than 180 days, the amount, that is the cost of the asset, is 8 lakhs. On this 20% additional depreciation will be calculated, and further it will be multiplied by 50%, and whatever the amount will come will be equal to the additional depreciation, which is equal to 80,000. Okay, and the asset which was put to use for more than 180 days, that was 20 lakhs. Okay, on this additional depreciation will be calculated. So let's calculate that. 20 lakhs into 20%, which is equal to 4 lakhs. So on this asset which was purchased and put to use for more than 180 days, the assessee has got an additional depreciation of 4 lakhs. I hope this is quite clear. I hope you all are getting a whole view about this section 32 as well as section 32 subsection 1 subsection 2a, because this is kind of a critical section. You need to understand it with the help of an example. After that, things will get little easy. So once we will revise the entire section 32 as well as section 32 subsection 1 subsection 2a, after that you will be capable enough to solve the question from the study material on your own also. Okay, so over here let's finish the remaining part also. The balance WDV at the end of the current year, let's calculate that. 58 lakhs minus 7,50,000 minus 60,000 minus 80,000 minus 4 lakh is equal to 45 lakhs 10,000. I hope this is quite clear to you all. And balance WDV at the end of the current year for this computer block is equal to 2,40,000. I hope this is quite clear to you all. Okay, so we have solved one illustration from the study material, as well as we have understood the section 32, that is depreciation, as well as section 32 subsection 1 subsection 2a additional depreciation. Now we will revise it and we will get more understanding about this. I hope this is quite clear. So let's start it from here. Section 32 depreciation. Depreciation as per accounting standard will be disallowed and added back to the net profit, and depreciation as per the Income Tax Act will be calculated and reduced from the income in order to calculate the net profit for Income Tax Act. I hope this is quite clear. Condition for charging depreciation is assessee should be the owner of the asset, and such asset should be used in the business and it should be put to use in the business. If the asset is put to use on or after 5th October, then such asset is put to use for less than 180 days. Then how to calculate the rate of depreciation? The rate of depreciation will be calculated in this manner. Rate of depreciation of that particular asset into 50%. Okay, into 50%. And if the asset is put to use on or before 3rd October, then such asset is put to use for more than 180 days. Then how to calculate the rate of depreciation for that asset? The rate of depreciation will be calculated in this manner. The rate of depreciation of that particular asset into 100%. I hope this is quite clear to you all. Okay, now let's come to this section, that is section 32 subsection 1 subsection 2a additional depreciation. If the following condition is satisfied, then assessee is eligible for additional depreciation, and such additional depreciation is applicable only in the first year of acquisition. And the conditions are as follows. The first condition says that assessee should involve in the manufacturing business only, and the manufacturing business includes printing or printing and publication or generation and distribution of power or transmission of power. Okay, and the additional depreciation will be allowed only if a new plant and machinery has been purchased by the assessee for such manufacturing business. Okay, and plant and machinery does not include following, that is UDO surgery. U stands for used asset, D stands for depreciable asset 100%, O stands for office equipment, plant and machinery, S stands for ships, S stands for scientific research plant and machinery, A stands for aircraft, R stands for road transport vehicle, R2 stands for residential premises plant and machinery, and G stands for guest house plant and machinery. So if this all are the plant and machinery purchased by the assessee for the manufacturing business, then on such asset no additional depreciation will be allowed. I hope this is quite clear. And if the manufacturing unit is set up in the backward notified areas of Telangana, West Bengal, Bihar, Andhra Pradesh during 1st April 2015 to 31st March 2020, then the rate of depreciation is 35%, and the normal rate of depreciation, that means other than these 4 states, if the assessee has set up his manufacturing unit, then the rate of depreciation, that is the additional depreciation, is 20% on the plant and machinery. I hope this is quite clear. If the asset is put to use for less than 180 days, then the rate of depreciation will be divided by 2. That means it will be multiplied by 50%. I hope this is quite clear to you all. Remaining half depreciation, that is the half additional depreciation, to be claimed in the next year. So this part we have not studied yet. So I'll explain you how to interpret and how to apply this part. Okay. So come into our solution. Over here, as you can see that we have done a mistake over here, that we have mentioned this figures upside down. That means this 4 lakhs was for this asset, that is the asset which was put to use for more than 180 days. Okay, and over here the formula also says that depreciation at the rate additional depreciation, it is not further divided by 2. Okay, so that means this particular asset was put for more than 180 days and this asset was put for less than 180 days. So this part over here says that if the asset is put to use for less than 180 days, then the remaining half additional depreciation will be claimed in the next year. So what does this mean? Over here we have only taken 50% of the additional depreciation. The original additional depreciation on this asset which was put to use for less than 180 days was equal to 1,60,000. But since it was put to use for less than 180 days, only up to 80,000 was allowed in the assessment year 2020-21. Okay, that means the remaining 80,000 was not allowed in the assessment year 2020-21. So section 31 subsection 1 subsection 2a says that if such is the case, that means if the asset is put to use for less than 180 days, then the remaining half depreciation can be claimed in the next assessment year. The remaining 80,000 additional depreciation, that is AD, will be allowed in the assessment year 2021-22. I hope this is quite clear to you all. Okay students, so we have already completed section number 32, that is depreciation, and also we have seen the rates of depreciation. Along with the rates of depreciation, we have also studied this section, that is section 32 subsection 1 subsection 2a, that is additional depreciation. I hope this is quite clear. In order to understand these 2 sections more in detail, I have made one question and we will solve that one question in a format book. So come into your format book. Okay, this is the format book. Come on page number 3. Over there you can see questions. Okay, there is a question related to section 32 subsection 1 subsection 2a. Okay, so let's read this question, and there is a format also for calculating depreciation for the previous year 2019-20, that is our assessment year 2020-21. Okay, so we will calculate that over here only. I hope this is quite clear to you all. So now let's read this question. What does this question says? Mr. Shyam is engaged in the business of printing and distribution, and such business is set up in the Andhra Pradesh. Okay, so basically after reading this much, we can realize that Mr. Shyam is engaged in the business of printing and distribution. That means this printing and distribution is also known as manufacturing activity. Okay, and the business is set up in Andhra Pradesh. So Andhra Pradesh is basically notified as backward area. I hope this is quite clear to you all, as we have already studied this part over here in this section, that is section 32 subsection 1 subsection 2a. What does this section says? If the following condition is satisfied, then SSC is eligible for additional depreciation, and such depreciation, that is additional depreciation, is applicable only in the first year of acquisition of new plant and machinery. The conditions are: assessee should be involved in manufacturing business, and manufacturing business includes printing or printing and publications, or generation and distribution of power or transmission of power. So we will just modify one thing over here. Printing and publication we will write, rather distribution. Okay. printing and publication, so that when you revise it, it will not create a confusion that publication and distributions are two different things. That's why I've changed it to publication. I hope this is quite clear. And second condition says that it is allowed, that is additional depreciation is allowed only for new plant and machinery. I hope this is quite clear. And if the manufacturing unit is set up in the backward notified areas of Telangana, West Bengal, Bihar, Andhra Pradesh during 1st April 2015 to 31st March 2020, then the rate of additional depreciation is 35%. Otherwise, normal rate of depreciation is 20%. I hope this is quite clear. So over here in this question, the additional depreciation rate will be 35% because the manufacturing unit, that is the printing and publication unit, is set up in the backward notified areas of Andhra Pradesh, assuming it has been set up between 1st April 2015 to 31st March 2020. I hope this is quite clear to you all. And there are details about purchase of new asset. Okay, so let's read that. Purchase of new plant and machinery during the previous year 2018-19. This is previous year 2018-19 and not 2019-20. I hope this is quite clear to you all. Purchase of new plant and machinery during previous year 2018-19 on 7th December 2018 for rupees 5 lakh. So a machinery was purchased in a previous year 18-19 on 7th December 2018 for rupees 5 lakh. So you can already relate it that over here in this section we have studied this part. Okay, remaining half depreciation to be claimed in the next year. Okay, if you remember this part, you can automatically understand why I have given this particular detail of this new asset. So let me make you all understand why I have given. So basically this asset has been purchased in the year 2018-19, okay, and this asset was put to use for less than 180 days, okay, so that means only half of additional depreciation will be allowed in the previous year 2018-19. I hope this is quite clear. And half will be allowed as additional depreciation in the previous year, that is the next previous year, that is 2019-20. I hope this is quite clear. So on this 5 lakh we have to calculate half additional depreciation, okay, for the previous year 2019-20. I hope this concept over here is 100% clear now, that is remaining half depreciation to be claimed in the next year. I hope this is quite clear to you. So let's come back to the format book again. I hope you all have understood this first part. Okay, so now let's move on to the second purchase. Purchase of new plant and machinery during the previous year 1920 on 1st June 2019. That means this asset is purchased on 1st June 2019. Assuming that put to use is also on 1st June 2019. Then it is before 3rd October. That means the asset is put to use for more than 180 days. I hope this is quite clear. So on this, that is the value of the asset, on this rupees 10 lakh, additional depreciation of 35% will be allowed. I hope this is quite clear. And the next asset that is purchased is new plant and machinery during the previous year 2019-20 on 1st October 2019 but put to use on 10th October 2019. Since put to use is after 5th October 2019, it is ascertainable that the asset is put to use for less than 180 days. I hope this is quite clear. So on this 15 lakh, additional depreciation will be allowed, that is half additional depreciation will be allowed. That means 35% into 50%, which will be equal to 17.5%. So 17.5% of additional depreciation will be calculated on this 15 lakh. I hope this is quite clear to you all. And the normal depreciation rate of plant and machinery is 15%. I hope this is quite clear to you all. So during the previous year 2019-20, only additional depreciation of the previous year 18-19 will be considered. I hope this is quite clear. So this new purchases of the previous year 1920s depreciation, that is the normal depreciation under section 32, will be calculated. Okay, so since this first asset which has been purchased in the previous year 1920, it has been put to use for more than 180 days, then full depreciation, that is 15%, will be allowed on this 10 lakhs. I hope this is quite clear to you all. And on the next purchase of plant and machinery during the previous year 1920, which has been put to use for less than 180 days, the depreciation will be allowed is equal to 15% into 50%, which is equal to 7.5% of depreciation will be allowed on this 15 lakhs. I hope this is quite clear to you all. Okay. And then last purchase made in the previous year 1920 is as follows. Purchase of a road transport vehicle during previous year 1920 on 10th September 2019. Assuming that this is only the date of put to use. So 10th September is before 3rd October. I hope this is quite clear. Therefore, the asset is been put to use for more than 180 days. I hope this is quite clear. And since it is a road transport vehicle and not a plant and machinery, no additional depreciation will be allowed. How come I am saying this? Because we have studied over here that following plant and machinery is not eligible for additional depreciation, that is kudo surgery. U stands for used asset, D stands for depreciable asset 100%, O stands for office equipment plant and machinery, S1 stands for ship, S2 stands for scientific research plant and machinery, A stands for aircraft, R stands for road transport vehicle. So this road transport vehicle is not a plant and machinery, and on this no additional depreciation will be allowed. I hope this is quite clear. And the remaining asset on which additional depreciation will not be allowed is residential premises plant and machinery, guest house plant and machinery. I hope this is quite clear. So on this asset no additional depreciation will be allowed, but depreciation under section 32 will be allowed. I hope this is quite clear. So this is a road transport vehicle. Okay, basically it is a motor vehicle and it is being used for non-hiring business. What does non-hiring business means? Hiring business, firstly we need to understand what does hiring business means. Hiring business means the motor vehicle is given on rent, okay, for use. I hope this is quite clear. So this particular road transport vehicle is being taken, that is purchased for own consumption, okay, that is for non-hiring business. I hope this is quite clear to you all, okay. And it is been purchased after 23rd August 2019. That means the rate of depreciation, that is the normal rate of depreciation that an assessee Mr. Sham can claim is 30%. I hope this is quite clear. So let's come into our notes. Over here rate of depreciation is given, over here motor vehicle is given, and there are two parts, A part and B part. In B part there is given about non-hiring business, okay. So if a motor vehicle, if acquired for non-hiring business and it is acquired on or after 23rd August 2019 to 1st April 2020, that means at 10th September falls between this range. I hope this is quite clear. Therefore 30% depreciation will be allowed on such motor vehicle, that is a road transport vehicle. I hope this is quite clear to you all. And one more detail is given in the question is opening WDV of plant and machinery block is rupees 20 lakh. So this road transport vehicle is the new asset purchased. I hope this is quite clear to you all. Earlier there was no road transport vehicle with the assessee, that is Mr. Sham. I hope this is quite clear to you. And the question is asking us to calculate depreciation and additional depreciation for the assessment year 2020-21, as well as it is asking us to calculate deduction under section 32 AD. What is this section? We have not studied it yet, but don't worry, we will study that section and we will come back over here. For time being, we will solve only up to this part, okay, that is calculate depreciation under section 32 and additional depreciation under section 32 subsection 1 subsection 2a. I hope this is quite clear to us. So we will use this format, okay. Over here we will write the name of our assessee. The name of our assessee is Sham, okay. Is the business unit set up in a notified backward area? So yes, it is set up in Andhra Pradesh, AP, okay. Rate of depreciation for this plant and machinery is 15%, and for motor vehicle MV is 30%, okay. And additional depreciation rate of depreciation is 35% only for plant and machinery, not for this motor vehicle. I hope this is quite clear to you all, okay. So we will change the names over here, okay. We will write plant and machinery block, motor vehicle block. We need to mention the opening WDV of the asset. The opening WDV of the plant and machinery block is 20 lakhs. So we will mention that over here. We will change the color, 20 lakhs, okay. And the opening WDV of motor vehicle block is 0. So we will put a dash, okay. And then we will mention the details of purchase of assets. Okay, so first is asset purchase and put to use for more than 180 days. So let's come into the question over here. So only this asset, so only so this plant and machinery is the only plant and machinery which has been purchased and put to use before 3rd October 2019. That means for a period of more than 180 days. I hope this is quite clear. And the value of the asset is 10 lakhs. So we will mention this value of 10 lakhs over here. 10 lakhs. I hope this is quite clear. Then we will mention the value of the asset purchased and put to use for less than 180 days for this plant and machinery block. So let's come into the question. This particular asset, that is purchase of new plant and machinery during the previous year 1920 on 1st October 2019 but put to use on 10th October 2019. So it has been put to use after 5th October 2019. That means it has been put to use for less than 180 days. And the cost of this asset, that is new plant and machinery, is 15 lakhs. So we will mention this value over here, 15 lakhs. I hope this is quite clear. And there are no details given about the sale of the asset. So we will put a dash. And WDV before depreciation of plant and machinery block is 20 plus 10, that is 30, 30 plus 50, that comes to around 45 lakh. I hope this is quite clear to you all. Okay, now we will see about this motor vehicle block. Okay, over here in the question, it has been given that a motor vehicle, that is road transport vehicle, has been purchased during the previous year 1920 on 10th September 2019. That is before 3rd October 2019. I hope this is quite clear to you all. And the value of this motor vehicle is 12 lakhs. So we will mention it over here, 12 lakhs, that is asset purchased and put to use for more than 180 days. I hope this is quite clear. And there are no details about the asset purchase and put to use for less than 180 days for this motor vehicle block. So we will put a dash over here. And there are no detail about the sale of asset for this motor vehicle block. So we will put a dash over here. And WDV before depreciation for this motor vehicle block is 12 lakhs. I hope this is quite clear to you all. So let's calculate the depreciation as per section 32 first, and then we will move on to the additional depreciation as per section 32 subsection 1 subsection 2a. I hope this is quite clear to you all. So asset put to use for more than 180 days. Okay, so which is the asset put to use for more than 180 days? So this is the asset which are put to use for more than 180 days. So the amount is equal to 30 lakhs into 15%. I hope this is quite clear to you all. So let's calculate the normal depreciation under section 32. Okay, so 20 lakhs plus 10 lakhs is equal to 30 lakhs into 15% is equal to 4 lakh 50,000. I hope this is quite clear to you all. Okay, and for the asset which has been put to use for less than 180 days, the cost of the asset is 15 lakhs. Depreciation will be calculated as per this manner. So let's calculate it over here. 15 lakhs into 15% into 50%, which is equal to 1,12,500. I hope this is quite clear to you all. Okay, so similarly we will calculate the normal depreciation as per section 32 for this motor vehicle block. I hope this is quite clear to you all. So this motor vehicle was purchased and put to use for more than 180 days, and the value of the motor vehicle is 12 lakhs. So on this 12 lakhs full depreciation will be allowed. Okay, and the value and the rate of depreciation on this motor vehicle is 30%. So let's calculate it. 12 lakhs into 30% is equal to 3,60,000. I hope this is quite clear to you all. Okay, and there are no details about the asset put to use for less than 180 days for this motor vehicle block. So we will put a dash over here. So we have calculated normal depreciation, that is depreciation under section 32 for this plant and machinery block as well as for this motor vehicle block. I hope this is quite clear to you all. So now we will calculate additional depreciation as per section 32 subsection 1 subsection 2a. Okay, so asset put to use for more than 180 days. Okay, so this asset was put to use for more than 180 days and additional depreciation rate is 35% because the manufacturing unit is been set up at a notified backward areas of Andhra Pradesh. I hope this is quite clear to you all. So on this 10 lakhs we will calculate additional depreciation 10 lakhs into 35%, which is equal to 3,50,000. I hope this is quite clear to you all. So we will mention it over here, 3,50,000. And why I have not taken this 20 lakhs and this 10 lakhs together for calculating additional depreciation? Because only additional depreciation is available on the asset when it is purchased in the first year. So if you have properly read our particulars given under section 32 subsection 1 subsection 2a, over here I have specifically mentioned applicable only in the first year of acquisition. So this asset which is there in the opening WDV, it has been purchased in the earlier year. This is not the first year of acquisition. These are the assets which have been firstly acquired in the previous year 2019-20. I hope this is quite clear. That's why only 10 lakh has been taken. I hope this is quite clear to you all. Now we will calculate additional depreciation for the asset which has been put to use for less than 180 days. So the asset is of 15 lakhs. So let's calculate 15 lakhs into 35%, which is equal to 5,25,000 into 50%, which is equal to 2,62,500. I hope this is quite clear to you all. So additional depreciation for this asset which has been newly purchased in the previous year 2019-20 is calculated over here. I hope this is quite clear to you all. Okay. And since this motor vehicle is not a plant and machinery and it does not satisfy the condition given under section 32 subsection 1 subsection 2a, therefore the additional depreciation will not be available on this asset. I hope this is quite clear. So we will put a dash over here. I hope you all are understanding it right now. And the last thing over here is less additional depreciation of the previous year 18-19 for the asset which was put to use for less than 180 days but can be taken only in the previous year. So let's come into our question over here. Okay, our question specifies that a asset that is a new plant and machinery was purchased in the previous year 18-19 on 7th December, that is after 5th October 2019, and this asset was put to use for less than 180 days and the value of the asset is 5 lakh. So on this 5 lakh of the asset, the additional depreciation will be calculated at the rate 35% into 50%, and this remaining 50% will be allowed in the previous year 2019-20. I hope this is quite clear. Why I am saying it so? Because it is given over here in this section that if asset is put to use for less than 180 days in the first year of acquisition, then only half of the depreciation will be allowed in that particular first year of acquisition, and half of the depreciation, that is remaining half depreciation, to be claimed in the next previous year, that is previous year 2019-20. I hope this is quite clear to you all. So we are claiming that only over here in this part. Okay, so the value of the asset which was purchased in the previous year 2018-19 was 5 lakh. On this, additional depreciation will be calculated at the rate 35%, which is equal to 1,75,000 into 50% will be allowed only in the previous year 19-20, and the remaining 50% was already allowed in the previous year 18-19. I hope this is quite clear to you. So we will mention this amount over here, 87,500. I hope this is quite clear to you. So a total amount of depreciation that our assessee Mr. Sham will claim, okay, in computation of net profit from business is this all, okay, and this also. So let's total it off to calculate the depreciation that the assessee will claim. 4,50,000 plus 1,12,500 plus 3,50,000 plus 2,62,500 plus 87,500 plus 3,60,000. Okay, so the total depreciation that Mr. Shyam will claim is equal to rupees 16,22,500. I hope this is quite clear to you all. And if the assessee, that is Mr. Shyam, has calculated net profit as per accounting standard, then whatever the depreciation as per accounting standard was calculated will be added back, okay, will be added back to net profit, and further whatever the amount will come, it will be further reduced by this depreciation as per the Income Tax Act. I hope this is quite clear. I hope you all have understood this entire flow of section 32 as well as the rates of depreciation as well as the flow of section 32 subsection 1 subsection 2a. I hope this is quite clear to you all. And now we will calculate the closing WDV of the asset for the previous year 2019-20. Okay, so let's calculate that. 45 lakhs minus 4,50,000 minus 1,12,500 minus 3,50,000 minus 2,62,500 minus 87,500, which is equal to 32,37,500. I hope this is quite clear. And in case of a motor vehicle block, the closing WDV for the motor vehicle block for the previous year 2018-19 will be equal to 12 lakhs minus 3,60,000. I hope this is quite clear to you all. And finally, the WDV is equal to 8,40,000. I hope you all have understood the flow of calculating depreciation as per the Income Tax Act. Okay, so let me erase this. I hope this is quite clear to you all. If you want to copy this solution, you can copy this solution because the format that you will receive is a blank format. Okay. Please pause the video and copy this much if you want to copy. I hope you all have copied it. Okay. So now let's move on to this part. Okay. Calculate deduction under section 32 AD. So we will understand first of all this section and then we will calculate. This is very easy section. Don't worry, it will take hardly 2 to 3 minutes to understand this particular section. Okay, so now let's come into our notes. Okay. Over here section 32 AD is given investment based deduction. Okay. What does this section 32 says? If the assessee has set up a new manufacturing business, okay, if the assessee has set up a new manufacturing business between 1st April 2015 to 31st March 2020 in the notified states of Andhra Pradesh, Telangana, West Bengal, Bihar. Similarly, these are the states that have been given under section 32, subsection 1, subsection 2a. I hope this is quite clear to you. So you all don't need to remember this specifically because we are any which ways remembering this 4 states for the section 32, subsection 1, subsection 2a. I hope this is quite clear to you all. Then the assessee is eligible for deduction of 15% of the cost of plant and machinery only during the first year of acquisition of such plant. I hope this is quite clear to you all. And then the assessee is eligible for the deduction, that is 15% of the cost of the plant and machinery only during the first year of the acquisition of such asset, that is plant and machinery only. And plant and machinery does not include Udo Surgery. We have already studied this Udo Surgery under section 32, subsection 1, subsection 2a. I hope this is quite clear. But it includes forklift truck. That means plant and machinery includes forklift truck. Okay. It does not include Udo Surgery. Okay. So let's revise up to here again. If the assessee has set up a new manufacturing business between 1st April 2015 to 31st March 2020 in notified state of Andhra Pradesh, Telangana, West Bengal, Bihar, then the assessee is eligible for deduction. How much deduction? 15% of the cost of plant and machinery only during the first year of acquisition of such asset, that is the plant and machinery only. And plant and machinery does not include Udo Surgery, but this plant and machinery includes forklift truck. I hope this is quite clear to you all. If such asset is transferred by way of amalgamation, demerger, then no problem. But if such asset is transferred within 5 years, then the benefit given earlier will be added back. So what does this mean? First of all, we will understand this much only. What does this part wants to say? If such asset, that means this plant and machinery, okay, which has been purchased within this time frame in this notified stage, okay, and a deduction has been claimed on such plant and machinery, and such plant and machinery has been transferred, that means sold or exchanged. Okay, I hope you all have understood what this transfer means in this chapter known as income from capital gain. So I don't need to repeat what this transfer means. Okay, if such asset is transferred within 5 years, then the benefit earlier given will be added back. That means how much benefit was given? 15% of benefit was given in the first year. So whatever is the benefit given, that is the 15% on this plant and machinery's cost, will be added back in the year when such asset has been transferred, if the asset has been transferred within 5 years. I hope this is quite clear. Within 5 years means within 5 years from the date of purchase of such plant and machinery. I hope this is quite clear to you all. There is no condition of 180 days. That means there is no condition of put to use of more than 180 days or less than 180 days. Okay, entire 15% of deduction will be allowed straight forward. Okay, if the assessee has purchased a new plant and machinery in the manufacturing business which has been set up in the notified areas of Andhra Pradesh, Telangana, West Bengal, Bihar between the period of 1st April 2015 to 31st March 2020. I hope this is quite clear to you all. So let's revise this section once again. Okay, Section 32 AD says that investment based deduction is allowed under Income Tax Act. Okay, so how the deduction will be allowed? The deduction will be allowed in this manner. If the assessee has set up a new manufacturing business, okay, over here a new manufacturing business has been set up. So over here it does not include printing and publications as well as it does not include generation, transmission and distribution of electricity. I hope this is quite clear to you all. Over here in this section number 32, subsection 1, subsection 2a, we have studied that manufacturing business includes printing and publication or generation and distribution of power or transmission of power. But over here specifically the assessee should set up a manufacturing business. Okay, it does not include printing and that business that has been given under section 32 subsection 1 subsection 2a. I hope this is quite clear to you all. Okay, and the new manufacturing business should be set up between 1st April 2015 to 31st March 2020 in the notified states of Andhra Pradesh, Telangana, West Bengal, Bihar. Okay, then the assessee is eligible for deduction of 15% of the cost of plant and machinery during the first year of acquisition of such asset, that is the plant and machinery. Plant and machinery does not include Udo Surgery. By now you know what does Udo Surgery means. And plant and machinery includes forklift truck. Okay, if such asset is transferred by way of amalgamation or demerger, then no problem. That means this 15% of deduction that has been taken by the assessee will be allowed. Okay, it will not be added back. But if such asset is transferred, that is it has been transferred other than this amalgamation or demerger, then if it is transferred within 5 years, then the benefit given earlier will be added back. Okay, and there is no condition of 180 days. Straight 15% deduction will be allowed. Here I am specifically saying deduction. This is not depreciation. I hope this is quite clear to you all. Okay, here they are giving deduction. Then straight 15% deduction of cost of the asset is allowed. I hope this is quite clear to you all. So let's come into our format book, into our question. Okay, here what the question is asking us to do, here the question is asking us to calculate deduction under section 32 AD. Okay, so deduction under section 32 AD will be available to the assessee, that is Mr. Sham, if he is engaged in manufacturing business. Okay, since he is engaged in the business of printing and publication, and in this section, that is section 32 AD, they have not mentioned that printing and publication is part of manufacturing business or not as per section 32 AD. So we will consider that this business is not manufacturing activity. I hope this is quite clear to you all. Okay, that is manufacturing business. So the new plant and machinery that has been purchased in the notified backward areas of the Andhra Pradesh, there this asset will not get a deduction under section 32 AD. I hope this is quite clear. But what if Mr. Sham was engaged in a manufacturing business, okay, specifically manufacturing business, then would this deduction under section 32 AD would have been available? The answer is yes. The deduction under section 32 AD would have been available. How much it would have been available? So it would have been available in this manner. So the total purchase of plant and machinery during the previous year 1920 was of 10 lakhs plus 15 lakh, which comes to around 25 lakhs. Okay, 10 lakhs plus 15 lakhs. On this 15% would have been calculated, which would be equal to 3,75,000. Okay, this 3,75,000 would have been deduction under section 32 AD if Mr. Sham would have been engaged in manufacturing business. I hope this is quite clear. And this manufacturing business was set up in the backward areas of Andhra Pradesh. I hope this is quite clear. I hope you all have understood this section, that is section 32 AD. Okay. So students, now let's understand this block of asset. We know what this block of asset means, but in this chart what we are going to learn is, if a block of asset is sold, then what will be the treatment of such sale of the block of asset. So let's understand it over here with the help of this chart. If a block of asset is there and all the asset of this block are sold, then what will be the treatment? If there is an over recovery, then it will be considered as short-term capital gain. If there is an under recovery, it will be considered as short-term capital loss, and there will be no asset, so no depreciation, because all the asset of this block has been sold. Okay, and if the asset which have been sold, that is the block of asset, are sold entirely, then there is a short-term capital loss, there will be no asset, and there will be no depreciation. I hope this is quite clear. So this is the first part of the chart. Let's understand the second part of the chart. Okay, so if a block of asset is there, and out of this block of asset, for example, there are 10 assets. Okay, out of this 10 asset, part of the assets are sold. Part of the asset, for example, 5 assets are sold. Okay, and if there is an over recovery, then it will be considered as short-term capital gain, and if there is an under recovery, then we will calculate depreciation, because there are asset and there is a value for depreciation. Okay, over here in this case there are asset and there will be no depreciation, because the part of the asset which I have sold have received over recovery amount. I hope this is quite clear. I know you all have not understood a single word after simply reading this chart. Okay, but don't worry, we will understand it with the help of an example. Okay, so come into the format book. In question number 2 over here, block of asset question is there. Okay, so let's read the first question. A car block is there and the car's depreciation is 15%, and the car block contain 10 cars. Okay, and the WDV of this car block is 10 lakhs. I hope this is quite clear to you all. Out of this 10 cars, that is out of this block of asset, 5 cars have been sold. That means this part of the assets are sold. Okay, so let's come back to the format book, and the WDV of this block was 10 lakhs and the asset is sold for 6 lakhs. If we subtract this, we will find 4 lakh. Okay, so if you remember that over here in the format, I used to write here less sale of asset. Okay, so this is a block of asset. I hope this is quite clear, and if there is a sale of asset, we will mention it over here. Okay, so that is what only is given over here. Okay, so understand this. This is the opening WDV and there are no additions during the previous year 2019-20. Okay, but there is a deduction in the asset, that is the assets are sold. So this 5 cars are sold for rupees 6 lakhs and the WDV is 10 lakhs. Okay, so the difference between these two is 4 lakhs. I hope this is quite clear to you. That is positive 4 lakhs. Okay, so this 4 lakhs is the remaining balance of WDV in the cars block. I hope this is quite clear. On this 4 lakhs, we will calculate depreciation. That is, on this 4 lakhs, we will calculate depreciation into 15%. I hope this is quite clear, because none of the assets have been purchased during the previous year 2019-20. So if the assets are not purchased during the previous year 2019-20, then there is no question of to see put to use. Okay, this 10 lakhs, that is the block of the asset, is definitely more than 180 days put to use. I hope this is quite clear to you all. Okay, so the difference between this two, which is equal to 4 lakhs, on this 4 lakh, which is the WDV before depreciation. Okay, we will calculate depreciation on this 4 lakh. So if you remember this format, after reducing the sale of asset, what we are finding is we are finding WDV before depreciation. So whatever amount will come over here, on this amount we will calculate the rate of depreciation. In our case here, the car is having a rate of depreciation of 15%. I hope this is quite clear. So on that remaining 4 lakhs, depreciation will be calculated at the rate 15%. So that is what is given in this chart. Okay, let's read this chart again. Block of asset is there. For example, cars block is there and part of the asset is sold. That means 5 cars are sold out of this block of the assets of car. Okay, and there is an under recovery. Okay, and there is a asset, there are asset and there is a value for depreciation. So this 4 lakhs is the value for the remaining asset, and on this 4 lakhs only debt will be calculated. I hope this is quite clear to you all. Okay, I hope you all have understood this much part at least. Okay, so now let's come back to the format book again and let's read this second question. Plant and machinery block is there, okay, and plant and machinery's block depreciation is 15%, okay, and there are 4 plants in this block, and the WDV of this entire block is 40 lakhs, okay, and the block is sold for rupees 50 lakhs, okay. So you can see there is a negative balance coming here, that is negative 10 lakhs. In simple words, there is an over recovery, and here all the assets are sold. That means, let's come back to our notes. Over here, block of asset is there and all the assets are sold from this block, okay, and there is an over recovery. If there is an over recovery, then whatever is the amount of over recovery, that is the excess amount, will be considered as short term capital gain. So let's come back to the format book. Over here, the difference of rupees 10 lakh, that is negative 10 lakh, will be considered as short term capital gain, and it will be taken under the head income from capital gain. I guess this is quite clear to you all. Okay, so let's come back to our notes. As we have studied over here, if there is a block of asset and the block of asset over here was plant and machinery, and all the assets that is in this block of plant and machinery are sold, and there is an over recovery, okay, as you can see, the WDV is 40 lakhs and the block is sold for 50 lakhs. So there is an over recovery of rupees 10 lakhs, and this 10 lakhs will be short term capital gain. I hope this is quite clear. I hope now you all are understanding how this chart works. Okay, so let's come back to the format book again and let's read this third question. Okay, furniture block is there and the furniture's depreciation is 10%, and there are 5 furniture in this block, okay, and the WDV of this furniture block is 20 lakhs, okay, and the block is sold for 18 lakhs. That means all the assets in this furniture block is sold for rupees 18 lakhs and the WDV is 20 lakhs. So basically, what is the scenario over here? There is a block of asset and all the assets in the block are sold, and there is an under recovery. As you can see that the WDV is 20 lakhs and it has been sold for 18 lakhs. There is an under recovery of rupees 2 lakhs. So what is this 2 lakhs? So this 2 lakhs is short term capital loss. So come into our notes again. If there is a block of asset and all the assets are sold from the block and there is an under recovery, then it will be considered as short term capital loss. I hope this is quite clear to you all. There will be no asset and there will be no depreciation. I hope this is quite clear because the entire block is sold. I hope this is quite clear to you all. So let's come back to our format book again. Okay, over here let's understand this fourth question. If a building block is there and this building's block is having a depreciation of 10% and there are 2 buildings in this building's block and the WDV of this building block is 40 lakhs, okay, and one building is sold for rupees 60 lakhs, okay, only one building, that is part of the asset from the block, is sold for rupees 60 lakh, and there is an over recovery. You can see there is a difference of 20 lakhs, that is excess recovery or over recovery, we can say it. Okay, so now let's come back to our notes. If there is a block of asset and part of the asset is sold, that means the block of asset is the building, okay, and there are 2 buildings, okay, and out of these 2 buildings, one building is sold, that is part of the asset is sold. I hope this is quite clear, and there is an over recovery, so it will be considered as short term capital gain. That means the difference of this 2, that is 40 lakhs minus 60 lakhs, which is equal to negative 20 lakhs, which will be short term capital gain. I hope this is quite clear because the consideration that has been received for one building is much higher than the WDV of the entire block. I hope this is quite clear to you all. So I hope you all have understood this chart. Okay, so if a block of asset is there and a part of asset is sold and there is an over recovery, then there will be short term capital gain. But there is a asset, there is still one building left. I hope this is quite clear to you all because out of these 2 buildings, only one building was sold. Okay, so there are asset and there will be no depreciation. On this balance one building left, we will never calculate depreciation as per Income Tax Act. I hope this is quite clear to you all. Similarly, if a block of asset is there and part of asset is sold and there is under recovery, then whatever amount is remaining in the block of the asset, for example, we took this example over here in this format book that there are 10 cars in the block and 5 cars are sold and 5 cars are sold for rupees 6 lakhs and the WDV of the 10 cars, that is the block of the car, is 10 lakhs. Okay, so the difference between this is 4 lakhs. So this is the WDV before depreciation. Okay, and on this we will calculate depreciation as per Income Tax Act. I hope this is quite clear. So here also it is written that there are asset and there is a value of depreciation. I hope this is quite clear to you all. And here depreciation is written which means that we need to calculate depreciation. I hope this is quite clear to you all. So I hope if you want to revise this block of asset, you can always refer this format books question. Okay, so it will be very easy for you all to remember the things. I hope this is quite clear to you all. So let's revise this block of assets chart. If a block of asset is there and all the assets from the block are sold and there is an over recovery on the sale of such block of asset, then it will be considered as short-term capital gain, and there will be no asset because all the assets are sold and therefore no depreciation will be calculated. Okay, and if the assets are sold, that is all the assets are sold from the block of the asset, there will be under recovery. Okay, and there will be short-term capital loss. I hope this is quite clear. Here also there will be no asset, and if there is no asset, there will be no depreciation. I hope this is quite clear to you. If there is a block of asset and a part of asset is sold from this block of asset and there is an over recovery, then it will be considered as short-term capital gain. Okay, and here there are asset and there will be no depreciation. I hope this is quite clear to you all. Okay. Similarly, if a block of asset is there and part of the assets are sold and there is an under recovery, then the scenario is we need to calculate the depreciation. I hope this is quite clear because there are asset in this block of asset and there is a value for depreciation. I hope this is quite clear to you all. Okay. Okay students, if the assessee is there and if the assessee does not want to follow this block of asset system and he wants to follow the individual asset system, then what will be the treatment as per the Income Tax Act if this individual assets are sold? Okay, over here we have studied if the block of asset is sold, then what will be the treatment as per the Income Tax Act. So now let's study about this individual asset system. Okay, so if an individual asset is there and this asset is sold, and after the sale of this asset the assessee has received a excess consideration over the cost, then whatever the assessee has received a consideration over the cost, it will be considered as short-term capital gain. I hope this is quite clear. But if the assessee who has sold his individual asset, okay, and he has received a consideration up to the amount of cost, okay, up to the amount of this cost, then the excess between the WDV up to the cost will be considered as PGPP income. I hope this is quite clear. But if this individual asset is sold and this individual asset is sold below the cost as well as below the cost of WDV, okay, then it will be considered as terminal depreciation. Let's understand all this with the help of the example given in the format book. Let's understand this question number 5. If there is a ship and this ship is an individual asset and the depreciation on this ship is 20%, okay, and there is only one ship, okay, there is no block of asset, the WDV of the ship is 15 lakhs, okay, and the cost of acquisition of the ship is 19 lakhs. That is, the ship was originally purchased at 19 lakhs. Now the ship is sold for rupees 20 lakhs or for 18 lakhs or for 13 lakhs. So in all these three individual cases, what will be the treatment as per the Income Tax Act? Let's understand it. So let's understand up to here, that is the first case, if the asset is sold for 20 lakhs. Okay, so the WDV is 15 lakhs and the cost of acquisition of the ship is 19 lakhs and the ship is sold for 20 lakhs. That means the difference between these two, that is 1 lakh, will be considered as short-term capital gain, and the difference between these two, that is from 15 lakh to 19 lakh, the difference is 4 lakh. This will considered as income from PGPP. I hope this is quite clear to you all. Overall, the excess consideration received by the assessee is 20 lakhs minus 15 lakhs, that is the WDV. The excess consideration received is 5 lakh. This 5 lakh is further divided into 2, 1 lakh and 4 lakh. This 1 lakh is short-term capital gain and this 4 lakh is income from PGPP. I hope this is quite clear to you all. Okay. So similarly, let's understand this second case. If the ship is there and the ship's WDV is 15 lakhs and the cost of the ship is 19 lakhs and the ship is sold for 18 lakhs. Let's calculate over here. The ship is sold for 18 lakhs, okay, and the WDV of the ship is 15 lakhs, okay. So the excess consideration received is 3 lakhs, okay. So is the excess consideration received above this cost of acquisition? The answer is no. The excess consideration is received above this WDV. So the difference that was of 3 lakhs will be considered as income from PGBP. I hope this is quite clear to you all. But what if the asset is sold for 13 lakhs? Then the consideration received is 13 lakhs and the WDV of the asset is 15 lakhs. That means there is a negative amount coming over here of 2 lakhs. So this negative amount will be considered as terminal depreciation. That means we can simply take this 2 lakhs amount in the computation of income from PGPP as depreciation as per Income Tax Act. I hope this is quite clear to you all. I hope now you all have understood this part. So let's revise this both the system, that is block of asset and individual asset system. Okay, if a block of asset is there and all the assets from this block are sold and there is an over recovery, then it will be considered as short term capital gain and there will be no asset and there will be no depreciation. But what if all the assets are sold from the block and there is an under recovery, then it will be considered as short term capital loss, and here also there will be no asset and there will be no depreciation. I hope this is quite clear. But what if there is a block of asset and part of the asset are sold, and due to the part of the asset sold there is an over recovery, then it will be considered as short term capital gain and there are asset and there will be no depreciation. Okay, here there will be no depreciation. I hope this is quite clear. But if there is a block of asset and part of the asset is sold and there is an under recovery, there will be depreciation. I hope this is quite clear, because there are asset and there is a value for depreciation. I hope this is quite clear. But if the assessee follows the individual asset system and if he sells his asset, then what will be the treatment? It is given over here. Excess over the cost will be considered as short term capital gain. Excess between the cost and the WDV will be considered as income from PGPP. Okay, I'll write it over here, income from PGPP. And if the asset, that is the individual asset, is sold and there is an under recovery of the cost and WDV, it will be considered as terminal depreciation. I hope this is quite clear to you all. Okay, so now let's move on to our next section, that is section 43 subsection 1, actual cost of asset for depreciation. In other words, it can be said as cost of acquisition of the depreciable asset, okay, so that we can calculate depreciation on such asset. I hope this is quite clear to you all. Okay, so let's read this particulars first of all and then we will understand it. Depreciation in case of a succession of a firm or a sole proprietary into a company or amalgamation or demerger of a company, then the asset transferred shall be depreciated in the manner that such succession or reorganization or demerger or amalgamation has not taken place. The depreciation shall be apportioned between the two entities in the ratio of the number of days for which the assets were used by them. So this is very simple. Okay, we will understand this with the help of one illustration from the study material. But before understanding that, let me throw some light on this part. Okay, here what it is said, depreciation in case of succession of a firm or a sole proprietary into company. We have already studied this under section 47, that if a sole proprietor transfers his going concern business into company, okay, that means he is converting his business into a company, okay, that is from sole proprietor he is upgrading to company, then such transfer will not be considered as transfer. That is what we have studied under section 47. And similarly, amalgamation or demerger of the company, we have also studied that under section 47. I hope you remember that. Okay, and if such is the case, okay, if such is the case, then such asset which have been transferred shall be depreciated in the manner that such succession or reorganization or demerger or amalgamation has not taken place. So simply we need to calculate the depreciation in the normal manner, okay, however we calculate, okay, and the depreciation will be apportioned, okay, the depreciation shall be apportioned between the two entities, that is the old proprietor and the new company, okay, and such apportionment of the depreciation will be done in the ratio of the number of the days for which the assets were used by them. So old proprietor and new company, so the ratio is number of days, okay. So we have to find out for this old proprietor how many days the asset was used, okay, and over here also we need to see for how many days the asset was used. I hope this is quite clear to you all. So now we will see the illustration from the study material. Okay, so wait, I'll find out that illustration. Illustration number 3. Okay students, so now let's understand this illustration number 3 on page number 4.199. Sai Limited has a block of asset carrying 15% rate of depreciation whose written down value on 1st April 2019 was rupees 40 lakh. It purchased another second hand plant and machinery of the same block on 1st November 2019 for rupees 14,40,000 and put to use on the same date. That means the second hand machinery was put to use on this date only, that is 1st November 2019. Sai Limited was amalgamated with Shirdi Limited with effect from 1st January 2020. You are required to calculate the depreciation allowable to Sai Limited and Shirdi Limited for the previous year ending 31st March 2020, assuming that the assets were transferred to Shirdi Limited at rupees 60 lakh. Also assume that the plant and machinery were purchased by way of account pay check. So we have read this question. Let's solve this question on a blank page. Okay, we'll feed the normal details. Okay, Sai Limited, okay, WDV of plant and machinery block at the rate 15% is how much? 40 lakhs. Okay, new plant and machinery, no, second hand plant and machinery purchased, okay, for rupees 14 lakh 40,000. Okay, now let's calculate the depreciation for this block. Okay, so we'll firstly mention this normal detail: asset put to use for more than 180 days and asset put to use for less than 180 days. Okay, so in this case, this 40 lakhs WDV is been put to use for more than 180 days. So on this, entire depreciation will be allowed. Okay, so which will be equal to 40 lakhs into 15%. Okay, so which comes to around 6 lakhs. Okay, and we will calculate the depreciation on this 14 lakh 40,000 asset. Okay, so this asset is basically purchased on 1st of November 2019, that is after 5th October, that is 5th 10 2019. That means this asset has been put to use for less than 180 days, so only half of the depreciation will be allowed. So let's calculate the half of the depreciation. 14 lakh 40,000 into 15% equal to 2 lakh 16,000 into 50% is equal to 1 lakh 8,000. I hope this is quite clear to you. So the total comes to around 7 lakh 8,000. Okay, so now let's come into our notes back. Okay, what does this note says? Okay, if a depreciation is to be calculated in case of a succession of a firm or a sole proprietary into a company, or if a depreciation is to be calculated in a case of amalgamation or a demerger of a company, then the asset transfer shall be depreciated in the manner that such succession or reorganization or demerger or amalgamation has not taken place. So that is how we have calculated this depreciation, assuming that such amalgamation between Sai Limited and Shirdi Limited has not taken place. Okay, so this is the depreciation's amount, and later what we have to do is the depreciation that we have calculated shall be apportioned between the two entities, that is Sai Limited and Shirdi Limited. Okay, and how it will be apportioned? It will be apportioned in the ratio of number of days for which the assets were used by them. Here asset was used by them, not block of asset was used by them. I hope this is quite clear to all. So let's come to this blank page and let's calculate the portion of depreciation that will be allotted or that will be apportioned to each entity. So we will write over here firstly Sai, and we will write over here Shirdi Limited. Okay, Sai Limited, Shirdi Limited. Okay, so let's calculate the number of days the old asset, okay, the old asset was used. Okay, so the old asset, that means this opening WDV of the asset was used by Sai Limited up to 31st December 2020, because on 1st of January 2020 the amalgamation took place and Sai Limited has transferred all its assets to the Shirdi Limited. I hope this is quite clear. So after or on or after 1st January 2020, Shirdi Limited is going to use all the assets of Sai Limited. I hope this is quite clear. So let's calculate the number of days of old asset used by Sai Limited. Okay, or else we will firstly calculate number of days used by Shirdi Limited of the old asset, because the Shirdi Limited got, because Sai Limited got amalgamated with Shirdi Limited on 1st January 2020. That means in Shirdi Limited the old asset was used from the very first day, that is from 1st January 2020. Okay, so entire 31 days of the January month the old asset was used, plus 29 day because it is February and it is a leap year, plus 31 days of March. So that means for 91 days, the old asset was used by For 91 days, the old asset was used by Shirdi Limited and the old asset was used by Sai Limited for how many number of days? Let's calculate. 366 days minus 91 days is equal to 275 days. I hope this is quite clear to you all. So in this ratio, this 6 lakhs of depreciation will be divided. I hope this is quite clear. Let's calculate number of days the new asset was used by each of them. Okay, so the new asset was purchased on 1st of November 2019. Okay, so the amalgamation between Sai Limited and Shirdi Limited took place on 1st of January 2020. Okay, so entire month of November and December was used by Sai Limited. So November consists of 30 days, so I'll write it over here. 30 plus 31, it comes to around 61 days. For 61 days, the new assets was used by Sai Limited, and for the remaining 91 days, the new asset was used by Shirdi Limited. I hope this is quite clear. So now we will calculate the depreciation that will be apportioned to Sai Limited and Shirdi Limited. So firstly, 6 lakhs will be apportioned in this ratio. I hope this is quite clear to us. So 6 lakhs into 275 divided by 366 days, which is equal to 4,50,820. I hope this is quite clear to you all. Minus plus 6 lakhs is equal to 1,49,180. I hope this is quite clear to you all. Similarly, the depreciation for Sai Limited for this new asset will be apportioned in this manner. 1,08,000 will be apportioned between this two, Sai Limited and Shirdi Limited. Okay, so let's calculate that. 1,08,000 into 61 days divided by 91 plus 61 is equal to 152 days, which is equal to 43,342 minus plus 1,08,000, which is equal to 64,658. I hope this is quite clear to you all. Okay, so let's see 91 days plus 61 days, how many days it comes to? 152 days only. So we have calculated it right only. So there is no worry. Let's calculate the total depreciation that will be allowed to Sai Limited and to Shirdi Limited. Okay, 4,50,820 plus 43,342 is equal to 4,94,162, and over here 1,49,180 plus 64,658 is equal to 2,13,838. So this is the amount of the depreciation that will be apportioned to the Sai Limited as well as to the Shirdi Limited. So it is apportioned in this ratio. So this 7,08,000 is apportioned in this. We can't simply apportion this in the ratio of this only, because many of the times I have seen the students who are solving this kind of sum, they do this mistake. They write this right amount, they calculate this depreciation's amount right, but they divide the depreciation amount entirely in this ratio only. They do not consider this new asset. Okay, we need to consider the new asset. So that is why over here I have specifically written that the depreciation shall be apportioned between the two entities in the ratio of number of days for which the assets, were used by them. I hope this is quite clear to you all. So I hope you all have understood this part. Let's read this part again. If a depreciation has to be calculated in a case of a succession of a firm or a sole proprietary into company, or a depreciation has to be calculated in a case of amalgamation or a demerger of a company, how the depreciation will be calculated? The depreciation will be calculated in this manner. The asset transferred shall be depreciated in the manner that such succession or reorganization or demerger or amalgamation has not taken place. Okay, and the depreciation shall be apportioned between the two entities in the ratio of number of days for which the asset was used by them. Here block of asset is not written. Okay, here only asset is written. I hope this is quite clear to you all. So this becomes individual asset, and this also becomes individual asset. I hope this is quite clear to you all. Okay, I hope you all have understood these things now. Okay, so now let's understand this part. Okay, if any capital asset acquired in any mode other than account pay check or a bank draft or an ECS payment or through such other prescribed electronic mode in excess of rupees 10,000, then such capital asset will not form part of the block of asset. So over here in the question also they were mentioning that assume that the plant and machinery was purchased by way of account pay check. Why they were giving this assumption? Because if it is not assumed that it has been purchased in account pay check, then this asset will not be considered in the block of the asset. Okay, because it has been purchased by any other mode. Okay, any other mode other than this account pay check, bank draft, ECS payment, or through such other prescribed electronic mode in excess of rupees 10,000. I hope this is quite clear to you. This is quite self-explanatory also. I hope you all have understood this part. Okay, here is a table. Okay, this table is an important table, but out of this table, which all things you need to remember for your inter level, I'll tell you. Because point number 3, point number 4, point number 5 are of higher importance at CA final level, at IPC level or inter level. This part will not come. Okay, mostly it will not come, but I'll explain it to you, but you can strike this off. Okay, so let's understand this, what it is. How to calculate cost of acquisition in case of an asset for depreciation. Okay, so serial number 1, circumstances and actual cost, that is the cost of acquisition. Okay, so let's see this. Okay, first, scientific asset used in business after it ceases to be used for scientific purpose, then cost of acquisition of such scientific asset will be nil. Okay, so what does this point number 1 say is that if there is a scientific asset used in the business and after such use of this scientific asset in the business it ceases to be used for this scientific purpose, then the cost of acquisition of such asset will be nil, because there are certain benefits given under this head, that is income from PGPP head, where if an assessee, okay, is purchasing a scientific asset, that is a capital asset, then whatever is the cost of this capital asset, it is 100% allowed. Okay, for what it is allowed? It is allowed as deduction from the income and for calculating the net profit. I hope this is quite clear. So if there is a deduction already given by the Income Tax Act to the assessee, then again it will not give this deduction by giving this scientific asset a value. Okay, if a value has been given to this scientific asset, then we will start calculating depreciation on it. So if there is no value to such scientific asset, then no depreciation will be calculated. I hope this is quite clear to you all. So I hope you all have understood why this particular point came into existence. So let's revise this. If there is a scientific asset and this scientific asset was used in the business and after it ceases to be used for this scientific purpose, then the cost of acquisition of such scientific asset will be nil. I hope this is quite clear to you all. Then point number 2 says that if an inventory is converted into capital asset, okay, if an inventory is converted into capital asset, then the cost of the asset will be considered as fair market value. For example, understand that a assessee is there. Okay, an assessee is doing a business of cars. So inventory of this assessee will be car only. Okay, so if we convert one of the inventory into the depreciable asset of the business, okay, then on this asset, that is the car, the assessee will need to charge depreciation. Okay, so on what amount this depreciation will be charged on the car? So that is what is given over here. Cost of acquisition of such inventory which is converted into capital asset, then such cost of the asset will be considered as fair market value of what? Of inventory. I hope this is quite clear to you all. I hope this is quite clear. I hope you all are understanding this. Okay, so let's understand point number 3. Point number 3 is not important for your level. Okay, point number 3, 4 and 5 are not important, but still we will understand it. Okay, second-hand asset acquired at enhanced cost to claim excess depreciation, then cost of acquisition will be determined as per the assessing officer with prior approval of the Joint Commissioner of Income Tax. Okay, so just read it, that's enough. Okay, fourth point says that if the assessee reacquires the asset sold to other person once belonging to him, that means the assessee was having a car, that is an asset, he sold it to a person, okay, and again this person is selling this car to the assessee at higher price. That means this car was sold to this third person for rupees say 5 lakh. Okay, now this third person is selling the same car to the assessee for say rupees 6 lakhs. then assessee is trying to take that 6 lakhs amount as the cost of acquisition of such asset. So income tax says no, do not try to fool us. The cost of acquisition of such car will be WDV at the time of sale, that is 5 lakh, or whatever will be the WDV, or cost of acquisition, whichever is lower. I hope this is quite clear. So income tax is smart enough, do not try to fool them. I hope this is quite clear to you all. So next point says that sale and leaseback transaction. So if there is a sale and leaseback transaction, then cost of acquisition of the asset will be WDV of the leasee. That means the person who was using the benefit of such asset. Okay. So cost of acquisition will be WDV of the leasee for the lessor. Okay. I hope this is quite clear. That is our assessee. I hope this is quite clear. Let's understand point number 6. Point number 6 says that building being property of the assessee in India or outside India, and the assessee can be a resident or a non-resident, and such assessee brings such building into the business of the assessee, then what will be the cost of acquisition of such building? Okay, the cost of acquisition of such building will be building's value, that is cost of acquisition of the building original minus depreciation till the date as per the Income Tax Act as in force, assuming that such building was used in the business only from the date of acquisition. I hope this is quite clear to you all. If you have not understood, I'll explain you over here in a blank page. So understand that this is a resident assessee, okay, and he is doing a business. He has acquired a building in 2015 and 16 for rupees 10 lakhs, okay, and this building is a normal building, okay, and now in the previous year 2019-20, assessee is bringing this building into the business, okay. So what will be the cost of acquisition? The cost of acquisition will be calculated in this manner: opening value of building is 10 lakhs, okay, and then we will calculate depreciation less depreciation as per Income Tax Act, okay. The depreciation on the normal building is at 10%, okay. So 10% of 10 lakh is 1 lakh, okay, and this depreciation is for the year, that is previous year 2015-16, okay. So the WDV will be equal to 9 lakhs. I hope this is quite clear to you all. Then again we will reduce depreciation as per Income Tax Act at the rate 10% for previous year 2016-17, so which will be equal to 90,000, and our WDV will be equal to 8 lakhs 10,000. I hope this is quite clear. Similarly, we will reduce depreciation for previous year 2017-18, okay, which will be equal to 81,000, okay. So now let's remove our calci back. 8 lakh 10,000 minus 81,000, which is equal to 7 lakh 29,000, okay. So this will become our WDV, okay. Again, depreciation for the previous year 2018-19 we will calculate at the rate 10%, so which will be equal to 72,900, and let's calculate the WDV, okay, minus 10% is equal to 7,29,000 minus 10% is equal to 6,56,100. I hope this is quite clear. So this will become the WDV, okay. So this WDV, whatever we have calculated, will become the opening WDV for previous year 2019-20. So this amount, that is 6,56,100, 6,56,100 will become the cost of the building for the previous year 2019-20. I hope this is quite clear. And now henceforth we will again calculate 10% of depreciation for every year. I hope you have understood this part now, okay. So I hope This point number 6 is crystal clear now. Okay, let's revise this point number 6. Building being property of the assessee in India or outside India, and the assessee being resident or non-resident, and if such assessee brings such building into the business, then the cost of acquisition of the asset will be cost of acquisition of this building minus depreciation till date as per the Income Tax Act as in force, assuming that such building was used in the business from the date of acquisition. I hope this is quite clear to you all. Then point number 7 says that capital asset on which deduction has been allowed under section 35 AD. So we will study this section 35 AD. So I'll give you a small glimpse. Under this section 35 AD, it has been given that if the assessee do a certain specified business, and if he incurs capital expenditure on capital assets, okay, then whatever expenditure has been incurred on such capital expenditure as well as on the capital asset, it will be allowed as deduction under section 35 AD from the income for calculating the net profit as per Income Tax Act. Okay, but there are certain conditions. If there is a breach of the condition, then we need to find out the cost of the asset. Okay, so we will calculate cost of acquisition for such asset in this manner: actual cost of the asset less depreciation till date as per income tax as in force. Okay, similar to this format only that we have studied on the blank page. Okay, assuming that such asset was used from the date of acquisition. I hope this is quite clear. So our total depreciation part is completed. Okay, so our depreciation started from section 32. Okay, and it went up to section 43 subsection 1, and then we studied section 32 AD, which was investment based deduction. It was deduction and not depreciation. I hope this is quite clear to us. So we will not waste any time on revision because we have already revised it many of the times. Okay, so we will take a break over here. Okay. Okay students, so now let's understand this section number 35, scientific research expenses. Before understanding this scientific research expenses, I'll explain you this part in a layman term. So let's come into a blank page over here. Understand that there is an assessee, Mr. Ram. Okay, Mr. Ram is doing a business. Okay, and Mr. Ram has got an idea, and for this idea he has to do a research, okay, for making a final product. Okay, so the government says that is the income tax department says that is the income tax act says that if any assessee, okay, incurs revenue or capital expenditure on research and development, okay, then whatever the expense they have incurred on this revenue expenditure for this research or capital expenditure for this research and development, that will be allowed as deduction. So how much it will be allowed? Minimum it will be allowed up to 100%, but there are cases where they are allowed up to maximum 150%. I hope this is quite clear. So for example, understand that this is our assessee's P&L account. Okay, in this P&L account, assessee has done the sales. Wait, assessee has done the sales of say rupees 10 lakhs. Okay, and over here purchases are there. He has done a purchase of 5 lakhs. Okay, and he has done a revenue research expense, okay, of say rupees 1 lakh. Okay, and he has done other expenses like salary of 1 lakh, and this salary is also paid for research purpose over here I have written a wrong spelling, revenue research. And if the salary is also paid for research purpose only, then whether all these expenses will be allowed to be reduced from this income or not. So that is what we are going to study over here in the section 35. Okay, so this is a broad view that this is the P&L of our assessee Mr. Ram, who is engaged in a business and he is doing a research and development for a final product, and he is incurring a revenue cost for this research. Okay, and he has taken it into the P&L and he has find out the net profit. So whether all these research expenses will be allowed to this particular assessee for calculating the net profit as per income tax act or not. So that is what we are going to study in this section. So come here in the notes, section 35, scientific research expenditure. So if the assessee is doing a scientific research expenditure and such scientific research expenditure is relating to the revenue expenditure, then how much deduction will be allowed as per income tax act is given. If such a revenue expenditure is done before commencement, okay, that is pre-commencement of the scientific research project. Okay, so not in one day this project starts. Okay, it takes a period of time. So before this project starts, before this some revenue expense has been done by the assessee for this scientific research project. Okay, then this is known as pre-commencement revenue expenditure for this scientific research. Okay, then the salary paid by the assessee to the workers will be allowed as scientific research expenditure, that is the revenue expenditure, but only salaries will be allowed. No perquisites will be allowed as expenditure. Okay, I hope this is quite clear. And purchase of the material also done by the assessee for this scientific research is also considered as revenue expenditure, and all this expenditure done by the assessee in the last 3 years, that is before the start of the project, that is our research project, is allowed. That is 100% of this expenses will be allowed. Okay, and such 100% of the expenses will be allowed only after the approval of the prescribed authority. I hope this is quite clear to us. So let's come back to over here in the blank page. Understand that this revenue research expenditure is a material expenditure. Okay, material expenditure, and the salary has been paid for this research people only. So this entire cost, that is of 2 lakhs, okay, is been allowed by prescribed authority, then this 2 lakhs of the cost will be allowed. That means it will not be added back to the net profit. For example, for time being, understand that the net profit as per the P&L comes to around 3 lakhs. Okay, so let's come to our format book over here. In this format book, there is a format for calculating income from PGPP. Understand the net profit as per the books is 3 lakhs. Okay, so we don't need to add back this 2 lakhs into this 3 lakhs. I hope this is quite clear. So that is what is given over here. Scientific research expenditure, if it is a revenue expenditure, then it will be allowed as deduction under section 35 subsection 1 subsection 1. Okay, and if such revenue expenditure is done before pre-commencement, that is before the commencement of the research project, then the revenue expenditure will be allowed for the salary and not for the perquisite, and as well as it will be allowed for purchase of the material, and such expenses will be allowed of last 3 years. Okay, and 100% of the expenses will be allowed only after the approval of the prescribed authorities. I hope this is quite clear to you all. But similarly, if this revenue expenditure are incurred by the assessee post commencement, that is after the project has been started, that means the research project has been started, and after that the assessee is incurring a post commencement revenue expenditure for the scientific research, then any revenue expenditure incurred for the scientific research will be 100% allowed. I hope this is quite clear to you all. So assuming over here this was the pre-commencement cost. Okay, now over here one more cost has been added of research miscellaneous. Okay, miscellaneous expenses of research of rupees 2 lakhs. I hope this is quite clear to us. So that means our net profit will reduce now. The net profit will come to 1 lakh, and in our format book also here net profit will change. Okay, of 1 lakh. But now the scenario is these expenses are incurred post commencement of research project. I hope this is quite clear to you. So any expenses related to this research, if this are revenue expenditure, will be allowed as deduction under section 35 subsection 1 subsection 1. I hope this is quite clear to you all. Okay, so let's revise this much part again. Okay, under section 35, if the assessee is incurring a scientific research expenditure and such scientific research expenditure is a revenue expenditure in nature, then the revenue expenditure, if incurred before the commencement of the research project, then salary will be allowed as expenses, as well as purchase of the material will be allowed as expenses, provided a approval has been taken from a prescribed authority. And such expenses of the last 3 years, that is this project is going to start on this date, and this 3 years expenses will be allowed in the year when the approval is been provided by the prescribed authorities. I hope this is quite clear to you. Similarly, if the scientific research expenditure is a revenue expenditure and such expenditure is incurred after the post commencement, that means the project has been started on this date, and post commencement of this project the expenditure is incurred, that is the revenue expenditure is incurred, then any revenue expenditure incurred by the assessee for such scientific research will be 100% allowed. I hope this is quite clear to you all. Similarly, if the assessee wants to make a capital expenditure, that means the assessee wants to purchase some machinery, okay, for such scientific research, okay, then will such capital expenditure will be allowed as deduction. So that is what is given under this T diagram. Scientific research expenditure, if it is a capital expenditure, then deduction is available under section 35 subsection 1 subsection 4. Okay, so if the capital expenditure is done pre-commencement to the project, that is the research project, then any capital asset but only of last 3 years except land will be 100% allowed. That means, for example, if the assessee has taken machinery, furniture, vehicle, okay, anything other than land, okay, other than land, in fact even if it takes building also for this research purpose, it will be allowed, that is 100% allowed as deduction under section 35 subsection 1 subsection 4. Okay, so let's come into our blank page over here. So understand that this is our P&L account. Okay, over here the assessee has sold of 10 lakhs, he has done sales of 10 lakhs. Okay, purchases is say 5 lakhs. Okay, and he has done a research expenses all inclusive, okay, research expense of rupees 3 lakhs. Okay, that means the net profit will now come to around 2 lakhs. Okay, so basically this scenario is pre-commencement scenario. Okay, pre-commencement scenario, and pre-commencement research expenses is also allowed 100%, that we have studied under section 35 subsection 1 subsection 1. I hope this is quite clear. So there is this net profit of 1 lakh. Okay, and now this our assessee, okay, before the commencement of the project has made a capital expenditure, that is he has purchased a machinery of rupees 5 lakhs. Okay, so the machinery of this rupees 5 lakhs will also be allowed as deduction under section 35 subsection 1 subsection 4 subsection 4. I hope this is quite clear, but it will not be taken over here, it will be taken into our format. Okay, so understand that over here now the net profit as per the books is 2 lakhs. Okay, and the assessee has incurred this pre-commencement capital expenditure of say rupees 5 lakhs. Okay, so let's come to the format book. Over here we will reduce allowances of expense as per the income tax act, that is under section 35 subsection 1 subsection 4 of 5 lakhs expenditure will be allowed. I hope this is quite clear. This is less. I hope this is quite clear. So whatever the income the assessee has earned, it will be reduced by this 5 lakh, and even if it is a negative balance, it does not matter, because we have already studied set off and carry forward chapter. Okay, so if there is a loss, this loss can be set off against the other head of income. I hope this is quite clear to you all. I hope you all are getting the grip why all these deductions are given and how to apply this deduction in the sums. Okay, so I hope you all have understood this part. Let me erase all these things in the format, okay, so that it will remain clean. Okay, so let's come back to our notes. Okay, over here we have understood pre-commencement. So similarly, if the post-commencement capital expenditure is done for the project, that is the research project, then any capital expenditure other than land will be 100% allowed. I hope this is quite clear to you all. So from here you can see that, okay, if the assessee makes a scientific research expenditure and such expenditure is a revenue expenditure or a capital expenditure, it will be 100% allowed if it is a post-commencement expenditure. But if it is a pre-commencement expenditure, there are certain conditions that only salary and purchase of the material will be allowed for the last 3 years. Okay, and it will be 100% allowed only with the prior approval of the prescribed authorities. I hope this is quite clear. But if it is a case of pre-commencement capital expenditure, then any capital asset will be allowed as deduction under section 35 subsection 1 subsection 4. Okay, but the asset should not be the land. Okay, even if the asset is a building, it is allowed. Okay, in pre-commencement as well as post-commencement, in both these cases, if the asset is a land, then it will not be allowed. I hope this is quite clear to you all. Okay, and if the capital asset has been purchased, that is a capital asset is there, okay, and a deduction has been claimed under section 35 subsection 1 subsection 4, then no depreciation on this will be allowed under section 32 as well as under section 32 subsection 1 subsection 2a. I hope this is quite clear. So this is what we have already studied under section 43 subsection 1 over here. Okay, in this point number 1, which said that scientific asset used in the business, after it ceases to be used for this scientific purpose, the cost of acquisition will be nil. I hope this is quite clear. So let's come back to this section 35 and let's revise this. Okay, section 35 says that scientific research expenditure, if related to revenue expenditure, then it will be allowed under section 35 subsection 1 subsection 1, and if such revenue expenditure is a pre-commencement expenditure, then only salary expense as well as purchase of the material expense will be allowed of the last 3 years. Okay, and 100% of such expense will be allowed only after approval of the prescribed authorities. I hope this is quite clear. But if the revenue expenditure is a post-commencement expenditure, then any revenue expenditure relating to this scientific research will be 100% allowed. I hope this is quite clear. Then if a scientific research expenditure is a capital expenditure, then a deduction is allowed under section 35 subsection 1 subsection 4, which says that if a capital expenditure is done pre-commencement to the research project, then any capital asset purchased for such project will be allowed as deduction under section 35 subsection 1 subsection 4. But such capital asset has to be purchased in the last 3 years, and the capital asset should not be land. I hope this is quite clear. But if the capital asset has been purchased in the post-commencement period, okay, then the capital asset can be allowed as deduction under section 35 subsection 1 subsection 4, and any capital expenditure will be allowed other than the land. I hope this is quite clear to you all. Okay, and this asset which has been allowed a deduction under section 35 subsection 1 subsection 4. On this asset no depreciation will be allowed, as well as no additional depreciation under section 32 subsection 1 subsection 2a will be allowed. I hope this is quite clear to you all. I hope you all have understood this. I hope you all have understood this layman understanding also, okay, how things has to be done, okay, and how we will add up or we will not add back such expenses in the net profit that has been calculated as per the accounting standard in order to calculate the net profit as per Income Tax Act. I hope this is quite clear to you all. Okay, so now let's come back to our notes. Okay, this was the first part. Okay, now underneath there is a table. Okay, this table is for scientific research expenditure, and such expenditure is in a form of donation to the others. Okay, so basically what the case is over here is, if the assessee himself is not doing a scientific research expenditure, but he is giving a donation to someone else who is doing a scientific research expenditure, then whatever donation has been done by the assessee will be allowed as deduction. Okay, and such deduction will be either allowed 100% or will be allowed 150%. I hope this is quite clear. So what is this 150%? Don't worry, I'll explain it to you all. Okay, so let's read this table in a speedy manner first of all, then we will go into a blank page and I'll explain it to you over there. Okay, so this is a donation or a contribution made by the assessee, or the amount paid by the assessee to the following institutions. Okay, so first is notified approved research association, universities, college, other institution for scientific research. Okay, so if this is the assessee and this assessee is making a donation or a contribution, or he has paid an amount to a notified approved research association or a university or a college or other institution for scientific research, then a deduction under section 35 subsection 1 subsection 2 will be allowed at the rate 150%. Okay, so how this 150% will be applicable, I'll show it to you all, don't worry about that. Okay, in point number 2 it says that if a assessee is there and if the assessee is making a donation or a contribution, or he is paying an amount to an approved Indian company, okay, to whom he is paying to an Indian company who is approved for scientific research, then a deduction will be allowed under section 35 subsection 1 subsection 2a at the rate 100%. I hope this is quite clear to you all. Similarly, in point number 3, it is said that if this is the assessee, okay, and this assessee is making a donation, contribution, or is paying an amount to this notified approved research association, universities, college, other than institution for research in social science or statistical research, then a deduction of 100% will be allowed. I hope this is quite clear. So here again is our assessee, and this assessee is making a donation, contribution, or is paying an amount to an approved notified laboratory, university, IIT, specified person for scientific research undertaking under an approved program, then a deduction is allowed under section 35 subsection 2AA at the rate 150%. So how we will calculate deduction? Let's see it over here in a blank page. Understand that this is our assessee Mr. Ram. Let me change the color. Here is our assessee Mr. Ram. Okay, Mr. Ram is running a business. Okay, and below is the P&L of Mr. Ram. Let's see it over here. Sales 10 lakhs. Okay, and purchases 5 lakh. Over here in the P&L, Mr. Ram has mentioned a donation under section 35 subsection 1 subsection 2. Okay, and the donation amount is 1 lakh rupees. Okay, and the net profit of Mr. Ram's business is now 4 lakhs. Okay, so will this 4 lakh will be straight taken into computation of total income of the assessee under head of PGPP? This is a question. So the answer for this question is no. We will calculate the profit as per the directions given by the income tax. Okay, so we will take this 4 lakh first of all in our format book over here. We will mention the profit as per business is 4 lakh. Okay, and in this question what they have given us, the assessee has made a donation under section 35 subsection 1 subsection 2 of rupees 1 lakh. So what does our note says? Okay, so we are in the notes right now. Over here section 35 subsection 1 subsection 2 is given, and if the assessee is making a donation under section 35 subsection 1 subsection 2, then whatever the amount he has donated, a deduction of 150% will be allowed. That means if he has donated 1 lakh, into 150% will be done. That means 1,50,000 donation will be allowed to the assessee. So how we will calculate the new net profit, okay, net profit as per Income Tax Act. So come into the format book over here. Now we will add back disallowances of expense which is already debited to P&L account. So we will write over here donation under section 35 subsection 1 subsection 2. Amount that he has donated is disallowed, okay, so it will be added back, okay. And allowances of expense as per the Income Tax Act. So how much allowances has been allowed? Donation that is 1 lakh into 150% is allowed as per Income Tax Act. So we will write over here 1,50,000 and we will reduce, and finally we will calculate our net profit as per PGBP. So 4 lakh plus 1 lakh is equal to 5 lakh, and 5 lakh minus 1,50,000 is equal to 3,50,000. So net profit as per Income Tax Act will be 3,50,000. I hope this is quite clear. So I hope you all have understood how we will calculate this 150% of deduction, okay. Over here the assessee has made a donation, okay, under section 35 subsection 1 subsection 2 of rupees 1 lakh, but the deduction under Income Tax Act is allowed at the rate 150%. So we need to add back this 1 lakh amount into this net profit, and then we need to reduce this 1 lakh into 150% from this new net profit that is of 5 lakh rupees. I hope this is quite clear. And from this 5 lakh, 1,50,000 will be reduced. That is the donation as per section 35 subsection 1 subsection 2 as per the Income Tax Act. And finally our new net profit as per the Income Tax Act will be equal to 3.5 lakh. I hope this is quite clear to you all. So let's erase all this thing what we have written in our format, because I have to explain one more thing over here, okay. So I'm erasing this, okay. So let's come back to the notes. I hope you all have understood this part, okay. If the assessee is there and if the assessee is making a donation to this notified approved research association, universities, college, other institution for scientific research under section 35 subsection 1 subsection 2, then a deduction of 150% is allowed under this section, okay. So whatever the amount of donation the assessee has done to this approved research association under section 35 subsection 1 subsection 2, it will be disallowed, okay, and up to 150% it will be allowed. I hope this is quite clear to you all. So now let's understand this point number 2. If this is the assessee and this assessee is making a contribution to this approved Indian company for scientific research under section 35 subsection 1 subsection 2a, then 100% of the amount that the assessee has contributed or donated to this approved Indian company for scientific research will be allowed as deduction under section 35 subsection 1 subsection 2a. So for example, come back to our blank page. Over here the assessee had made a donation earlier under section 35 subsection 1 subsection 2, but let's change it to section 35 subsection 1 subsection 2a. If the assessee would have made a donation to this approved institution, that is the approved company for research, then whatever amount has been donated by the assessee will be 100% allowed. So we don't need to add this back to this and again reduce it, okay. It will give the same effect, okay. So earlier we had added back to here in this net profit because the deduction was allowed up to 150%, okay, but over here it is allowed up to 100% only. So adding it back and further reducing it back will give us the same effect of 4 lakhs only. So we will not do anything, we will keep as it is because this expense is allowed by the Income Tax Act. I hope this is quite clear to you all, okay. So similarly, if the assessee makes a donation or makes a contribution to a notified approved research association, universities, college, other institution for research in social science or statistical research under section 35 subsection 1 subsection 3, then 100% of the donation that the assessee has made to this institution will be allowed. That means similarly over here only, if this donation was made to this institution mentioned under section 35 subsection 1 subsection 3, then this 1 lakh will be 100% allowed. So we don't need to add this back and further reduce it to find out the profit as per the Income Tax Act, okay. This is basically allowed by Income Tax Act. I hope this is quite clear to you all, okay. So let's come back to the notes. If the assessee is making a donation or a contribution to approved notified laboratories, universities, IIT specified person for scientific research undertaking under an approved programming, then the deduction will be allowed to this assessee under section 35 subsection 2AA at the rate 150%, okay. For example, understand over here the donation is done under section 35 subsection 2AA. Then whatever this amount of donation has been done, we need to add back to the net profit, okay, and then further we have to multiply the donation with 150%, and whatever amount will come of 1,05,000, it will be reduced from the profit, okay. So let's come into the format book, okay. Over here again the profit is 4 lakhs only, okay. We need to add back the donation under section 35 2AA. Here we have donated an amount of rupees 1 lakh, okay. So this will be added back, and then we will reduce the expenses allowed as per Income Tax Act for donating under section 35 2AA, which is equal to 1 lakh into 150%, which will be equal to 1,50,000. I hope this is quite clear. And finally, our net profit as per the Income Tax Act will be equal to 3,50,000. I hope this is quite clear to you all. I hope you all have understood this entire section 35. Okay, so now let's move on to our next section. The next section is section 35, subsection 2AB. So what does this section say is 150% of the revenue and capital expenditure related to research post commencement. If there is an in-house research and development facility is there, then such a revenue and capital expenditure will be allowed up to 150%. That means the deduction under section 35 subsection 2A will be allowed at the rate 150%. I hope this is quite clear to you all. So let's understand the particulars first of all, and then we will understand it in a blank page. Okay. If a company is there, so basically if a company is the assessee, then only a deduction will be allowed under section 35 subsection 2AB. So basically there is a very rare possibility that they will ask a question from this, but they have given this particular thing in your study material. That's why I'm explaining it to you. Okay. So if the company is the assessee, and if the company is engaged in the business of manufacturing of a biotechnology or incurring expenditure in relation to the research related to drugs and pharma, including expenditure on clinical trial, obtaining approval from any regulatory authority, and filing any application for patent, then deduction up to 150% other than land and building will be allowed. Okay. So what does this mean? Let's understand this. Okay. If the assessee is the company and if the assessee is the company and the company is engaged in the manufacturing of a biotechnology or is incurring an expenditure relating to a drug trial or a pharma trial or a clinical trial, and is incurring an expenditure in order to obtain an approval from a regulatory authority for filing an application for patent, then whatever expenditure they have incurred on all of this will be allowed up to rupees 150%. That is, the deduction will be allowed up to 150% under section 35 subsection 2AB. I hope this is quite clear to you all. Okay. And the deduction will not be allowed up to 150% for the expenditure which is a capital expenditure, okay, on this land and building. Okay. But earlier we have studied section 35 subsection 1 subsection 4 over here. Okay, if a post commencement expenditure is done by the assessee for this scientific research, and if such expenditure is done on any capital asset other than the land, that means this any capital assets include building, okay, and it excludes land, okay, then 100% deduction will be allowed under section 35 subsection 1 subsection 4. So that is what is only written over here. But if the capital expenditure of building is there, then a deduction will be allowed up to 100% under section 35 subsection 1 subsection 4, that is post commencement capital expenditure. I hope this is quite clear to you all. Okay students, so now let's revise up to this much only. First of all, section 35 2AB says that if the assessee is making a revenue or a capital expenditure relating to a research, and such research expenditure is done post commencement of such research project, okay, then 150% of this revenue as well as capital expenditure will be allowed if such expenditure is done for in-house research and development, okay, and such 150% deduction, okay, under section 35 2AB will be allowed to the company only. I hope this is quite clear to you all. Okay. And such company who is the assessee is engaged in the business of manufacturing of a biotech or incurring expenditure in relation to research in relation to a drug and pharma, including expenditure on clinical trial or for obtaining the approval from a regulatory authority and filing an application for the patent. So whatever expense has been incurred on all these things will be allowed as deduction up to 150%. But if a capital expenditure is done on a land and building, then 150% deduction will not be allowed, but capital expenditure of a building can be allowed up to 100% under section 35 subsection 1 subsection 4, that is post commencement capital expenditure. I hope this is quite clear to you all. Okay, so these things that is written in red, I'll explain you only after studying this section, that is section 41 subsection 3. Okay, if I explain it to you right now, things will get little complicated, so let's not understand it right now. Okay, and let's understand this part. Okay, in case of a scientific research asset is sold, and if such asset is used in the business and then sold, then the cost of acquisition is nil. Sales proceed or scrap value, whichever is received, will become short-term capital gain. So let's come back to over here. Section 43 subsection 1. Over here we have studied this scientific research asset used in the business, and after it ceases to be used for the scientific purpose, the cost of acquisition will be nil. And if the assessee sells this scientific asset, whatever amount that has been received by this assessee for the consideration of this scientific asset will be considered as short-term capital gain. I hope this is quite clear. So that is what is given over here. If such asset is used in the business and then sold, then the cost of acquisition will be nil, and the sales proceed or the scrap value received for the scientific research asset, whatever will be the amount, that amount will be considered as short-term capital gain. But if such asset is not used in the business and sold, that means this applies only in case of section 35 subsection 1 subsection 4. That means only for this part. Okay, entire this part. Okay, so let's read this part again. If such asset is not used in the business and sold, then the amount allowed as deduction for the capital asset will be treated as the business income, and calculate capital gain as if the asset was purchased for the normal business other than research purpose, and such asset is sold, and whatever will be the amount, that is the excess amount or under recovery amount, will be considered as short-term capital gain or terminal depreciation. By now you know what the short-term capital gain means and what does terminal depreciation means when an asset is sold. I hope this is quite clear. So let's understand this part once again. If such asset, that means this assets, okay, this asset is not used in the business and it is simply sold, then the amount allowed as deduction for capital asset will be treated as business income. That means 100% of deduction that we have claimed under section 35 subsection 1 subsection 4 will be considered as business income now, and we will calculate capital gain as if the asset was purchased for normal business other than research purpose, and such capital asset is sold, and whatever is the excess amount recovered will be considered as short-term capital gain. If there is a shortfall, that is under recovery, then it will be considered as terminal depreciation. I hope this is quite clear to you all. Okay, so I have specifically written over here applies only in case of under section 35 subsection 1 subsection 4. That means if the assessee has purchased the capital asset under section 35 subsection 2ab, and if he sells such asset before using such asset in the business, then there is no such condition. I hope this is quite clear to you all. So in other words, we can say that the government, that is the income tax department, is encouraging the assessee to start a biotech business, that is a manufacturing business of a biotechnology, or getting into the business of drugs or pharma. I hope this is quite clear to you all. Okay, so now let's revise this part, that is section 35 subsection 2ab. 150% of the revenue or the capital expenditure relating to the research of the post commencement for in-house research development facility will be allowed to the assessee. Who is the assessee? The assessee is the company, and such company is engaged in the business of manufacturing of a biotechnology or incurring expenditure in relation to research in relation to a drug and pharma, including expenditure on clinical trials or expenditure on obtaining approval from any regulatory authority and filing an application for patent. So for filing an application for patent, the assessee needs to incur certain expenditure. That all expenditure will also be allowed as deduction under section 35 subsection 2ab up to 150% other than land and building. I hope this is quite clear. So students, we are going to start with our next section, that is section 35AD, and here we are going to study specified businesses. Okay, we have come across this word specified business under the chapter known as set off and carry forward. Okay, so over there we have studied that the losses of the specified business can be set off against the income of specified business only. Okay, So which are the specified business? It is given over here in this section, that is section 35 AD. There are 15 specified business that we need to remember. Okay, you don't need to learn all these 15 names of the business. You just need to remember this acronym. Automatically you'll remember all these 15 names of the business. I hope this is quite clear to you all. So the first is hospital business, second is housing project, third is hotel business, fourth is slum redevelopment project business, fifth is slurry pipeline business, sixth is semiconductor water fabrication manufacturing unit business, seventh is cold chain facility business, eighth is cross country natural gas pipeline network business, ninth is cross country crude or petroleum oil pipeline network business, 10th is warehousing facility for agriculture product business, 11th is warehousing facility for sugar business, 12th is inland container depot business, 13th is beekeeping, production of honey and bee wax business, 14th is fertilizer plant business, 15th is development of infrastructure facility business. Okay, so if the assessee is starting with all this business, then whatever the expenditure, that is specifically capital expenditure done by the assessee for the specified business, then whatever is the capital expenditure done by the assessee for this business, it will be allowed as deduction under section 35 AD at the rate 100%. I hope this is quite clear to you all. So in order to remember this 15 businesses, there is an acronym. So what is this acronym? 3HSC W square IB FD. Okay, so how to remember this? There are 3 H's, there are 3 S's, there are 3 C's. Okay, so 3 H's, 3 S's and 3 C's. Okay, and there is 2 W. I hope this is quite clear. The first H is hospital, second H is housing project, third H is hotel, S1 is slum redevelopment project, S2 is slurry pipeline, S3 is semiconductor water fabrication manufacturing unit, C1 is cold chain facility, C2 is cross country natural gas pipeline network, C3 is cross country crude or petroleum oil pipeline network, W1 is warehousing facility for agriculture product, W2 is warehousing facility for sugar business. Okay, I stands for inland container depot, B stands for beekeeping, production of honey and bee wax, F stands for fertilizer plant, D stands for developing infrastructure facility. I hope this is quite clear to you all. So if the assessee has incurred a capital expenditure, okay, for this businesses, then whatever capital expenditure he has incurred, he will get a deduction at the rate 100% of such capital expenditure that the assessee has done. I hope this is quite clear to you all on this specified business. Okay, so there is a note 1. Let's understand note 1. 100% of capital expenditure is allowed as deduction under section 35 AD. So under this note 1, there is point number 1 which says that capital expenditure incurred prior to the date of commencement of the above business, and if such expenses, that is the capital expenses, is capitalized in the book, then whatever is the capital expense incurred by the assessee prior to the date of the commencement of the above businesses will be allowed as deduction under section 35 AD, plus capital expenditure after commencement of the above businesses is allowed as deduction under section 35 AD. So understand this in this manner over here in this blank page, that Mr. X, okay, is the assessee, wants to start a specified business, okay, and the specified business is hotel business. I hope this is quite clear to you all. So this business cannot be start on the day 1 only, okay, because if a business of hotel has to be start, first a hotel has to be constructed, okay, construction period will be there, okay, construction of hotel has to be done, and after that when the construction is completed, then the business can be commenced. So understand that over here in the previous year 2019-20, the construction of the hotel got complete and the commencement of the business began, okay, and before this period, that is before the previous year 1920, okay, the asset was getting constructed, that is the hotel was getting constructed, and the hotel construction started in the year 2017-18, okay, within 2 years the hotel got constructed, okay. During this period, assessee made capital expense on this hotel of rupees 1 crores. I hope this is quite clear to you all. And assessee purchased a land, that is also capital expenditure for this hotel only, of rupees 5 crores, okay. and other miscellaneous capital expense he did for this hotel business of rupees 50 lakhs. I hope this is quite clear. This is pre-commencement period. Okay, that is prior the commencement of business period expense. I hope this is quite clear. And all this expense are capitalized. Okay, are capitalized in the books of the assessee. I hope this is quite clear. After the commencement of the business, that is for the previous year 2019-20, the assessee made a capital expenditure, okay, of rupees 20 lakhs. I hope this is quite clear to you all. Okay, so now let's come back to our notes. Over here, let's read this much part. Okay, over here it is said that in note number 1, 100% of capital expense is allowed as deduction under section 35 AD if the capital expenditure is incurred prior to the date of the commencement of the above business, and such expenses are capitalized in the book, plus capital expense after the commencement of the business is allowed as deduction. Okay, such capital expense, if made in cash or in mode other than the prescribed mode for more than rupees 10,000, then such capital expense will not be allowed as deduction under section 35 AD. I hope this is quite clear. And capital expense does not include the cost of purchase of the land and the cost of financial instruments. In other words, the cost is not eligible for deduction under section 35 AD. So let's come over here. Here, the assessee has made the expenses prior to the commencement of the business, and here he has made the expense for the hotel, for the land, and for miscellaneous capital expense. Okay, so from this note number 1, we have studied that if the assessee purchases a land and this is the capital expense for the hotel business, then this will not be allowed as deduction under section 35 AD. I hope this is quite clear to you all. So only this expense, that is the expense for the hotel of rupees 1 crore and other miscellaneous capital expense of rupees 50 lakhs will be allowed as deduction under section 35 AD. I hope this is quite clear. And along with this prior period expense, the current period expense will also be allowed. That is, after the commencement of the business, the capital expenses made by the assessee will also be allowed as deduction under section 35 AD. Okay, so in the previous year 2019-20, the assessee has made a capital expenditure of rupees 20 lakh, that is after the business got commenced. I hope this is quite clear. So this 20 lakhs will also be allowed as deduction under section 35 AD. I hope this is quite clear to you all. So the total deduction under section 35 AD is equal to 1 crores plus 50 lakhs plus 20 lakhs. I hope this is quite clear. That is equal to 1.7 crores. I hope this is quite clear. So, for example, understand that if the assessee for the previous year 2019-20 makes a P&L account, okay, and over here the sales is of rupees say 1 crore and expense of the business which is also allowed by income tax, okay, is say rupees 50 lakhs. So the net profit as per the accounting standard will come to around 50 lakhs only, and this 50 lakhs we will take into the format for calculation of net profit as per Income Tax Act. Okay, so now come into the format book. Over here we will mention the net profit as per the books, that is equal to 50 lakhs. Let me change the color so that it will be easy for you all to identify. 50 lakhs. I hope this is quite clear. And whatever expenses has been done by the assessee is allowed by the Income Tax Act, so we don't need to add this back. Okay, but the Income Tax Act is giving an deduction under section 35 AD of rupees 1.7 crores. So this deduction we have to take in our format. Okay, so over here we will write expense as per 35 AD. Okay, and we will mention the figure of 1.7 crores. I hope this is quite clear. Okay, and this is the allowances of expense as per the Income Tax Act. I hope this is quite clear. But if you can see over here, the assessee has earned an income of rupees 50 lakh as per the accounting standard, but the income tax has given an additional deduction, okay, under section 35 AD of rupees 1.7 crores. I hope this is quite clear. So that is what we are reducing from this 50 lakhs. I hope this is quite clear. So our final net profit as per Income Tax Act will be not net profit, it will be net loss. I hope this is quite clear to us. So the net loss as per the Income Tax Act will be 1.2 crores. I hope this is quite clear to you all. And this loss of 1.2 crore can be set off against the income of specified business only. I hope you all remember this part from set off and carry forward chapter. Okay, I hope this is quite clear to you all. So let's come back to our notes over here. This all are the 15 businesses that have been specified under section 35 AD, and if the assessee is starting any of this business and if he incurs a capital expenditure prior to the date of the commencement of the above business, and if such capital expense is capitalized in the book plus the capital expense incurred after the commencement of the business is allowed as deduction under section 35 AD. Okay, and the capital expense does not include the cost of purchase of the land and the cost of the financial instrument. In other words, this cost will not be eligible for deduction under section 35 AD, and this point says that such capital expense, if made in cash or in any mode other than those mode prescribed by the Income Tax Act for more than rupees 10,000, then such capital expenditure will not be allowed as deduction under section 35 AD. I hope this is quite clear to you all. And now let's understand note number 2. Note number 2 says that if a deduction is claimed under this section, that is under section 35 AD, then no deduction will be allowed for chapter 6A, that is deduction under section 80C to 80 RRB. I hope this is quite clear, because over here in this section, that is section 35 AD, there is a huge deduction, or we can say benefit, given to the assessee. Okay, so the income tax says if such benefit is given to the assessee, then why the assessee needs one more benefit of deduction under chapter 6A. So that's why over here they have said that if a deduction is claimed under this section, then no deduction will be allowed from chapter 6A, that is deduction under section 80C to 80 RRB will not be available. I hope this is quite clear to you all. So now let's understand note number 3. Note number 3 says that such capital asset on which capital expenditure is done should be held for a minimum period of 8 years. If the assessee does the violation, that means if he sells off the capital asset before the completion of 8 years, then consideration received for sale of the asset, that is the capital asset, will be considered as business income as per section 28. I hope this is quite clear to you all. So this part specifically we have studied over here also at the very start of our chapter. Here income under the head PGPP in point number 6, which says that sales proceed of the assets of the business specified under section 35 AD will be considered as income under the head PGPP. I hope this is quite clear to you all. So now let's move back again to section 35 AD. Okay, so here in note number 3 it is said that such capital asset on which capital expenditure is done should be holded for a period of minimum 8 years. Only after a completion of 8 years then such asset can be sold. Okay, if the assessee does the violation, then the consideration received for sale of such capital asset or the asset will be considered as business income as per section 28, that is income under the head PGBP only. I hope this is quite clear. But if this asset is sold after the completion of 8 years, then how it will be taxable? It will be taxable as per the directions given under the head income from capital gain. I hope this is quite clear to you all. Okay, so I hope you all have understood it. So let's revise this section, that is section 35 AD. It is a very simple section which says that if a assessee is starting a specified business and if he is doing a capital expenditure on such specified business, then whatever capital expense is done on the specified business, it will be considered as deduction under section 35 AD. That is, whatever the amount of capital expenditure is done, 100% of this capital expenditure will be allowed as deduction under section 35 AD, provided that the capital expenditure done is not done on a land or done on a financial instrument. So what does financial instrument means? Let's understand that. Financial instrument means simply equity shares, okay, preference shares, debentures, okay, in short securities. I hope this is quite clear to you all. So basically financial instrument you will study at CA final in FR, that is financial reporting. In short, you can know it as accounts. Okay, so in accounts you will study this financial instrument. Financial instrument simply means securities. So if the assessee is making a capital expenditure and such capital expenditure is purchase of land or this financial instrument, then whatever capital expenditure is done on this both will not be allowed as deduction under section 35 AD. I hope this is quite clear. So now let's revise this section. 3 HSC W square IBFD. Okay, H stands for hospital, H2 stands for housing project, H3 stands for hotel, S1 stands for slum redevelopment project, S2 stands for slurry pipeline, S3 stands for semiconductor water fabrication manufacturing unit, C1 stands for cold chain facility, C2 stands for cross country natural gas pipeline network, C3 stands for cross country crude or petroleum oil pipeline network, W1 stands for warehousing facility for agriculture produce, W2 stands for warehousing facilities for sugar, I stands for inland container depot, B stands for beekeeping production of the honey and bee wax, F stands for fertilizer plant, D stands for developing infrastructure facility. I hope this is quite clear. So if any capital expenditure is done, then 100% of such capital expenditure is allowed as deduction under section 35 AD. Capital expenditure incurred prior to the date of the commencement of the above business, and if such capital expense is capitalized in the book plus capital expenditure is done after the commencement of the business, then it is allowed as deduction under section 35 AD. Then such capital expenditure, if made in cash or in any mode other than prescribed mode for more than rupees 10,000, then such capital expenditure will not be allowed as deduction under section 35 AD. But capital expenditure does not include cost of purchase of a land and cost of financial instrument. In other words, if a cost of purchase of a land is a capital expenditure, or if a cost of purchase of financial instrument is a capital expenditure, then such capital expenditure will not be eligible for deduction under section 35 AD. Note number 2 says that if a deduction is claimed under this section, that is section 35 AD, then no deduction will be allowed from chapter 6A, that is no deduction will be allowed under section 80C to 80 RRB. So now we'll move on to note number 3. Note number 3 says that such capital asset on which capital expenditure is done should be holded for a period of minimum 8 years. If the assessee does violation, then the consideration received for the sale of the asset will be considered as business income as per section 28. I hope this is quite clear to you all. So students, now let's move on to our next section, that is section 35 CCA. It talks about rural development, and over here I have written refer section 80 GGA also. We have already studied this section under deduction chapter, but why I have written this over here, I'll explain you, don't worry. So let's read this particulars first of all, and then I'll explain you in the layman term. Okay, if the assessee incurs the expenditure on rural development, okay, or if it donates to the institution engaged in rural development or notified urban poverty eradication fund, then deduction under section 35 CCA is equal to 100% of the actual expense. Okay, if this expense is taken into the calculation of the net profit, then it is allowed as expense. No need to add back to the net profit. But if the donation is done, then add back to the profit and claim deduction under section 80 GGA. So this is quite self-explanatory, but I'll explain you over here in this blank page. Understand that this is our assessee, Mr. A. Wait, I'll change the color of the pen. Mr. A is our assessee and he is doing a business. Okay. And this is the P&L of Mr. A. Over here sales is there of 10 lakhs, okay, and purchase is given say rupees 5 lakh, and this assessee has made a donation, or he has made a expenditure on rural development, okay, and the expenditure amount is say rupees 1 lakh rupees. I hope this is quite clear. And he has made a donation to urban poverty eradication fund, okay, and the amount of the donation is say rupees 1 lakh only, okay, and finally the net profit as per accounting standard comes to around 3 lakhs rupees. I hope this is quite clear to you all. So let's come to our notes again. Over here, what it is given is, if the assessee incurs expenditure on rural development, okay, or donates to the institution engaged in rural development or notified urban poverty eradication fund, then deduction available under section 35 CCA is 100% of such actual expenses. So basically, this is allowed, okay. This is basically allowed as per Income Tax Act. I hope this is quite clear. But this is not allowed, okay. So we need to add back this expense to the net profit, okay, and then we can take this amount which has been donated by the assessee to this urban eradication fund, okay, under section 80 GGA. Okay, this will be allowed as deduction. I hope this is quite clear to you all. So I'll show you how things will work over here. Okay, so understand this. This is the net profit as per books, okay, which is 3 lakhs. I hope this is quite clear. And since this 1 lakh that has been incurred by the assessee for the expenditure on rural development, it will be 100% allowed as per section 35 CCA. So we don't need to do anything. We don't need to add back this over here and further reduce 1 lakh rupees. I hope this is quite clear to you. So we will keep it as it is because it is 100% allowed by income tax. I hope this is quite clear. Okay, but this donation that has been made by the assessee is disallowed expense. Okay, disallowed expense, add back. So what is the expense? Donation as per section 80 GGA. So what is the amount? The amount is 1 lakh rupees. Okay, now the net profit as per income tax is equal to 4 lakhs. I hope this is quite clear to you all. Okay, and this amount which has been donated by the assessee, it will be allowed as deduction under section 80 GGA. So this 4 lakhs will be taken into computation of the total income. For example, understand this. This is computation of total income. Over here, income from salary is there, income from other sources is there. Over here, income from house property is there, income from capital gain is there, and income from PGBP is there. Okay, and all these incomes are 0 and PGBP income is 4 lakhs. I hope this is quite clear, and this will become our gross total income. I hope this is quite clear, which is equal to 4 lakhs. Okay, and this gross total income will be further reduced with the deductions under chapter 6A. I hope this is quite clear, and the deduction is available under section 80 GGA, which is equal to 1 lakh rupees. And finally, our net total income on which tax will be calculated is equal to 3 lakhs. I hope this is quite clear to you all. So how to make the treatment of the expenditure and for the donation is given under section 35 CCA if an expenditure is made for rural development or if a donation is made for the rural development. I hope you all have understood this much. Okay, so let's revise this section, that is section 35 CCA. It says that if the assessee incurs expenditure on rural development or makes a donation to the institute engaged in rural development or notified urban poverty eradication fund, then deduction under section 35 CCA is 100% of such actual expense. This is the actual expense. Okay, but if the donation is done, then we need to add back the donation amount to the profit and we need to claim a deduction under section 80 GGA. I hope this is quite clear. Okay, and what is given over here, if the expense is taken in the calculation of the net profit as per the accounting standard, then it is allowed expense. No need to add back to the net profit as per accounting standard. I hope this is quite clear to you all. Okay, I hope you all have understood this section, that is section 35 CCA. Okay, so now let's move on to our next section, that is section 35 triple C, which talks about agriculture expenditure. Let's read the particulars first and then we will understand how to deal with this particular section. Okay, section 35 CCC says that if any assessee incurs any expenditure on notified agriculture extension project as notified by CBDT, then deduction allowed is 150% of actual expenses. So let's come back to our blank page over here. Understand this. Mr. A is doing business. Okay, and Mr. A's profit and loss account is given to us. Sales, say rupees 10 lakhs, purchases, say rupees 8 lakhs, okay, and agriculture extension expense, okay, as allowed by CBDT, that is Central Board of Direct Tax, the assessee has incurred an expense of say rupees 50,000, okay, then the net profit as per accounting standard is equal to 1,50,000. I hope this is quite clear to you all. But this net profit will not be taken straight into the computation of the total income. Okay, we will calculate the net profit as per the Income Tax Act. So we will calculate over here net profit as per books. Okay, over here we will write 1,50,000. Okay, and then we will add back disallowances. Okay, so basically what does this section 35 Triple C says that if any assessee incurs an expenditure on notified agriculture extension project as notified by CBDT, then deduction allowed is 150% of actual expenses. 150% of the actual expenses. Okay, so let's come to our blank page over here. We will add back the disallowances, that is the agriculture expense as per CBDT of rupees 50,000. Okay, and we will get an amount of rupees 2 lakh. Okay, and further we will reduce allowances of expense as per Income Tax Act. Over here we will mention section 35 Triple C. Okay, that is agriculture expense, and how much this agriculture expense will be allowed, 50,000 into 150%. Okay, so which is equal to 50,000 into 150%, 75,000. I hope this is quite clear. So the allowances of expense as per the Income Tax Act is 75,000. Therefore the net profit as per Income Tax Act is equal to 1,25,000. I hope this is quite clear. I hope now you know how to deal with this kind of section, that is section 35 Triple C, and where a deduction is given of 150%. Firstly we need to add back that 100% into the net profit, and then we need to reduce allowances as per Income Tax Act. Okay, and we need to find out 150% of that actual expense, and that will be reduced. I hope this is quite clear to you all. Okay students, so now let's move on to our next section, that is section 35 CCD, development of a skill. Okay, if the assessee is a company, here specifically it is for a company. Okay, over here if the expense is incurred by any normal assessee, that is individual also, okay, then this deduction under section 35 CCA and deduction under section 35 CCC will be allowed to the assessee, but the deduction under section 35 CCD will be allowed only to the assessee which is a company. I hope this is quite clear to you all. Okay, so let's understand the particulars given under this section. If assessee is a company and if the assessee incurs expenditure on the skill development other than the land and building, okay, and such expenditure is done on the notified skill development project, okay, then the deduction allowed is 150% of the actual expense. I hope this is quite clear to you all. So now let's come to a blank page over here. Understand that there is a ABC Limited, okay, and the profit and loss of the ABC Limited is as follows. Okay, sales 10 lakhs, purchases 6 lakhs, okay, and skill development expense is of rupees 1 lakh. I hope this is quite clear to you all. And the net profit as per accounting standard is 3 lakhs. I hope this is quite clear to you all. Okay, so we will calculate the net profit as per the Income Tax Act now. Net profit as per books is equal to 3 lakhs. I hope this is quite clear. Add disallowances. Okay, so as per section 35 CCD, if a company incurs an expenditure on notified skill development project, then the deduction available is 150% of the actual expenditure. So firstly, this expenditure that has been done by ABC Limited will be added back to the net profit. I hope this is quite clear. So we are adding back that expense. Skill development expense of 1 lakh. I hope this is quite clear to you all. So it comes to around 4 lakh now. And further, now we will reduce less allowances of expense as per Income Tax Act, and we will mention the section, that is section 35 CCD, and over here we will calculate 1 lakh into 150% is equal to 1.5 lakh, that is 1,50,000. Therefore, the net profit as per the Income Tax Act is 2,50,000. I hope this is quite clear to you all. Net profit as per Income Tax Act. I hope this is quite clear. I hope by now you all have understood how to interpret this deduction if it is given 150% of the actual expenses. I hope this is quite clear. But if the question says that if the deduction is allowed 100%, then whatever expense that has been actually reduced in the calculation of the net profit as per accounting standard will be allowed by the income tax. I hope this is quite clear. But if 150% or 175% or 200% deduction is given by the income tax, what we have to do is we have to firstly add back that 100% of the actual expenses as disallowances, and then further we have to make an allowances as per the Income Tax Act, and then we have to calculate 150% or 175% or 200%. I hope this is quite clear. So 175% and 200% was just an example. Over here we have studied 150%. Okay, so I hope you all have understood this sections also. Okay, so now let's move on to the next page. The next section is section 35 DD. DD stands for amalgamation or demerger expense. Okay, so when a company gets amalgamated or gets demerged, there is certain expenses, that is legal cost, okay, as well as consultancy cost. So all this cost will also be allowed as deduction. Okay, that is, this expenses will be allowed as expense as per section 35 DD. So let's understand the particulars now. Okay, deduction to only company for this expense relating to amalgamation and demerger. So quite self-explanatory. Only companies are getting amalgamated and demerger. Okay, and the sole proprietor or a partnership firm get converted. They do not get amalgamated or demerger. I hope this is quite clear. Then the deduction under section 35 DD will be available in this manner. So whatever is the cost of amalgamation and demerger, for example, the cost of amalgamation and demerger is given in the question as say rupees 5 lakh. Okay, and this 5 lakh has been taken into the profit and loss account. Okay, profit and loss account, and the net profit is calculated on this basis. Okay, I hope this is quite clear. So what does income tax says? As per section 35 DD, whatever is the expense, that is the amalgamation or demerger expense, in our case it was say rupees 5 lakh. This 5 lakh will be divided by the 5, whatever amount will come, that is 1 lakh. This 1 lakh will be allowed as deduction for each previous year up to 5 previous year. I hope this is quite clear to you all. Don't worry if you have not understood this part. I'll explain you over here in the blank page. Understand that this is a company ABC Limited. Okay, ABC Limited is getting amalgamated. Okay, and the cost of amalgamation is say rupees 5 lakhs. I hope this is quite clear. So in this profit and loss account, they have taken this 5 lakhs. Okay, so I'll show you how this will be given in the exam. 10 lakhs is the sales. Okay, and if purchases is say rupees 2 lakhs, and this demerger this amalgamation cost is 5 lakhs, then the net profit as per the profit and loss account will be equal to 3 lakhs. I hope this is quite clear to you all. Okay, so will this amount be taken into computation of the total income? The answer is no. We will calculate. Okay, so what we will calculate? We will calculate net profit as per the Income Tax Act. So net profit as per books is equal to 3 lakhs. I hope this is quite clear to you all. And then we will add disallowances. So basically this amalgamation cost of rupees 5 lakh is 100% disallowed. Okay, so we will write it over here 5 lakhs. Okay, 3 lakhs plus 5 lakhs will be equal to 8 lakhs. Okay, on this 8 lakh there will be further reduction of allowances of expense as per Income Tax Act. So what does Income Tax Act say as per section 35DD? Whatever is the demerger expense, so this is the demerger or amalgamation expense, so this is equal to 5 lakh. Okay, of this 5 lakh, 1/5 will be allowed to the assessee each year for 5 previous year, including the current previous year. I hope this is quite clear. So that means the deduction allowed under section 35DD will be 5 lakhs into 1:5 is equal to 1 lakh. Okay, in the previous year, and it will be allowed for 5 previous year, including the current previous year of 2019-20. I hope this is quite clear to you all. So now the net profit as per Income Tax Act is equal to 7 lakhs. I hope this is quite clear to you all. So that is what is given in this small section, that is section 35DD, amalgamation or demerger expense. Deduction to only companies for expenses relating to amalgamation or demerger. Deduction for each previous year up to 5 previous year, including the previous year 2019-20 in which the demerger or amalgamation has taken place. I hope this is quite clear. So how much will be the deduction? Deduction will be equal to 1/5 into the cost of amalgamation or demerger. I hope this is quite clear to you all. So I hope you all have understood this much. Okay, before understanding this section, one more thing I want to explain you about this section 35DD. Many of the time I have seen in the study material or any other scanners, okay, what they do is, over here maximum deduction that will be allowed under section 35DD is 1/5. Okay, so what they do is they only add 4/5 of the amount. That means over here we have added entire 5 lakh, right, disallowances. So what they do is, in the scanner or the study material, they add only 4 lakh rupees, that is the net of this two amount. So what they do is, they know that since it is the first year, they only calculate this much, 1/5. Okay, and 1/5 of 5 lakh is equal to 1 lakh. Okay, so that means this 1 lakh is only deduction allowed for the previous year 2019-20. I hope this is quite clear. But they do not do this step. What they do is they do the net step, that is they write over here 4 lakhs, and over here in the calculation they mention 4/5. Okay, disallowances is 4/5. So that is also right, but if you follow one particular format, that will be very uniform for you and you will not make mistakes. Okay, if you will do some method in some sums and some different method in other sums, then things will become little difficult for you when you are revising stuff. Okay, so always follow a uniform method, that if this cost is there, this cost will be 100% firstly disallowed. Okay, and then we will find out the cost that will be allowed. I hope this is quite clear to you. Okay, so now let's understand our next section, that is section 35 DDA VRS, that is voluntary retirement scheme expense. Okay, so deduction is allowed to any assessee. It is not specific for company. This expense is allowed to any assessee if the assessee, that is the person who is running the business, okay, incurs VRS expenses. Then how this VRS expenses will be allowed in calculation of the net profit as per Income Tax Act is given over here in this section, that is section 35 DDA. Deduction to any assessee. Deduction for each previous year up to 5 previous year is equal to 1/5 into such expense. I hope this is quite clear, and now you know how to calculate this. Okay, because we have seen over here in section 35 DD. I hope this is quite clear. So basically remember that if a PNL is given, okay, and in that VRS expense is mentioned, okay, and whatever is the VRS expense, it will be 100% firstly disallowed. So we need to add it back to the net profit, and then we need to reduce allowances as per Income Tax Act. I hope this is quite clear to you all, and whatever will be the allowances of the expense that the income tax is giving, we need to write it over here, and then we will find out our net profit as per Income Tax Act. I hope this is quite clear to you all. So now let's move on to our next section, that is section 35 preliminary expense. So what does preliminary expense means? Understand this. Preliminary expense means the expense incurred by the assessee for incorporation of a company, okay, or any expenses related to a project, that is known as preliminary expenses. In short, it can be known as initial expense to start any work, okay, to start any work. But majorly preliminary expenses means expenses incurred by the assessee for formation of a company or formation of any legal thing. Okay, I hope this is quite clear to you all. So deduction is allowed for 5 previous year, which is equal to 1/5 into lower of the following. So lower of the following means actual cost of preliminary expenses or the maximum allowed. So what does maximum allowed means? Maximum allowed means if the assessee is a company, then 5% of the cost of the project for which preliminary expense has been incurred, or 5% of the capital employed. Okay, what does capital employed means and what does cost of project means? It is given over here. Okay, we will understand that. Okay, so whichever is the higher, that is 5% of the cost of the project or 5% of the capital employed, whichever is higher will be taken over here, and whichever will be lower, that is the actual preliminary expense or the maximum allowed, whichever is lower, we will consider over here and divide it by 5, and whatever the amount will come, that will be allowed as deduction under section 35. So in short, whatever the preliminary expense is mentioned in the P&L account, okay, on this side, okay, on the debit side, that preliminary expenses will be simply added back to the net profit. I hope this is quite clear to you all. Okay, so now let's understand what does cost of project means. Cost of project is equal to actual cost of a fixed asset or a land and building or a leasehold premises or a plant and machinery or a furniture or a fixture as on the last date of the previous year. I hope this is quite clear to you all. And what does capital employed means? Capital employed means aggregate of issued share capital plus debentures and long-term borrowing as on the last date of the previous year. Don't worry, this kind of a sum will maximum come for MCQ. If this kind of a sum comes for MCQ, they need to provide you the details of cost of capital as well as capital employed. But you need to be aware of these things, that on this 5% you have to calculate, and whichever is higher of this two, you have to take it over here and you have to compare it with actual preliminary expenses. Whichever will be lower will be considered over here and it will be divided by 1/5, and whatever is the amount of the 1/5 will be allowed as deduction, and this deduction will be allowed for 5 previous year, including the previous year 2019-20. I hope this is quite clear to you all. So here we have studied about the company. What about others? That means normal assessee. Okay, that means individuals. If they do a preliminary expense in their P&L account, so how we have to deal with it? So over here, maximum allowed, we will calculate as per this, that is 5% of the cost of project. Okay, and over here we will consider that and we will compare it with the actual preliminary expense. Whichever will be lower, we will consider it over here, and 1/5 of this will become the deduction for the previous year 2019-20, and this deduction, whatever the amount has derived, will be allowed for 5 previous year, including the previous year 2019-20. I hope this is quite clear to you all. So what does preliminary expense includes? Preliminary expense include project report expense, survey report expense, management report expense, feasibility report expense, legal expenses, MOA and AOA expense, that is memorandum of associates expense, articles of associate expense. These expenses are incurred by the assessee when a company is been incorporated. Okay, and share issue expenses, market survey expenses, fees for registration of the company. I hope this is quite clear. This all are very simple sections. Okay, so let's revise this section, that is section 35, preliminary expense. Deduction will be allowed for 5 previous year. Okay, and deduction will be allowed in this manner: 1/5 of the lower of the following, that is actual expenses or maximum allowed. Actual expenses means actual preliminary expenses. What does maximum allowed means? Maximum allowed in case of a company is 5% of the cost of the project or 5% of the capital employed, whichever is higher. In case of other, the maximum allowed is equal to 5% of the cost of the project. What does preliminary expenses means? Preliminary expense means project report, survey report, management report, feasibility report, legal expense, MOA and AOA expense, share issue expense, market survey expense, fees for registration of a company expense. So this all are also expense only. I hope this is quite clear. What does cost of project means? Cost of project means actual cost of fixed asset, land and building, leasehold premises, plant and machinery, furniture, fixtures as on the last date of the previous year. And what does capital employed means? Aggregate of the issued share capital plus debentures and long-term borrowing as on the last date of the previous year. I hope this is quite clear to you all. Okay. Okay students, so now let's move on to our next section, that is section 36, specified deduction. So from now onwards there are all easy sections pending. Okay, So this will not take much time. Don't worry about this. This all are very simple section. Okay. So let's start with section 36. There are number of line items given under this section. So that's why over here it is written specific deduction. I can't explain you what is given under this section 36. We need to understand each line item to understand this section 36. I hope this is quite clear. So let's understand the first line item. The first line item says that insurance premium paid for or against the risk of distribution or damage of the stock, then whatever the premium has been paid by the assessee and taken in the P&L account on the debit side, okay, this insurance premium will be allowed as expense as per Income Tax Act. I hope this is quite clear to you all. Okay, so let's come into a blank page. Over here, understand that this is the P&L account of the assessee. Over here, insurance premium expense has been taken for the calculation of the net profit, and this insurance premium amount is 10,000. Okay, and this insurance premium is paid for the insurance of stock. Okay, this will be allowed as expenses and this will not be add back to the net profit for calculating net profit as per Income Tax Act. I hope this is quite clear. So this is what is given over here in this section 36, which says that if the insurance premium is paid for or against the risk of destruction or damage of the stock, then whatever the insurance premium is paid for the stock, it will be allowed as expenses. Okay, it will not be disallowed and will be added back to the net profit. That is net profit as per accounting standard. I hope this is quite clear to you all. The second line item says that if the insurance premium is paid by the Federal Milk Cooperative Society on the life of the cattle, that is the cow or buffalo, okay, then whatever the insurance premium has been paid by this Federal Milk Cooperative Society on the life of this cattle will be allowed to this assessee as expense under Income Tax Act. I hope this is quite clear now. So let's revise this first 2 points. First point says that if the insurance premium paid for or against the risk of the destruction or damage of the stock, then whatever the insurance premium has been paid by the assessee, it will be allowed as expense. Then point number 2 says that if the insurance premium is paid by the Federal Milk Cooperative Society on the life of the cattle, then whatever the insurance premium has paid by this Federal Milk Cooperative Society, it will be allowed as deduction. I hope this is quite clear. But for example, if the insurance premium is paid by the assessee, that is an individual, okay, he is not Federal Milk Cooperative Society, okay, and he has paid the insurance premium for the life of the cattle, then whatever insurance he has paid for the life of the cattle will not be allowed as expense as per Income Tax Act. I hope this is quite clear to you. In other words, this insurance premium paid by this assessee will be added back to the net profit as per accounting standard, that is net profit as per books. I hope this is quite clear to you all. Okay, so now let's move on to point number 3. Point number 3 says that deduction for livestock is equal to cost minus sales value / scrap value. Deduction is available in the year in which the animal has become useless or they are dead. So for this we need to come to the blank page over here. Understand that this is our assessee. Okay, this assessee is involved in livestock business. Okay, so that is, for example, understand that he has a dog and this dog does some services, okay, and against this dog services this assessee receives money. I hope this is quite clear. So basically this dog is the livestock of this assessee, okay, and since the dog has a certain age, okay, for example, understand that the dog's age is certain of 10 years, okay, after the dog is completely grown, after he is matured, 10 years is the age of this dog in this livestock business. I hope this is quite clear to you all, okay, and the assessee will calculate the P&L account, okay. So while calculating the P&L account, what does this assessee does is he writes over here livestock cost, okay, that is, for example, if this dog has been purchased by this assessee for say rupees 10,000, okay, and the age of this dog is 10 years, then he divides it by 10 and finds out this 1000, and it becomes his livestock cost, and he mentioned this over here. Okay, so income tax says that this cost that you have taken in the calculation of the net profit is not allowed as per income tax act. Okay, so how the livestock cost will be allowed? The livestock cost will be allowed in this manner: when this livestock, that is the dog, where is this dog age has reached and he is being relieved of his service, or he is dead, then livestock cost will be calculated in this manner. Cost of acquisition, that is the cost at which the dog was purchased, that is 10,000. We will write over here 10,000, and further it will be reduced by the scrap value. It sounds little odd, scrap value for the living thing, but this is what is given in the income tax act. I have not made it, so that's why I'm just quoting it: scrap value or value of the dog or the livestock. I hope this is quite clear. So for example, the cost of acquisition is 10,000 and the scrap value is say 1,000. So this is equal to 9,000. So this 9,000 will be allowed in the year when such dog is dead or been relieved. I hope this is quite clear to you all. So that is what is given over here in section 36 point number 3, that deduction for the livestock is equal to cost of acquisition minus sales value or scrap value. Okay, deduction is available in the year in which the animal has become useless or they are dead. Useless means they have been relieved. Okay, I hope this is quite clear. I hope you all have understood this. Okay, so simply we will add this one in this net profit. Okay, and there will be no deduction. Okay, but in the year when the dog has been actually relieved or dead, that time the assessee will get entire 9,000 deduction, that is entire 9,000 expense. I hope this is quite clear to you all. So that is what is explained over here. Let's move on to next line item, that is point number 4, says that bonus or commission is allowed on paid basis as per section 43B. So let's understand first of all section 43B, and then again we will come on to this section 36. Okay, so over here section 43B is given. Section 43B can be remembered as paid basis, and the acronym to remember all this line item is B Tuckly R. Okay, it sounds little odd, B Tuckly R. Okay, BTCLIR. Okay, so if the assessee, that is this assessee who is having a business, okay, and he is paying bonus or commission to his employees or any person, okay, so basically this commission and bonus will become the expense of the assessee. Okay, and this bonus and the commission will be allowed as expense by the income tax act only when this bonus and expense are actually paid by the assessee. I hope this is quite clear to you all, and there is a time limit up to which the assessee can pay. Okay, so let's read the note. The note says that above payment will be allowed if the payment is made before the due date given under section 139 subsection 1. For simplicity, I have written the date, that is up to 31st July 2020. So remember this, if this is the assessee and this assessee had paid bonus, okay, and he has just passed a book entry, okay, a book entry in P&L account, and he has not actually paid it. But in order to claim this expense, what does income tax says under section 43? In order to claim this expense of bonus and commission, the assessee has to actually pay such expense. Okay, even if he has passed the book entry, it will not be allowed. Okay, so that is what is given in the notes. Above payment will be allowed if the payment is made before the due date given under section 139 subsection 1, that is up to 31st July 2020. That means the time limit to pay this bonus and commission has been given to this assessee up to 31st July 2020. I hope this is quite clear to you all. This is the due date for individual. For the sake of simplicity, I have given the due date of individual. We have understood this bonus and commission. So let's understand point number 2, that is T point. It says that taxes to the government. If the assessee is there and if this assessee has made a book entry of this taxes, okay, and he has not actually paid this expenses to the government, okay, then this expense will not be allowed as expenditure under Income Tax Act. But if this taxes are paid to the government up to the date of 31st July 2020, then such expenses will be allowed as per Income Tax Act. I hope this is quite clear. But if it is not paid up to 31st July 2020, what will be the treatment? This bonus and commission will be added back to the net profit. I hope this is quite clear to all. In order to calculate net profit as per Income Tax Act, I hope this is quite clear. So basically, why this section came into picture, earlier the practice done by the assessees were, they used to make a book entry, okay, and they used to inflate, that is they used to increase their expenses, and if the expenses are increased, that means automatically net profit will reduce and automatically they will need to pay less taxes. I hope this is quite clear. So government said that do not do this mischief, we know you are doing this mischief, that's why they have brought up this section that only if you actually pay, okay, only if you actually pay, then only these expenses will be allowed. Earlier this assesses what they used to do was they used to pass a book entry, okay, and after 2 to 3 years they used to write off this book entry, okay, and they used to fool the government. So after this section it has become very difficult to fool the government by doing all such activities. I hope this is quite clear. So we have understood B as well as T, okay. Now let's understand C. Contribution to approved fund, that is employer's contribution to the provident fund as well as to the gratuity. If the employer is making a contribution to the approved fund and if he is claiming the expense for such contribution to the approved fund, then such will be allowed only if it has been actually paid, and if it is actually paid before 31st July 2020, then only these expenses will be allowed. I hope this is quite clear to you all. Then the next is leave encashment salary. If the assessee is paying the leave encashment salary, and if this leave encashment salary is actually paid, and if it is actually paid before 31st July 2020, then only this expense will be allowed. I hope this is quite clear. Okay, so now let's understand this point number 5, that is point I, which says that if interest on business loan is taken from public financial institution or state financial corporation or state industrial investment corporation or a scheduled bank or a NBFC, that is a non-banking financial corporation, then the interest will be allowed only on paid basis. That means actual interest has to be paid by the assessee in order to claim these expenses. Otherwise, this will be added back to the net profit. I hope this is quite clear. But if the assessee has paid this interest before the due date, that is up to 31st July 2020, then the expenses which have been claimed in the profit and loss account will be allowed as per Income Tax Act. I hope this is quite clear to you all. Let's understand point R. Point R says that railway expenditure for using its asset. Okay, so basically if a railway asset is used by the assessee for some work, okay, then only if the assessee makes the payment to the railway for such use, then only it will be allowed as expense. I hope this is quite clear to you all. Okay, that means if the assessee is there, okay, and he has made a book entry for this railway expenditure and he has not actually paid it, okay, then it will be added back to the net profit. I hope this is quite clear. But if he makes the payment of this railway expenditure, okay, up to 31st July 2020, then the expense which has been taken in the profit and loss for this railway expenditure will be allowed as deduction. I hope this is quite clear to you all. So over here the note says that above payment will be allowed if the payment is made before the due date given under section 139 subsection 1, that is up to 31st July 2020. Okay, so our financial year, that is our previous year, was 2019-20, but there is more 6 months time is given. Okay, so that is what this date is, 31st July 2020, that is up to the due date of filing the return. Okay, if you have paid for all these expenses that you have made in your P&L account, then only it will be allowed as expenses. I hope this is quite clear. I hope you all have understood this. Let's revise this section, that is section 43 subsection B. section 43B, that is paid basis, B Takli R. Okay, bonus and commission, taxes to the government, contribution to approved fund by the employer, leave encashment salary, interest on bank loan taken from public financial institution, state financial corporation, state industrial investment corporation, scheduled bank, NBFC, that is non-banking financial corporation, then the interest will be allowed on paid basis. And if the railway expenditure is done for using its asset, then also paid basis will apply. That is, the above has to be paid, okay, then only it will be allowed as expenses. And even if it is paid up to the date of filing return as per under section 139 subsection 1, that is up to 31st July 2020, then the expenses will be allowed as expenses as per Income Tax Act. I hope this is quite clear to you. So now let's come back to our section, that is section 36. Okay, over here we have studied point number 1, point number 2, point number 3, and for point number 4 we went to this section, that is section 43B. So what is given over here? Bonus or commission is allowed on paid basis. That means if the bonus or commission is not actually paid, then what is the treatment? We need to add this bonus or commission to the net profit as per accounting standard. I hope this is quite clear to you. That means we need to add back this bonus or commission. I hope this is quite clear. Then the next point is interest on borrowed capital. So if the assessee has taken a loan and if he is paying interest on the borrowed capital, then how it will be allowed? Let's understand it. If the loan is taken from public financial institution, that is PFI, state financial corporation, that is SFC, and state industrial investment corporation, that is SIIC, and scheduled bank, that is SB, plus cooperative bank, then it will be allowed on paid basis. That means this interest will be allowed on paid basis. That is what we have studied in B Takli, right? We have studied over here I. In that we have studied if interest is paid by the assessee and if such interest cost is taken in the calculation of the net profit in the P&L, okay, then such interest will be allowed as expenses if it is been actually paid, that is allowed on paid basis as per section 43B. I hope this is quite clear. But if the loan is taken from otherwise than this people, then the interest on such borrowed capital will be allowed on accrual basis. So what does this accrual basis means? Accrual basis simply means book entry, okay. So even if this is a book entry and if the assessee has taken the loan from this other person other than this people, then even if the book entry has been passed by the assessee, it will be allowed as expenses. I hope this is quite clear to you all. So you need to remember this, okay. In the question, the examiner will provide you with this P&L account, okay. Over there they will write interest expenses. So you have to verify whether the loan has been taken from this people. If it has been taken from this people, then such interest will be allowed only if it is actually paid. I hope this is quite clear. Actually paid up to 31st July 2020. I hope this is quite clear to you all. So let's move on to the next line item, that is point number 6. Point number 6 says that health insurance premium paid by the employer for the employee in any mode other than cash to a general insurance company, GIC stands for General Insurance Company, approved by the central government or policy approved by IRDA, okay, then whatever is this health insurance premium paid by this employer, it will be allowed as expenses. I hope this is quite clear and quite self-explanatory. So let's read this point number 6. If a health insurance premium is paid by the employer for the employee in any mode other than cash to general insurance company approved by central government or policy approved by IRDA, then such health insurance premium paid by the employer, that is the assessee, will be allowed as expense. I hope this is quite clear to you all, okay. And GIC simply means General Insurance Company. For example, LIC is a general insurance company or a policy approved by IRDA. I hope this is quite clear to you all, okay. So now let's move on to the next point, that is point number 7. Point number 7 says that employer's contribution to the approved funds, okay. If the employer is making a contribution to a recognized provident fund or an approved superannuation fund or an approved gratuity fund, then such expenses made by the employer will be allowed on paid basis under section 43B. I hope this is quite clear to you all. But if the employer contributes to the approved fund, which is a pension scheme mentioned under section 40A, subsection 9 as per section 80 CCD, then up to 10% of the basic salary plus dearrence allowances only is allowed, and 14% if the government is the employer. I hope this is quite clear. We have already studied this part under deduction, that is 80 CCD. I hope this is quite clear to you all. Okay, so you know what we have to do over here. So the last part we will read now. If the employer makes a contribution to the approved fund otherwise, that means otherwise than this, then it will be completely taxable. Then it will not become approved fund. That will be simply employer's contribution to otherwise than this approved funds. Then it will be taxable. I hope this is quite clear. Let's revise this point number 7. Point number 7 says that employer's contribution to the approved fund, that is recognized provident fund or approved superannuation fund or approved gratuity fund, then it will be allowed on paid basis as per section 43B. But if the employer is contributing to the approved fund, that is the pension scheme, as mentioned under section 40A subsection 9 as per section 80 CCD, then up to 10% of the basic salary plus dearrence allowances is only allowed as expense. I hope this is quite clear. Over and above, if paid by the employer, it will be disallowed. That means it will be added back. I hope this is quite clear. Added back. And if the employer is contributing to otherwise than this approved funds, then it will be completely taxable. That means whatever the employer has contributed, it will be added back to the net profit. So if you want, I'll write it over here. Added back to net profit. I hope this is quite clear to you all. Okay, so the next point is point number 8. It talks about bad debts. Okay, so this is very common. You have many of the times seen in the P&L account, in the debit side there is a bad debt. Okay, and this bad debt is write off as an expense. I hope this is quite clear. So is it allowed as per Income Tax Act? So that is the question. We will understand it with the help of this chart. Okay, so let's understand this. If there is a bad debt and the bad debt is related to goods or services and such bad debts are to be written off as irrecoverable, then it is allowed as deduction. I hope this is quite clear to you all. Okay, but if the bad debts is related to money, okay, and money which is for the normal business, then it is not allowed. For example, understand that the assessee is there. Okay, this assessee is running a business. Okay, and this assessee has given a loan, okay, to a person. Okay, and this person took this loan and ran away. So basically the loan given by the assessee is now bad debt. Okay, so this bad debt of money will not be allowed as expense. I hope this is quite clear to you all. But if such bad debt occurs when the assessee is in the money lending business, then such bad debt expense is allowed. I hope this is quite clear. So let's understand this bad debt chart once again. If there is a bad debt and such bad debt is related to goods and services, and if such bad debts are going to be write off as irrecoverable, then it is allowed as deduction. That means if this bad debt is mentioned in this P&L account, then it will be allowed as expenses. It won't be added back. I hope this is quite clear to you all. Okay, but if the bad debts are related to money and the assessee is not in the money lending business, he is in normal business, then whatever the bad debt he has incurred on such money will not be allowed as expenses. But if the assessee has incurred a money bad debt and such assessee is in the money lending business, then such bad debt will be allowed. That means it won't be added back. I hope this is quite clear to you all. Okay, so now let's move on to next point, that is point number 9. Point number 9 says that family planning expense only for the company. Okay, so if this family planning expense is mentioned in the P&L account, okay, and this family planning expense is mentioned in the P&L account of the assessee who is an individual, okay, who is an individual, then straight away whatever the family planning expense he has mentioned in this P&L account, we need to add back to the net profit, because family planning expense is allowed only for the companies. I hope this is quite clear to you all. And at your inter level, there are hardly questions going to be asked on company. Okay, so this point particularly is for the company. I hope this is quite clear to you all. Okay, if the family pension expense is incurred by the company, okay, and such family planning expense is a revenue expenditure, then it is allowed. Okay, that means such expenses will not be added back by the company in the net profit. I hope this is quite clear. But if such family planning expense is done by the company and such family planning expense is a capital expenditure, then this capital expenditure will be allowed as deduction under section 36 in this manner, that is 1/5 of the capital expenditure up to 5 years. I hope this is quite clear. That means whatever will be the capital expenditure, okay, that has been mentioned in the P&L account, okay, of the company, it will be forcibly added back to the net profit, and then only 1/5 of the capital expenditure will be allowed. I hope this is quite clear to you all. Okay, so let's revise this point number 9. Point number 9 says that family planning expenditure only for the company, and if such family planning expenditure is a revenue expenditure, it is 100% allowed to the company. Okay, so it won't be added back to the net profit. But if such family planning expense is a capital expenditure, then such expense firstly will be added back to the profit, and the calculation will be done for deduction under section 36, and it will be calculated in this manner: 1/5 of the capital expenditure up to 5 years. That means this capital expenditure will be allowed for 5 years, including the previous year 2019-20. I hope this is quite clear to you all. So now let's move on to the next point, that is point number 10, which says that if STT is paid, that is security transaction tax is paid by the assessee, then it is allowed as expense. I hope this is quite clear to you all. And the 11th point says that if CTT, that means commodity transaction tax, has been paid by the assessee, then it is allowed as expense. And if the assessee is engaged in the speculation business, then it is allowed. I hope this is quite clear to you all. Okay, so now let's move on to the next page. Okay, over here more 2 line items are given. We will understand that, and then we will revise this entire section, that is section 36. I hope this is quite clear to you all. So point number 12 says that provision for bad debts and doubtful debt. So many of the times we have seen that in our P&L account, on the debit side we write provision for bad debts. I hope this is quite clear to you. So whether this provision amount will be allowed as expenses by the Income Tax Act, that is what we are going to study with the help of this chart. Okay, so provision for bad and doubtful debt, if this provision is created by a bank or a cooperative bank, then up to 8.5% of the gross total income before this deduction, that is before the deduction of this provision, plus 10% of the aggregate average rural advance will be allowed as expense. Okay, I hope this is quite clear to you all. Any expense above this amount will be added back to the net profit. I hope this is quite clear to you all. Similarly, if the provision for bad and doubtful debt has been created by a foreign bank or a public financial institution or a state industrial investment corporation or a state financial corporation, then 5% of a gross total income before deduction of this provision, okay, will be allowed as expense. I hope this is quite clear. Over and above this amount, it will be added back to the net profit. I hope this is quite clear to you all. Okay, and similarly, if the provision for bad and doubtful debt has been created by NBFC, then also 5% of the gross total income before this deduction will be allowed as expense. Any expense above this amount will be added back to the net profit. I hope this is quite clear to you all. Okay, so now let's move on to our next point, that is point number 13. This particular point will basically not come at your level, but you need to understand this. Okay, point number 13 says that discount on zero coupon bonds. Okay, so basically companies issues zero coupon bonds. Okay, and company also charges in their P&L account cost of this zero coupon bonds. Okay, so whatever they have charged over here, we have to add back to the net profit. Okay, and we have to calculate the discount on the zero coupon bonds as per this format. Okay, if the zero coupon bonds are issued on 13th September 2018 and there are 1000 bonds and the issue value is 50,000 and the life is 5 years. Okay, and the redemption value is 100, that is 10,000 into 100. Okay, so let's calculate the discount. Firstly, the discount is 50 rupees, the issue price is 50 and the redemption is 100. So the difference between these two is 50. So this discount will be allowed as expenses in this manner. So the discount is equal to 10,000 bonds into the discount value, that is equal to 50, which is equal to 5 lakh. Okay, and the redemption date is after 5 years, that is 12th September 2023, and it will be calculated in this manner. Okay, so the discount per month is equal to 5 lakh divided by 60 months. Okay, it is equal to 8,333. Okay, and for the year 2018-19, the discount that will be allowed is 7 months into 8333. I hope this is quite clear. For the previous year 2019-20, the discount that will be allowed is 12 months into 8333. I hope this is quite clear. So this is how we have to calculate the discount on the zero coupon bonds. Okay, and over here part of the month will be considered as whole month. I hope this is quite clear to you all. So basically this is a part of the month, this is considered as full month, and over here also this is part of the month, it is considered as full month. I hope this is quite clear to you all. Okay, so we have completed section 36 special deduction. Let's revise this. Okay, if the assessee has incurred an insurance premium expense for the risk of destruction or damage of the stock, then such expenses is allowed by the income tax. If the insurance premium is paid by the Federal Milk Cooperative Society on the life of the cattle, then whatever the insurance premium has been paid, it will be allowed as expenses by the Income Tax Act. In point number 3, it has been said that deduction for the livestock will be calculated in this manner: cost of acquisition of such livestock minus sales value or scrap value. Whatever the value will be coming over here, it will be considered as cost of the livestock under section 36. That is deduction for livestock under section 36. I hope this is quite clear. Deduction is available in the year in which the animal has become useless or they are dead. I hope this is quite clear. Fourth point says that bonus or commission is allowed as paid basis. That is, fourth point says that bonus or commission expense, if taken into the P&L account, then such expenses are allowed only on paid basis as per section 43B. Okay. Point number 5 says that interest on borrowed capital, if the loan has been taken from public financial institution or a state financial corporation or a state industrial investment corporation or a scheduled bank plus cooperative society, then the interest on this loan will be allowed only on paid basis as per section 43B. Otherwise, that means if the loan has been taken other than this people, then it will be allowed on accrual basis. I hope this is quite clear to you. Point number 6 says that if an health insurance is paid by the employer for the employee in any mode other than cash to general insurance company approved by central government, that is LIC, or policy approved by IRDA, then whatever the insurance, that is the health insurance premium paid by the employer, it will be allowed as expense in this P&L account as per Income Tax Act. I hope this is quite clear to you all. 7 point says that employer's contribution to approved funds. Okay, if the employer has made a contribution to a recognized provident fund or a approved superannuation fund or a approved gratuity fund, then the expense that the employer has incurred will be allowed as paid basis as per section 43B. I hope this is quite clear. But if the employer has made a contribution to the approved fund, that is a pension scheme mentioned under section 40A subsection 9 as per section 80 CCD, then up to 10% of the basic salary plus dearance allowance is only allowed. And in case of a government employer, that means this employer is a government, then 14% of this basic salary plus dearance allowances is allowed. Okay, over and above of this amount, whatever the expense has been taken by the employer in the P&L account, it will be added back. I hope this is quite clear to you all. Okay, and if the employer contributes to the approved funds otherwise than this, then it will be taxable. That means such expenses, if taken into the P&L account, it will be added back to the net profit. I hope this is quite clear to you all. Point number 8 says that bad debt, if a bad debt is related to goods and services and such bad debts are going to be written off as irrecoverable, then it is allowed as deduction. That means it is allowed as expense in this P&L account. I hope this is quite clear to us. But if this bad debt is related to money and such bad debt is related to money lending business, then whatever is the bad debt of the money will be allowed as expense in this P&L account. I hope this is quite clear. But if this bad debt is related to money and such money bad debt is from a normal business, then such bad debt of the money will not be allowed in the P&L account. That means it will be added back to the net profit. I hope this is quite clear to you all. Point number 9 says that if a family planning expense is done by the company, then if it is a revenue expense, it is allowed. That means if it is taken into the P&L account, then it will not be added back to the net profit. I hope this is quite clear. But if this family planning expense is done by an assessee, that is an individual, okay, and he has taken such expense in the P&L account, then it needs to be added back to the net profit. I hope this is quite clear to you all. Okay. Similarly, if the family planning expense is in the capital expense nature, then 1/5 of the capital expense up to 5 years will be allowed to this assessee, that is the company. I hope this is quite clear. Point number 10 says that STT paid, that is security transaction tax paid, is allowed, as well as point number 11 says that CTT paid, that is commodity transaction tax paid by the assessee will be allowed as expense in the P&L account. I hope this is quite clear, irrespective the assessee is individual or a company. I hope this is quite clear to you all. So let's move on to the next page. Point number 12 said that provision for bad and doubtful debt will be allowed in this manner. Okay, if the assessee is a bank or a cooperative bank, okay, then 8.5% of a gross total income before the deduction under this, that is particularly this provision for bad and doubtful debt, plus 10% of aggregate average rural advance will be combined together, and whatever amount we have derived, and if the provision made in the P&L account is more than this amount, then the excess amount over this amount will be added back to the net profit. I hope this is quite clear. Similarly, provision for bad and doubtful debt, if it is for foreign bank, public financial institution, or a state industrial investment corporation, or a state financial corporation, then 5% of the gross total income before this deduction will be allowed as expenses. Over and above this amount, if any expense is taken into P&L account, it will be added back to the net profit. I hope this is quite clear. Similarly, in case of NBFC, 5% of a gross total income before this deduction is allowed as expense. I hope this is quite clear to you all. In point number 13, we have studied how to calculate the discount on zero coupon bonds. I hope this is quite clear, and we will not revise this because there is a very less chance of coming this in the exam. I have explained it once to you all, that is sufficiently enough. I hope this is quite clear to you all. Okay students, so now let's move on to our next section, that is section 37, general deduction. It says that if any expense which are not covered from section 30 to 36, but such expense is a revenue in nature and such is related to the business, then such expenses will be allowed as expense under the Income Tax Act. I hope this is quite clear to you all. So for example, understand that if this assessee is there and this assessee in its P&L account has taken staff welfare expenses, okay, and he has paid an amount of rupees 10,000, okay, so this expense is a revenue in nature, okay, and it is related to the business. I hope this is quite clear. So this expense will not be added back to the net profit. I hope this is quite clear to you. So let's read section 37 once again. General deduction. Any expense which are not covered from section 30 to 36, but such expense is revenue in nature and such is related to business, then such expense will be allowed as expense as per Income Tax Act. Okay, if the above conditions are satisfied, that means these three conditions are satisfied, then such revenue expense are allowed as deduction under section 37. That means that expense is allowed as expense as per Income Tax Act. I hope this is quite clear to you all. Okay, so over here there are few charts given, so let's read that. Okay, so let's read point number 1, taxes. If the assessee is paying taxes and these taxes are taken into the P&L account and these taxes are related to goods and services, then such taxes is allowed as expense. I hope this is quite clear. That means these taxes don't need to be added back to the net profit. I hope this is quite clear. But if these taxes are not related to goods and services, okay, that means this taxes is income tax, okay, then such taxes will not be allowed as expense under P&L account. So this expense of tax, that is income tax, will be added back to the net profit. I hope this is quite clear to you. So that is what is given over here. If the assessee paid the taxes and these taxes are related to the goods and services, then such taxes will be allowed as expenses. But if these taxes are not related to the goods and services, then it will not be allowed as expense. I hope this is quite clear. Then second point says that if interest on tax is paid, if interest on tax is paid relating to the goods and services, then such interest on tax expense will be allowed. Okay, but if this interest on tax is not related to goods and services, then it will be not allowed. That means it will be added back to net profit. I hope this is quite clear to you all. Then point number 3 says that penalty. If assessee pays penalty and this penalty expense is taken into the P&L account, okay, and if this penalty is relating to a contract, that is a contract between the assessee and the third person, okay, and if this penalty is relating to this contract that I have showed right now, then whatever the penalty that assessee has paid and taken into the P&L account, it will be allowed as expense, okay. But if this penalty is relating to any act or law irrespective of any act or any law, if the assessee is paying penalty, that is the business of the assessee is paying the penalty, okay, and in the P&L account this penalty is taken, then this penalty will be added back to the net profit. I hope this is quite clear to you all. So let's move on to point number 4. Point number 4 says that if the assessee is doing the advertisement, then such assessee can take such advertisement under the P&L account or not. So that is what we are going to study in this chart. Okay, if the advertisement is a normal advertisement, that is the normal advertisement in the course of business, then whatever the advertisement cost has been taken into the P&L account will be allowed by the income tax. Okay, it will not be added back. But if the advertisement is done by the assessee in the sovereign brochure etc. of the political party, then it will not be allowed by the assessee. Okay, but the assessee will get a deduction under section 80 GGB or 80 GGC. I hope this is quite clear. So we have already studied this. Okay, so don't worry about that. If the assessee makes a advertisement in this sovereign brochure etc. of the political party, then whatever this expense the assessee has done, if he has taken this advertisement expense in the P&L account, this expense will be added back to the net profit. I hope this is quite clear. So in short, you can understand it in this manner. If the assessee makes an advertisement in this sovereign brochure etc. of a political party, it will be considered simply as donation made by the assessee to this political party. Okay, so whatever the expense has been done, it will be firstly added back. Okay, added back to the net profit, and this expense will be allowed as deduction, okay, under section 80 GGB or 80 GGC. I hope this is quite clear to you all. Okay, and if the assessee is making a deferred revenue expenditure for this advertisement, okay, that is this assessee has paid for this advertisement cost for this 5 years. That means he has paid 5 lakhs, okay, for 5 years. So from this 5 lakhs, only 1 lakh will be allowed as expense. I hope this is quite clear to all. But if the assessee has taken entire 5 lakh in the first year only, then this 5 lakh will be firstly disallowed and it will be added back to the net profit, and only 1/5, that is 1/5 of 5 lakh, which is equal to 1 lakh, will be allowed as advertisement expense in the previous year 2019-20. I hope this is quite clear to you all. Okay, so now let's read the note. Over here, point number 1 says that CSR activity expense as per the Companies Act will be not allowed as business expense as per section 37. That means if CSR activity expense has been taken into the P&L account by the assessee, then such CSR expense will be added back to the net profit. I hope this is quite clear. And Keyman insurance policy taken is allowed as expense. That means if the assessee has taken a Keyman insurance policy and he is paying the Keyman insurance policy premium in the P&L account, okay, Keyman insurance, okay, then such insurance paid by the assessee for the Keyman is allowed as expense. We don't need to add this back to the net profit. I hope this is quite clear to you all. Okay, so now let's revise section 37, general deduction. Any expense which are not covered from section 30 to 36, but such expense is revenue in nature and such is related to business. If above conditions are satisfied, then such revenue expense are allowed as deduction under section 37. I hope this is quite clear. If the assessee pays the taxes and such taxes are related to goods and services, then such tax expense is allowed as expense as per Income Tax Act. But if such tax expense is not related to goods and service, it will not be allowed as expense as per Income Tax Act. I hope this is quite clear to you. If interest on tax has been paid by the assessee, which is the expense for the assessee, and such interest on tax is related to goods and services, then it will be allowed as expense as per Income Tax Act. I hope this is quite clear. But if this interest on tax is not related to goods and services, okay, then such expense will not be allowed as expense. It will be added back to the net profit. I hope this is quite clear to you all. Okay. Then the next point is penalty. If the assessee pays the penalty relating to a contract, then such penalty expense is allowed. Okay, then it will not be added back. But if this penalty is relating to any act or any law, then such penalty will not be allowed as expense and it will be added back to the net profit. I hope this is quite clear. Then the next point is advertisement. If the assessee makes the advertisement for the normal course of the business, then it will be allowed as expense. It will not be added back. But if the advertisement is done in a sovereign brochure etc. of a political party, it will be added back to the net profit and it will be considered as donation. Okay, donation to political party and deduction under section 80 GGB or 80 GGC will be available to the assessee. I hope this is quite clear. But if the assessee has made a deferred revenue expense for this advertisement, then only the expense relevant to the previous year 2019-20 will be allowed, and other deferred revenue expense will be added back to the net profit. I hope this is quite clear to you all. So let's revise the note. The note says that, okay, so now let's revise the note. Point number 1 says that CSR activity expense as per Companies Act not allowed as business expense as per section 37. Okay, so understand that if there is a P&L account in this CSR expense is given, then the CSR expense need to be added back to the net profit. I hope this is quite clear. But if a keyman insurance policy is taken by the assessee, then such keyman insurance policy expense is allowed to the assessee. That means it will not get added back to the net profit. I hope this is quite clear to you all. Okay. So students, now let's move on to our next section, that is section 40, subsection A, disallowances of expense. Point number 1 says that if TDS is deducted but not paid before filing of ROI, that means if this is the assessee and this assessee has deducted TDS, okay, but has not deposited this TDS up to 31st July 2020, okay, then what will be the treatment? That is what is given in this chart. Okay, so if the TDS is deducted by the assessee but not paid before filing of ROI, okay, if the assessee is making the payment to the resident, okay, then 30% of the expense will be disallowed. What does this mean? 30% of the expense will be disallowed. So understand that if the assessee has paid a commission, okay, to a third person, okay, on this commission he needs to deduct TDS. I hope this is quite clear. So he has deducted the TDS but he has not paid to the government, okay, then whatever the commission that he has taken into the P&L account, okay, commission taken into the P&L account, this commission will be disallowed, okay, will be disallowed. That means a commission will be added back to the net profit. How much commission will be added back? 30% of the expense will be added back. That means 30% of the commission will be added back to the net profit. I hope this is quite clear. So that is what is given. If a TDS is deducted but not paid before filing of the ROI, that is 31st July 2020, okay, and such payment is made to the resident, okay, then 30% of the expense will be disallowed. Such 30% disallowances will be allowed in the previous year in which such TDS is paid to the government. That means, for example, this assessee did not pay TDS to the government up to 31st July 2020, but he has paid such TDS on 30th September 2020. That means in the next previous year, that is 2020-21, I am talking about previous year only, okay, 2021, the 30% expense which was disallowed will be allowed in the previous year 2020-21. I hope this is quite clear. So that is what is given over here, okay. But if the pay, that means the person who is receiving the commission, okay, takes such income and pays taxes on such income and files return of income, then such tax is paid in the year in which the payee has filed ROI. It will be considered as the disallowances expense of 30% will be allowed in the year in which the payee has filed ROI. So let's come into a blank page and let's understand this particular thing. So understand that this is our assessee, Mr. A. Mr. A is going to pay commission to this assessee, Mr. B. Okay. So a commission has been decided of rupees 1 lakh. Okay. But Mr. A has deducted TDS but not deposited it. Okay. So what is the scenario? In the P&L account of Mr. A, he has taken this commission of entire 1 lakh, okay, but income tax says that since you have not paid the TDS to the government, okay, the entire 1 lakh will not be allowed as deduction, that is expense as per Income Tax Act, okay. 30% of this, that is 1 lakh into 30%, which is equal to 30,000, okay, 30,000 will be added back to the net profit, okay, and if the assessee, that means Mr. A, pays off this TDS to the government, okay, then this 30%, that is 30,000, will be allowed as expense in the year in which the assessee, that is Mr. A, pays the government the TDS amount. I hope this is quite clear to you all. Okay, so that is what is given over here in this part. Okay, and over here in this part what it is given is, if the payee takes such income, that is the third person, in our example was Mr. B, takes such income and pays the taxes on such income and files the return of income, then such taxes is paid. That means the TDS has been paid, okay, in the year in which the payee has filed the ROI. Okay, it will be considered as the disallowances of the expense of rupees 30% will be allowed in the year in which the payee has filed ROI. I hope this is quite clear to you all. Okay, similarly, if the assessee, that means Mr. A, has paid a commission to Mr. B, okay, and this Mr. B is a non-resident, then 100% of the expense will be disallowed. I hope this is quite clear. That means, for example, a commission of 1 lakh has been paid to a non-resident, and on this TDS has not been deducted and not paid before filing of ROI. Okay, then 100% of the expense will be disallowed, and such 100% of the disallowance will be allowed. That means such 1 lakh expense will be allowed in the previous year in which such TDS is paid to the government. I hope this is quite clear. These 2 points are same for both of these cases. I hope this is quite clear to you all. So let's read the note. The note says that if TDS deducted but paid before filing of ROI under section 139 subsection 1, that is before 31st July 2020, then no disallowances at the rate 30% and 100%. I hope this is quite clear to you. So basically understand that. Let's come back to our blank page over here. This 30,000 which was deducted and not paid to the government, okay, but now the assessee, that is Mr. A, is paying this 30,000 TDS to the government, okay, and this TDS is paid up to the date of 31st July 2020, then whatever the TDS has been paid, it will be allowed. That means this disallowances of 30% or 100% will not be applicable. That means 30% will not be added back to the net profit, and similarly 100% of the expense will not be added to the net profit. I hope this is quite clear to you all. Okay, so we have completed first part of section 40 subsection A, disallowances of expense. Okay, so point number 2 says that if the assessee has taken income tax in the P&L account, then it will be disallowed. So any which ways we have studied this income tax over here in taxes also. If the taxes are related to goods and services, then only it is allowed. If the taxes are related to the income tax, then it will not be allowed. I hope this is quite clear. Similarly, point number 3 says that if the taxes are related to the wealth tax, then such wealth tax will be added back to the net profit of the assessee as per accounting standard. I hope this is quite clear. Point number 4 says that fees chargeable by the state government. Okay, if the fees chargeable by the state government is paid by the assessee and such fees has been taken as expenses in the P&L account, then such fees will not be allowed as deduction. Okay, that is expense, and it will be added back to the net profit. I hope this is quite clear to you all. Okay, so now let's move on to the next point, that is point number 5, equalization levy. If equalization levy is not deducted, or if deducted but not paid up to the due date, then 100% of the disallowances of such expense, okay, which means that such expense will be added back to the net profit. I hope this is quite clear to you all. But if the subsequent deduction or paid after the due date in the subsequent previous year, then the same will be allowed in the subsequent previous year. So this is very similar to the TDS that we have studied in point number 1. I hope this is quite clear to you all. Let's move on to point number 6. Point number 6 says that TDS on salary to the non-resident, then it will be 100% disallowed. That means if the assessee is paying salary to the non-resident and on such salary he has not deducted TDS, or if he has deducted and not deposited it to the government, then the disallowances is 100%. I hope this is quite clear. Any which ways we have studied over here, if the assessee does not deduct and does not pays the TDS before the filing of the return and such payment is made to a non-resident, then the disallowances will be 100% of the expense. I hope this is quite clear. So that is what is only given in this point number 6. Point number 7 says that tax paid by the employer for the employee or the non-monetary perquisite paid by the employer to the employee, then such expenses will not be allowed to the employer. Okay, that means 100% disallowances. That is what is given in point number 7. Taxes paid by the employer for employee or non-monetary perquisite paid by employer to employee, then such expense will not be allowed as expense. That is, if such expense are taken into the P&L account, it will be added back to the net profit. I hope this is quite clear to you all. Okay, so we have completed this section, that is section 40 subsection 8, disallowances of expense. It is a very simple section. Okay, so let's move on to our next section, that is section 40A subsection 2, payment to a relative. This is of highest importance at CA final level. Okay, but here they have introduced to you all, so let's read it. Okay, section 40A subsection 2, payment to the relative. If any payment is made to the relative which is in excess as compared to the fair market value or unreasonable, then only excess amount which has been paid to the relative in the P&L account will be added back to the net profit. I hope this is quite clear. So you all might be thinking, who will come and judge that whether I have paid to the relative in excess or not? Okay, so when you will come to CA final level, that time you will study one chapter known as assessment procedure. Over there you will come to know that when you file an income tax return, the assessing officer, which is an income tax officer who assesses your income tax return, okay, and he checks whether you have calculated net profit in a proper manner. Okay, so over there this particular section gets triggered. At your level where assessment procedure is not part of your syllabus, this point does not make much difference. Okay, so you just need to be aware of this part, that if any payment is made to a relative means simply that we have studied under income from other sources, okay, which is in excess as compared to fair market value or unreasonable, then only excess will be disallowed. I hope this is quite clear to you all. Let's move on to the next section, that is section 40A subsection 3, cash payments. Okay, if any payment is made to a person in a day for a single bill in excess of rupees 10,000 or in excess of rupees 35,000 in case of a GTA, that is good transport agency, then whole of such sum shall be disallowed if paid in otherwise by account pay check, account pay bank draft, ECS, or through such other electronic mode as may be prescribed. So let's understand this in a blank page. Understand over here in the P&L account, okay, you have came across a particular expense and this expense has been paid in cash and such expense is of rupees 12,000. So this 12,000 will be completely disallowed, okay, and this 12,000 will be added back to the net profit. I hope this is quite clear for calculating net profit as per Income Tax Act. I hope this is quite clear. So let's come back to the notes. Over here they have said that any payment made to a person in a day, okay, in a day for a single bill in excess of rupees 10,000 or in excess of rupees 35,000 in case of a good transport agency, then the whole of such amount paid will be disallowed, okay, if paid in otherwise by account pay check or account pay bank draft, ECS, or through such other electronic mode as may be prescribed. I hope this is quite clear to you all. And now there is a rule 6DD for this cash payment. Following are the exemption for this cash payment. Let's read this. If a payment is made in cash to the government or a bank or a financial institution, or if the payment is made by the method other than the method mentioned over here, okay, then such payment will be allowed, okay, if it is made to the government, bank, or financial institution, okay. But if the payment is required to be made on a bank holiday or a strike, then this limit will not be applicable. Then whatever payment has been made in any mode other than the modes given over here, that is if paid in cash, then such cash payment will be allowed as expense. I hope this is quite clear. Such expense will not be added back to the net profit. I hope this is quite clear to you all, okay. Let's move on to our next point, that is point number 3. If payment made to the employee whose terminal benefit is up to rupees 50,000, that means the employee is leaving the job, okay, and his terminal benefit, that is his FNF, that is full and final closure, is of 50,000, okay, and the assessee is paying this 50,000 in cash to this employee, okay, then such 50,000 payment, if made in any other mode other than this account pay check or account pay bank draft, ECS, or through such other electronic mode as may be prescribed. In other words, if this 50,000 is made in cash, it will be allowed. Above 50,000, if made in cash, then it will be disallowed and it needs to be added back to the net profit. I hope this is quite clear to you all, okay. So now let's understand point number 4, payment made to FAPCO. What does FAPCO means? FAPCO means Fisher, Agriculture and Animal Husbandry. P stands for poultry product. C stands for cottage industry. D stands for dairy product. If any payment is made to all these businesses or any people running these businesses, okay, then even if the payment is made more than 10,000 by any mode other than the mode mentioned over here, okay, will be allowed as deduction, that is allowed as expense. It will not be added back to the net profit. I hope this is quite clear. Let's move on to point number 5. Point number 5 says that payment made to employee who is on outstation for 15 days or more and he does not have a bank at that place, then if any payment is made to such employee over this 10,000 rupees, okay, by mode any other than the mode mentioned over here, it will be allowed as expense, okay, it will not be added back to the net profit. I hope this is quite clear to you all. Then point number 6 says that payment made to a place where there is no banking facility available. So for example, if the assessee is making a cash payment, okay, of say rupees more than 10,000, okay, to a place where there is no bank facility, then such payment made by the assessee will be allowed as expense. It will not be disallowed and the same will not be added to the net profit. I hope this is quite clear to you all. Point number 7 of rule 6DD says that payment for purchasing agriculture products, okay, if an assessee, okay, who is running a business, okay, and if he makes a payment for the purchase of agriculture product in excess of rupees 10,000 other than the mode mentioned over here, then such expenses taken into the P&L account will not be added back to the net profit. I hope this is quite clear to you all, okay. Okay, so section 40A subsection 7 and section 40A subsection 9, okay, these sections we have already studied when we were studying section 36 as well as section 37 as well as section 43B. I hope this is quite clear. If you will read this, you will automatically understand. So I hope you all have understood this section, that is section 40A subsection 2, section 40A subsection 3 and rule 6DD for this section 40A subsection 3. I hope this is quite clear to you all, okay. So students, now let's move on to our next section, that is section 41, which talks about deemed profit chargeable to income tax. Over here is our first section, that is section 41 subsection 1, which says that any subsequent benefit arising out of a deduction or allowances made earlier then such benefit arised will be taxable income of the business. What does this mean? So let's come to our section number 32 AD, okay. So what does this section 32 AD was saying? If the assessee set up a new manufacturing business between 1st April 2015 to 31st March 2020 in the notified state of Andhra Pradesh, Telangana, West Bengal, Bihar, then the assessee is eligible for deduction, that is 15% of the cost of the plant and machinery only during the first year of acquisition of such asset. Plant and machinery does not include Udo-Soji but includes forklift truck. If such asset is transferred by way of amalgamation demerger, then no problem. But if such asset is transferred within 5 years, then the benefit given earlier will be added back. So what does this point is saying? If the asset is transferred within 5 years, then the benefit, that is this 15% deduction which was given earlier, will be added back. I hope this is quite clear. That means it will become the business income. I hope this is quite clear to you all. So that is what is given under section 41 subsection 1. I hope this is quite clear to you all. So let's come back to section 41. So over here section 41 subsection 1 was saying this only: any subsequent benefit arise out of a deduction or allowances made earlier, then such benefit arise will be taxable income of the business. I hope this is quite clear to you all. Successor in the business will also be liable to pay tax on the benefit so received. What does this point means? Let's understand this. This is our assessee, okay. This assessee was running the business, okay, and he has taken benefit, that is deduction under section 32 AD, okay, which is 15% of cost of acquisition of plant and machinery, which is equal to say rupees 3 lakhs. I hope this is quite clear. So the deduction under section 32 AD is 3 lakhs. Okay. Now this person transferred his business, okay, by way of amalgamation to other company, okay. So this other company sold the asset on which deduction was given under section 32 AD. I hope this is quite clear to you all. And this asset was sold within 5 years. I hope this is quite clear. So this 3 lakhs benefit was given to the old SSC, but since now the business is transferred and it has been run by this new company, this 3 lakhs benefit which was earlier given to this old SSC, now it will be added back to the business of the new SSC. So that is what is given over here. Successor in the business will also be liable to pay tax on the benefit so received. I hope this is quite clear to you. This is this looks quite small, but it has a huge implication. So I hope you all have understood this part, okay. So I'll erase this part over here, okay. Okay, so now let's revise this section, that is section 41 subsection 1, which says that any subsequent benefit arises out of a deduction or allowances made earlier than such benefit arises will be taxable income of the business. Successor in the business will also be liable to pay tax on the benefit so received. I hope this is quite clear to you all. Okay, so now let's move on to our next section, that is section 41 subsection 3. This section says that sale of an asset used for scientific research without having been used for the purpose of PGPP. While we were studying section number 35, that time we have already studied this part, okay. So now we don't need to stress much on this, okay. Okay, so now let's move on to our next section, that is section 41 subsection 4, which says that recovery of bad debt. So if the assessee has written off a particular bad debt as irrecoverable under section 36 and later such bad debt is recovered, okay, then such recovered bad debt will be considered as business income. I hope this is quite clear to you all. I hope you all have understood this section number 41, okay. So this is a very simple section. I hope you all have understood this, okay. So students, now let's understand the next section, that is section 43 CA. It talks about sale of an asset being a business asset. What does business asset means? Business asset simply means over here is inventory, okay. And if the business asset is land, building or both, then how to calculate the sales value of such inventory is given under this section, that is section 43 CA. So first of all, you all might be wondering that how come a land, building or both can become an inventory of a business. There is a possibility that there is an assessee who is into a property business, okay. And if he is into a property business, then the inventory of his business will be land, building or both only, right? I hope you all are understanding this. Then how to calculate the sales value of such inventory is given under this section, that is section 43 CA. So here the method of calculation of the sale value of such inventory is given. The sale value of the inventory will be equal to actual consideration received if the actual consideration into 105% is more than stamp duty value. I hope this is quite clear. But the sale value of the inventory will be equal to stamp duty value of this inventory if the actual consideration into 105% is less than stamp duty value. I hope this is quite clear to you all. Stamp duty value of which date we have to take is given in this chart, okay. If the date of the agreement and registration is same, then the stamp duty value as on the date of registration will be considered for calculation of the sale value of the inventory. I hope this is quite clear. If the date of the agreement and registration is not same, and if on the date of agreement part or whole of the amount is paid by the account payee check, bank draft, ECS or through other prescribed mode as per the Income Tax Act, then stamp duty value on the date of the agreement will be taken for the calculation of the sale value of the inventory. I hope this is quite clear. Otherwise, the stamp duty value will be taken as on the date of registration for calculating sale value of the inventory. I hope this is quite clear. I hope you all have understood this section. So now let's revise this section, that is section 43CA. Section 43CA says that sale of an asset being business asset. And what does business asset means? Business asset means inventory. Okay. And if the inventory is land, building or both, then how to calculate the sale value of such inventory is given in this section, that is section 43CA. Method for calculating sale value of such inventory is sale value of inventory is equal to actual consideration received if actual consideration into 105% is more than stamp duty value. I hope this is quite clear to you. But the sale value of the inventory is equal to stamp duty value if actual consideration into 105% is less than stamp duty value. I hope this is quite clear to you all. Stamp duty of which date we will take? If the date of the agreement and registration is same, then the stamp duty as on the date of registration will be considered for calculation of the sale value of the inventory. I hope this is quite clear to you all. But if the date of the agreement and registration is not same, and if on the date of agreement part or whole of the amount is paid by account pay, check, bank draft, ECS or through other prescribed electronic mode, then stamp duty value on the date of the agreement will be taken for calculating sale value of the inventory. I hope this is quite clear. Otherwise, stamp duty value will be taken as on the date of registration for calculating sale value of the inventory. I hope this is quite clear to you all. Okay students, so now let's understand the next section, that is section 44AA, maintenance of books of account. If an assessee is running a business and the assessee is individual or HUF and the income earned by this individual HUF from this business is more than rupees 2,50,000 or turnover from this business by this assessee, that is individual or HUF, is more than rupees 25 lakh in any 3 previous year preceding to the current previous year, then the assessee has to maintain the books of accounts for this business. I hope this is quite clear to you all. But otherwise, that means other than this assessee, if the assessees are carrying out a business, okay, and the income is earned from this business by this other assessee is more than rupees 1,20,000 or and the turnover of the business is more than rupees 10 lakhs in any 3 previous year preceding to the current previous year, then the other assessees who are carrying on the business needs to maintain the books of account. I hope this is quite clear to you. But if the assessee is carrying on a profession, okay, this is the assessee who is carrying on a profession, and if the gross receipt in all 3 previous year preceding to the current previous year exceeds rupees 1,50,000 or is likely to exceed rupees 1,50,000 in the first year, then the assessee who is carrying on this profession has to maintain the books of account as per section 44AA. What is this presumptive means? We will understand this presumptive after understanding this section, that is section 44AD, section 44ADA, section 44A. I hope this is quite clear to you all. So basically what we have learned in this section, we have learned that as per section 44AA, a business as well as a profession has to maintain a books of account if this following criteria is reached. I hope this is quite clear to you all. So let's revise this section. Section 44AA says that maintenance of a books of account if an assessee is carrying on a business and the assessee is individual or HUF and the income from this business is more than rupees 2,50,000 or the turnover of the business is more than rupees 25 lakh in any 3 previous year preceding to the current previous year, then the business has to maintain the books of accounts. I hope this is quite clear. But if there are other assessees, that means other than this individual and HUF, and they are carrying on this business and income from this business is more than rupees 1,20,000 or the turnover from this business is more than rupees 10 lakh in any 3 previous year preceding to the current previous year, then the other assessees who are carrying on the business has to maintain the books of account. I hope this is quite clear. But if the assessee is carrying on a profession, okay, and if the gross receipt in all 3 previous year preceding to the current previous year exceeds rupees 1,50,000 or likely to exceed rupees 1,50,000 in the first year, then the person who is carrying on the profession has to maintain the books of account as per section 44AA. I hope this is quite clear. Over here there is a note. In this note, what does profession means is given. Medical profession, accounts profession, interior decorator, architect, lawyer. This all are the professionals. I hope this is quite clear to you all. Okay, so I'll write it over here. This all are professionals. I hope this is quite clear to you all. Okay, books are to be maintained for 6 years. So if an assessee has to maintain the books as per section 44AA, then the assessee has to maintain the books for 6 years. That means if the assessee has started a business in 2019-20, okay, and if he has to maintain books of account as per section 44AA, then from this 2019-20, he has to maintain the books up to 6 years. I hope this is quite clear to you all. Okay, or else the penalty of rupees 25,000 will be applicable to the assessee as per section 271A. I hope this is quite clear to you all. So now let's move on to our next section, that is section 44AB, tax audit. Okay, so over here in this section 44AA we have studied when to maintain the books of account. Over here in this section 44AB we will understand when to do tax audit. I hope this is quite clear to you all. If an assessee is having a business and the turnover, that means the sales of the business, okay, if the sales of the business is more than 1 crore, that is the gross receipt of the business, then the tax audit will be applicable to any business. I hope this is quite clear to you all. But if a person is carrying on a profession and his turnover is more than 50 lakhs, that is the gross receipt is more than 50 lakhs, then tax audit is applicable. And over here there is presumptive. What is this presumptive? We will understand it after studying presumptive income. Okay, note is given here, turnover is equal to sales net of GST plus scrap sales. I hope this is quite clear. I hope you all have understood what this turnover means. Turnover simply means the sales done by the assessee. I hope this is quite clear to you all. Okay, over here also we have studied turnover. This also means that only, sales done by the assessee. I hope this is quite clear to you all. Okay, so now let's revise this section, that is section 44AB, tax audit. Tax audit will be applicable to a business if the turnover of the business exceeds rupees 1 crore, then tax audit will be applicable. Tax audit will be applicable to a profession if a turnover exceeds rupees 50 lakh, then the tax audit will be applicable. I hope this is quite clear. What does turnover means? Turnover means sales net of GST plus sales of scrap. I hope this is quite clear to you all. So students, now let's move on to our next section, that is section 44AD, presumptive taxation scheme for trader. What does this presumptive taxation means? Presumptive taxation means it is a kind of a relief given by Income Tax Act to the assessees, okay, who are carrying small scale business, okay, and this relief is given for calculating the amount of income chargeable under the head income from PGPP. I hope this is quite clear to you all. So let's read the particulars given under this section. Section 44AD says that assessee should be an individual or HUF or a firm. This firm should not be LLP in order to claim a benefit under this section, that is section 44AD. And such assessee should be engage in business other than the following. That means the assessee should not be engaged in this business. So the acronym to remember this is C-GAP. Okay, C stands for commission business, G stands for GTA, that is good transport agency business, A stands for agency business, P stands for professional business. I hope this is quite clear. If the assessee is not engaged in this business and he is engaged in any other business other than this, then the assessee can take a benefit under this section, that is section 44AD, provided the turnover of the assessee is up to rupees 2 crore. I hope this is quite clear to you. So let's read this part again. Assessee should be individual, HUF, firm, and firm should not be an LLP, and the assessee should be engaged in business other than the following, that is C-GAP, commission business, GTA, that is good transport agency business, or professional business. I hope this is quite clear. Turnover limit is up to rupees 2 crore for opting this scheme, that is presumptive taxation scheme. I hope this is quite clear to you. So how to calculate the income as per section 44AD is given over here. Income chargeable to head PGPP is equal to turnover, that means the sales, into 6% if the payment is received by account payee check or account payee draft or through ECS or through such other prescribed electronic mode as given by Income Tax Act. I hope this is quite clear. But there is one more percentage given. So let's read that. Turnover into 8%. When this 8% will be applied, this 8% will be applied if the payment is received in any mode other than the above mode. That means any other mode other than this account payee check or account payee draft or through ECS or through such other prescribed electronic mode. I hope this is quite clear to us. So what we have to do is basically the turnover will be given in the question. Okay, we just need to mention the question and we need to ascertain which percentage will be applicable. 6% will be applicable if the sale is done. Okay, and the consideration for this sale is received by account pay check or account pay draft or through ECS or through such other prescribed electronic mode, then we will apply 6%. Okay, and whatever the amount will come, that will become the income chargeable under the head PGPP. I hope this is quite clear to you all. Similarly, if the turnover is given and the payment for the sales has been received by the assessee from the mode other than this mode, then 8% will be applicable. I hope this is quite clear. So now let's come into a blank page. Over here we will understand that Mr. A is the assessee. Okay, Mr. A is doing a small scale business. Okay, and the turnover of Mr. A during previous year 2019-20 is rupees 1.8 crores. Okay, and out of this 1.8 crores, the assessee has received the sales consideration in this manner. Sales consideration in this manner. First is through ECS he has received rupees 1 crore. Okay, and through other mode he has received rupees 80 lakhs. Okay, so now we need to calculate the income chargeable to tax under the head of PGBP. So we will calculate here in this manner income chargeable under PGBP as follows. Okay, first is consideration received through ECS. Okay, so we will write over here 1 crore into 6%, which is equal to 6 lakhs. I hope this is quite clear to you all. And from other mode, the assessee has received 80 lakhs. Okay, on this 80 lakhs, 8% will be calculated. Okay, so let's calculate 8% on this 80 lakhs. 80 lakhs into 8% is equal to 6 lakhs 40,000. I hope this is quite clear to you. So total of this 2 comes to 12 lakh 40,000, and this 12 lakh will be straight taken into computation of total income of the assessee. I hope this is quite clear to you all. Okay, and in this computation of the total income, where PGPP will be written, that is income from PGBP will be written, over there we will simply mention 12 lakh 40,000. Okay, and on this 12 lakh 40,000 tax will be calculated. I hope this is quite clear to you all. Okay, I hope you all have understood how this section 44 AD works. Okay, so let's revise this section. Section 44 AD, presumptive taxation scheme for traders. Assessee should be an individual or HUF or a firm, and a firm should not be LLP in order to take a benefit of this section, that is section 44 AD. And assessee should be engaged in business other than following, that is C gap. C stands for commission business, G stands for GTA business, A stands for agency business, P stands for professional business. And how to calculate the income chargeable to the head PGPP? It is calculated in this manner: turnover into 6% if the payment is received by account pay check or account pay draft or through ECS or through such other prescribed electronic mode, or turnover into 8% if the payment is received in any mode other than above. I hope this is quite clear to you all. And the benefit of section 44 AD can be taken by a assessee whose turnover limit is up to rupees 2 crore. I hope this is quite clear to you all. So there is a note, let's read this note. Advance tax mandatory. Up to 15th March, 100% of the advance tax has to be paid by the assessee who is following this presumptive taxation scheme. I hope this is quite clear to you all. If option is breached within 5 years, no benefit under this section for next 5 years. What does this point means? Okay, so if an assessee is opting for this section, that is section 44 AD, then he has to follow this method of calculating the income under the head PGPP for 5 years. I hope this is quite clear. And if this assessee breaches the period of 5 years, then no benefit under this section will be available for next 5 years. I hope this is quite clear to all. Lower profit can be shown subjected to tax audit. What does this mean? If the assessee has calculated the profit as per this formula, and if he wants to show a lower profit as compared to this formula as given under section 44 AD, then the assessee can do so only if he is doing a tax audit. Okay, that means if he want to show a lower profit as compared to the profit that has been calculated from this formula, then he has to do a tax audit. So that is what was given over here in section 44 AB, tax audit presumptive. If the assessee claims income below the prescribed rate to be the income under the presumptive scheme under section 44 AE, section 44 AD, under section 44 ADA, in 44 BB or 44 BBB, it is not a part of your syllabus. Okay, so don't worry about that. Then tax audit will be applicable. Okay, so let's revise this point again. What does this point says? Lower profit can be shown subjected to tax audit. If the assessee wants to show a lower profit as compared to this formula, then he can do so, but he have to do a tax audit. So that is what is given over here, presumptive. If the assessee claims income below the prescribed rate to be the income under the presumptive scheme under section 44 AE, under section 44 AD, under section 44 ADA, then tax audit will be applicable to such assessee who is following this presumptive taxation scheme. I hope this is quite clear to you all. Note number 4 says that unabsorbed depreciation cannot be adjusted against the income under section 44 AD. I hope this is quite clear to you all. So now let's revise this section, that is section 44 AD, presumptive taxation scheme. Assessee should be the individual, HUF or firm, and the firm should not be an LLP, and the assessee should be engaged in the business other than the following, that is C-gap. C-gap stands for commission business, G stands for GTA business, A stands for agency business, P stands for professional business. Then the income chargeable under the head PGPP will be calculated in this manner. Turnover into 6% if the payment is received by account pay check or account pay draft or through ECS or through such other prescribed electronic mode. Or turnover into 8% if the payment is received in any mode other than the mode prescribed above. I hope this is quite clear to you all. An assessee can take the benefit of this section, that is section 44 AD, if the turnover is up to rupees 2 crore. I hope this is quite clear. So let's revise this note. Advance tax is mandatory, has to be paid up to 15th March up to 100%. Note number 2 says that if the option is breached within 5 years, then no benefit under this section for next 5 years. Lower profit can be shown subjected to tax audit, and unabsorbed depreciation cannot be adjusted against the income under section 44 AD. I hope this is quite clear to us. Okay students, so now let's move on to our next section, that is section 44 ADA, presumptive scheme for professionals. Okay, assessee should be an individual or a firm and should be engaged in a profession specified under section 44 AA. That means under section 44 AA, here I have mentioned certain profession. If the assessee is involved in any of this profession, okay, and if his gross receipt does not exceed rupees 50 lakhs, okay, and the assessee is an individual or a firm, then the assessee can opt this section, that is section 44 ADA, for presumptive scheme for professionals. I hope this is quite clear. So how to calculate the income under the head PGPP for such professionals is given over here. Presumptive income will be equal to 50% of the gross receipt. For example, understand that this is our assessee and this assessee is a professional, okay, and he is earning a 40 lakhs rupees of gross receipt. Then how much will be his income from PGPP? His income from PGPP as per section 44 ADA will be equal to 40 lakhs into 50%, which is equal to 20 lakhs. Okay, this 20 lakhs will be straight taken into computation of total income of the assessee. I hope this is quite clear to you all. Advance tax is mandatory and advance tax has to be paid up to 15th March up to 100%. I hope this is quite clear to you all. And books of accounts to be maintained and audited if profit claimed to be lower than the deemed profit. That means if the assessee, that means the assessee who is a professional, okay, if he wants to claim the profit below this presumptive income, okay, then he needs to maintain books of account and he needs to carry out tax audit, okay, in order to claim a lower profit than the deemed profit. So basically this presumptive income is also known as deemed profit. I hope this is quite clear. Let's revise this section. Section 44 ADA. Section 44 ADA is a presumptive scheme for professional. Okay, assessee should be an individual or a firm and should be engaged in a profession specified under section 44 AA, and the gross receipt should not exceed rupees 50 lakh in order to claim the benefit under section 44 ADA. and the presumptive income will be calculated in this manner, 50% of the gross profit. I hope this is quite clear. And the assessee need to pay advance tax mandatorily up to 15th March, okay, and the advance tax has to be paid up to 100% up to 15th March. I hope this is quite clear to you. And the books of account has to be maintained and audited if the profit is to be claimed lower than this deemed profit. I hope this is quite clear to you all. Okay,